Good morning, everybody. My name is Patrick Bratelius, and I work for ABG Sundal Collier. And I would like to kick off this day by presenting Henrik Stenlund, CFO of Vostok Emerging Finance. The floor is yours.
Thank you very much. Great to be here. And I hope everyone can hear me okay. So we have 20 minutes. I'm going to jump right into it. So we're Vostok Emerging Finance, a fintech investment company operating in the crossroads of financial services and emerging markets. This is a snapshot of the company now. Our latest reported NAV was $223 million. We have some cash, a war chest to invest of 20 million. We have made 14 investments since inception and 2 exits with quite good results, actually, with an average 65% IRR on those 2. Those were a Russian digital bank, Tinkoff Bank, and a Turkish payments company, Iyzico. So how do we invest and where? So we're focused on emerging markets, but sector-wise, we target basically all sectors of financial services, be it credit, payments, wealth management, and what have you. Geography, we like scale markets. Hence, we have exposure in Brazil, which I will come back to, Mexico, Pakistan, Russia, scale markets with a big population. This is very important to us. We typically take minority stakes of 10 to 20%, roughly, and our sweet spot is probably the growth stage, early growth stage when it comes to investment. We think we're a unique fintech investment vehicle. We're listed on Nasdaq First North, so we provide some liquidity for our shareholders while investing in the private space, which is a space that is very hard to get access to for many investors. So it's a great vehicle. And this is representing, we're basically touching anything that is related to fintech or financial services, as you can see from this slide. The only thing in this slide we haven't really tapped into is insurtech, but that is probably something to be investigated further. Well, we are in credit, payments, PFMs, investments, and embedded fintech, if you wish, with accounting SaaS, for example. We have a global lens because we invest globally, and this is a great asset for us. So we see the types of business models that work in one market, and we can take learnings and experience from that market and apply in a new market with the same models, basically. And partners are very, very important to us. We invest far away from home, and we have partnered up with some of the strongest local VC companies in each market that we operate. And this is something we're putting a lot of effort into, nurturing that network. And that's how we get some of the deal flow as well. With strong partners, they will come to us because we fill a perfect capital gap in the early stage growth phase of the companies. We have a global mandate, as I mentioned, and a well-diversified portfolio. And as you can see from this slide, 60% of our NAV is in Brazil. 75% of the NAV is in LATAM, and that is by design. Now we'll come back to Brazil as well and why we think that is maybe the holy grail of fintech markets today. But we also have exposure, as I mentioned, in Russia, in India, in Africa, in emerging Europe as well. So well-diversified portfolio. This is another representation of the portfolio, and as you can see from the pie chart here, Creditas is emerging as the relative size portfolio company for us. And this is probably the company that is going to move the needle from an NAV perspective in the short run. That's what we think, and that's our belief. And the 2 largest there, Creditas and Konfio, those are the emerging winners, we would like to think. Even it's still early stage, but we have high hopes for those companies. And as you can see here, we have a very well-diversified portfolio, but 6 out of 12 holdings are based in Brazil, and we touch basically any financial services play in terms of fintech and sector here. So Brazil, why do we have 60% of our NAV in Brazil? It is a bit of a concentration, but as I said, it's by design. We think Brazil is by far today the most interesting fintech market globally. It's a scale market. It's over 200 million population, which is very important for us. That means you don't have to go beyond the borders of the country because the market is big enough, and you can make it while staying at your home turf. That decreases risk for us. Brazil is also one of the most online markets globally. People are using internet, they are using social media. I think it's the fourth largest social media country globally. And they're very well acquainted with internet and the online services that's going on. It's also an oligopolistic banking sector where a handful of the top banks control basically 80% of the loans in the system. And that is in a country where some of the highest interest rates and fees, which means it's a huge market to tap into for any fintech. It's a well-banked ecosystem, actually. So it's an emerging market, but we develop market features many times. And when it comes to banking, it's just the banking experience that is bad for many of the customers and the pricing. So in Brazil, it's not so much a case of educating the masses and tell them this is financial services, you need this. It's more a case of giving them something that's better, cheaper, better user experience, and more efficient, basically. Some of the companies that we invest in, they operate under various licenses. So the licensing or the regulatory framework becomes very, very important for us as well. And Brazil is a country where the regulations have been favoring emerging fintech players, which is also very important for us. Great assets in this country in terms of people and ecosystem. Super strong entrepreneurs, very, very competent and great VC community that's within our network. Also a given important thing when you invest. It's easy to spend money for everyone. It's a different question to get the money back and hopefully with a great return. And Brazil is also a market with a proven history of great value creation and a very viable exit market, which is something we clearly like and investors think is important. That's what we do. So jumping into Creditas. So Creditas is a digital secured lending platform in Brazil. In Brazil, roughly 70% of all the houses and the cars are owned debt-free. At the same time, Brazilians are paying some of the highest interest rates in the world. And you can see from this slide that the top three highest priced categories on the credit side, credit cards, overdraft, and personal loans, they're priced at an APR of 230%, which is very, very high, to say the least. And this itself represents a revenue pool of $125 billion. So it's a very, very big market for Creditas to tap into. So Creditas offers consumers the option to use their cars or their homes as collateral to reduce the high lending costs that they are paying on these categories on the credit side. It's a huge market, and Creditas is growing very, very fast. All the companies in our portfolio are growing super fast, and Creditas is one of the fastest growing ones and represents 30% of our NAV today. Nibo, we're staying in Brazil. So Nibo is an accounting SaaS company. I think the best peers would be probably Fort Knox or Xero out of New Zealand. So it's the leading accounting SaaS platform for small businesses in Brazil with a client base today of approximately 300,000 small businesses that are, and also 3,000 accountants. And small businesses in Brazil are legally bound to use an accountant. So Nibo have been distributing their products on their platform through their accountant base to reach the end consumer. Nibo keeps adding new features and products to the offering every day. Today, it's the classic accounting SaaS products like accounts reconciliation, cash flow projection tools, but you have also payment options and issuing of invoices, etc. But I think the most interesting thing with Nibo, except for being a great company in a fantastic and unloved space, because accounting SaaS isn't the most loved space, which is why we like it. So the competition is lower. But it's the data set, the extreme data amount that Nibo is accumulating through this SMB base. And that is, of course, something that down the line will and are going to be monetized. So that's Nibo, our Fort Knox, let's call it that. And as always, we invest in entrepreneurs, strong entrepreneurs, and a great founding team, which is key for us to pull the trigger when it comes to investments. The last company, because I can't run through all 12 of them, is Konfio. It's also a lending platform, but this is in Mexico. And this is an unsecured lending platform. And Konfio started basically only extending loans to their client base. And this is a very big untapped market as well. They're attacking roughly 7 million SMEs in the country to offer. And that's the high-end category of that segment in the pyramid, as you can see there. So how do they do it? Unsecured lending it's risky business, but Konfio, they're leveraging big data, their own tech stack, coupled with fiscal policies like mandatory electronic invoicing, which means they are extracting a lot of data, so they are able to score these SMEs and give a very, very clear picture of their credit worthiness before they're extending the loans. Konfio have larger ambitions than only extending credit and being a lending platform. I think we will see this company becoming everything SME for Mexico, be it payments, ERP, on the accounting side, coupled with the financial services pool. And they're already today offering actually their tech stack, like banking as a solution to some of the largest clients in the market, like Grupo Modelo, for example, the beverages company that you may have heard of. So they are actually using the tech stack from Konfio to score their own supply chain and extend credit to them. So their part or their share of non-credit related revenues are becoming substantial, actually, even from a low base. But we can see a great future for this company, as well as the other companies in the portfolio. I'm not saying I love this company the most, because you don't say that, but it's a great company. Super strong founding team and entrepreneurs as well, and we have great confidence in that this is going to be one of the two companies, I think, in the medium term that's going to have a real impact for us. So that's the portfolio, snapshot of the portfolio. And this is our history. This slide shows our NAV development since inception, basically. And the share price have more or less tracked the NAV with varying degree of discount, which is something we obviously don't like. But of late, I think many new investors have sort of gotten around our story, and we have been tracking a much lower discount to the NAV of late. And again, repeating the numbers, latest reported in Q2, $223 million of NAV. The share price at that point was $315, and market cap $210 million. Coming back to the fundamental thing that we do, we invest to be able to exit at higher valuations. And the two exits we have made so far is, as I mentioned, Tinkoff Bank, where we had a 65% IRR and 6.1 cash on cash multiple on that, which is great. Tinkoff was a listed asset in our portfolio, and we invest and play in the private space, not the listed. The other exit we did was in a Turkish payment company, and this was a great schoolbook example of how we want to invest. Very early stage, with actually when the tanks were on the street, and then the coup happened. So that meant a favorable pricing point for us and less competition. This was a fantastic company that got acquired by Naspers, which is the PayU, which is the arm, payments arm from Naspers. And we had a great return on that asset as well. We would have loved to keep holding it, but we, in our investment thesis and strategy, when the entrepreneurs are ready to move, we follow suit as well. And looking at the unrealized returns, I'm more in favor of looking at the actual returns, but as you can see from here, we have had on a per share basis NAV close to 24% since inception, and the share price is tracking that, so a little bit lower at 22. And that's it.
Thank you. Thank you. I have prepared some questions.
Great.
I saw the impressive track record, but do you have any financial targets connected to this on IRR or multiple?
Yeah, we do. We always try to, you know, the spreadsheets and the models on paper say something, and then reality is always different. It could be better or worse, but we try to target a 30% IRR when we take the investment decisions.
Yeah, and how long is normally your investment horizons?
Good question. So we are long-term investors. Look, early stage, emerging market, fintech, that's a bag of risk, to be quite honest, but it's a huge upside as well. But that means that we are very long-term when it comes to investing. So typically, we have a horizon of 5 to 7 years, in that range. But you can end up holding an asset that is great and are generating cash flows for you longer than that. And it can be shorter, as in the case with Iyzico, for example. We were in no rush to sell that company, but an opportunity presented itself. And that tends to happen with the greatest assets.
Yeah?
You get offers and you say no, but at some point in time, the entrepreneurs think this is good for us and we should take it, and then we're supportive as investors. And we didn't mention that, but we have board seats in all our holdings, so we are very active as investors as well.
Yeah, and now we are in a COVID-19 world. So what is happening on the activity? How is the deal being sourced now? Is activity going down? How is valuations impacted in the sector, and how do you think this will progress going forward? Also
a great question. I think, look, we in Q1 we wrote down the portfolio with 25% roughly, and that was because of no visibility from the COVID pandemic happening around the world. What we did was that we worked extremely actively with every single portfolio companies. We altered their business plans with them, of course, just to do anything to extend the cash runway throughout this window because of the low visibility. In Q1, portfolio value went up again, and simply because I think all of the companies are back at the same level they were back in March. And we also had a window when we saw that the pandemic was hitting Europe. It was a bit later in these markets, like Brazil and Mexico, for example. So we could actually see what was going on and prepare accordingly. But all the companies are back on a growth footing, and looking at maybe 2 other names in the portfolio in the payment space, like TransferGo, which is a remittances company. They're tracking ahead of budget. They haven't been impacted at all by the pandemic. And an Indian payments company, which is our most recent investment. Same thing there, just adding partners, and they are in a sense beneficiaries from the pandemic in terms of, you know, accelerated digitalization, etc., etc. Deal sourcing, we have for obvious reasons been very inward focused during this window, but we are constantly building a pipeline of companies, but we haven't really pulled the trigger on anything new at this stage. But we see, I think, the seed type of tickets, the super early ones, they are unimpacted because it's like we need $1 million and this is the valuation you can get for that. So that's not really impacted. But obviously, Maybe the mid-range have been a bit, demand has come down slightly, but that's on the way up again. We see a great pipeline now coming through. So, and also I think worth mentioning, headlines versus reality in some of these markets. There's, to our experience, a very big discrepancy between there. Headlines are screaming the world is going under, but in reality, things aren't that bad necessarily. So.
Yeah. You're very tilted to Brazil, and
we are.
they have, according to the headlines, they have a huge problem with the COVID-19 as of now. But how has...
And they do.
Yeah,
obviously.
of course. But how has this impacted Creditas, and what is the next step for that company in the future? Is it expanding outside Latin America or outside the Brazil region? What's your thoughts?
Yeah, no, great question as well. Look, Creditas, what they did in this pandemic window, they stopped customer acquisition spending, and they turned to cash flow positive in a matter of a couple of weeks, which is something that's easily said or shown on paper, but you never really trust it until you've seen it for real. But they did, which was a fantastic stress test through the window for Creditas. Creditas have actually set up shop in Mexico recently, so they're starting slowly. We think Brazil is a big enough market for us, actually, but they are doing that. But what they're doing, they're building new offerings and deepening the customer experience and the customer engagement through the core pillars that they have, which is car, auto, and payroll. Secured products with a variety of different services and products coupled with that. So super interesting future for Creditas. And maybe because I always get that question, so when are they going to exit? We don't know, to be quite frank. But I think Creditas is maybe the company that is closest to some sort of exit, if you think from a 2 to 3 year perspective or something like that.
Okay. Interesting. I wish I had more time to ask more questions, but I will ask a final one. So, how hands-on are you as an owner? How do you work with your companies in general?
We're very active as owners. So as I mentioned, we have board representation in all our holdings. We have, and specifically during this window, we have been on weekly calls, and we get weekly and monthly KPIs from all the companies constantly. So we're interacting, speaking, engaging continuously. So very, very active is the short answer to that question, I think.
Oh, great. Yeah. Thank you, Henrik. And we unfortunately have to move on with others. Thank you for today.
Thank you for having me.
Good morning and welcome to today's presentation with Volati and the Introduce Investor Days. My name is Eric Castle and I'm an equity analyst here at ABG. This morning I have the pleasure of introducing Mårten Andersson and Andreas Stenbeck of Volati. And we'll have a 20-minute presentation followed by a short Q&A from me. And with that, I'll leave it over to you.
Thank you, Eric. It's great to be here and thank you for the invitation. We would like to, for the next 20 minutes, take you through like an overview of Volati, and then I'm sure we will have some questions afterwards. But if we step back a little bit and have a look at who we are, I'm Mårten Andersson. I've been with Volati since 2012 and been the CEO since 2014. I have about 3% of the common shares and have about 1 million SEK invested in our preference share. Andreas Stenbeck, who will introduce himself later, who's the CFO, has been with us since September 19. But if we look out and see what we are doing and what is sort of our business idea, and since inception, when we started back in 2003, we've basically been focusing doing exactly this. We are acquiring stable, profitable, well-run businesses at a reasonable valuation. And then we view ourselves as long-term owners of this, and we have strong focus on value creation. Of course, you can talk hours about what this actually means. We don't have the time today, but I'm going to take you a little bit through what we look like. The first question is, has this been successful? I think this has been extraordinarily successful since inception. If you look at our growth story that we're on together with our shareholders, we've had since start about 30% EBITA growth every year. And if you look since the IPO, end of 2016, we've had an EBITA growth of 19%. So together, shareholders, we are on a tremendous growth story that we would like to see continue. When you grow at that rate, of course, how the business looks changes quite rapidly. But if you want to have a snapshot what we look at right now, we are divided into 4 business areas. And if you start at the sort of the left side of the screen, this is our business area trading, which is about a third of our profits, mainly geared, it's a Nordic dominant player, mainly geared towards sort of construction consumables. You have quite well-known brands there as Habo all around the Nordics, Väggmaterial, T-emballage, but you also have pure wholesale like in the form of Tomer. Here the fundamentals are strong brands and very efficient logistics. The second part is our consumer business, where we have Besikta, who's the leading vehicle inspection company in Sweden, which is a dominant company in that business area. It is also a company called Naturmed Pharma, which is sort of nutritional supplements. Our third business area, Akademibokhallen Bokus, top 230 leading consumer brands in Sweden, 2 million clients in our stores and in our online sales. About 50% in stores, about 50% online sales in this business area. And the last is our industry grouping, which these companies are typically product leaders in their niche. 2 of them have quite a large international presence, where we have helped them take their products out in the European markets. That's Coventa and Tunum. And then we have an infrastructure play with Sankt Eriks and a fantastic labeling business in Etiquette och Printcom. So this is what we look like at the moment. If we look at our numbers, we've had a very good start of the year. We reported 17th of July our numbers, and our sales is now about 7 billion SEK, and that produces an EBITA profit of 589 million. I think what is quite exceptional this year is that we produce an absolutely fantastic cash flow, 802 million SEK in operating cash flow. The Volati business has always generated a lot of cash. I think given the COVID-19 pandemic and the situation during the first half of the year, we focused a lot on that, and you see the results of the cash that we can actually produce when we put full focus on that. These strong numbers gives us a very low debt ratio, and our net debt to EBITA today is 1.3 times. Of course, this gives us all the possibilities to execute on opportunities in the M&A market that might occur. I'm going to focus in a little bit, very briefly, on the second quarter. This is, of course, a quarter that's very dominated by the pandemic and everything around it. We delivered great results. We grew our sales. Our EBITA is up 41% to 108 million. So overall, after quite interesting and very, very intensive quarter, we are coming around and delivering fantastic numbers. And I think that says a lot about the resilience of our businesses, the resilience of our position in the markets, and actually about the managed teams that we have that have been able to take us through this. If we zoom in a little bit on that, I think what is very, very pleasing to us is that a lot of that profit increase actually comes to the shareholders. How our capital structure, what it looks like today, is that a lot of the extra profit as Volati grows ends up with our shareholders, and actually our earnings per share grew with an extraordinary 129%. And as we said before, operating cash flow very, very strong, and overall a great company. People ask me, didn't you get affected by the pandemic? We got very affected by the pandemic. We are in a lot of different businesses. We have sourcing from Asia. We run a retail network. We have businesses that actually source from Italy and deliver in Russia. So of course, there's been a lot of pressure on the businesses, but I'm very proud of how we and our management teams have delivered and been able to solve that and actually gain position during this second quarter. We also executed on an add-on acquisition to Etiketto Pinco, which is Benelli, which I'm very pleased with. During a few months, we actually paused our M&A activity. Stopped. Andreas will talk a little bit about that. But when we reactivated, we were still in a strong position to start executing, and which is quite pleasing. So how do we create these results? And we don't have a lot of time to talk it through. Of course, the fundamentals and how we create values has actually a lot at the point of acquisition. I think Andreas would take us through that a little bit later, how we create value at the point of acquisition. When we own the businesses, we basically, as owners, as active owners, focus on three main areas. Strategic direction, quite easy. If you have this well-run business, strong market position that you just have acquired, what do you do to create value? And here, I think the common or most important word is that it's a common view between us and the management. And we spent a lot of time, I would say the first 6 to 12 months, to set that direction. Then I think we can help our mid-sized businesses a lot with ensuring that they have the right board and the right management in place. Now, we'll talk a little bit more on that on the next slide, but this is a core value add that we have as active owners to our businesses. The third portion is what I call operational efficiency. And during the second quarter this year, particularly, we've helped really our businesses to keep the pressure up and addressing those issues you have. So you can't do one of these three things and good at it. You have to do all of them at the same time and make sure that you deliver on them. And I think Volati has done that exceptionally well over the years. And as you have seen, we produce a lot of cash flow, and the question we always ask is, how do we actually reinvest that cash flow in the best possible way to generate the best returns for you, for our shareholders? And that we can do through reinvesting in our businesses, but also through new acquisitions. I wanted to talk a little bit about what we can do as owners to our businesses. And if you look at a growth rate of 30%, the actual challenge or bottleneck is access to good management and good people. I think we realized this quite a number of years ago. And today we work very, very systematic with that. And we have 4 areas to make sure that we have the right people in place today, but more importantly, in 3 to 5 years when we're twice as large. We have something we call Volati Management Program, which are for young talent that have worked a few years, typically with business consultants or bankers that want to actually come into operations and have a chance to become the CEOs of a subsidiary. We've run that for 3 to 4 years now, and I'm very pleased. We have what we call Volati Academy for existing management teams to make sure that we have a common view on how businesses are supposed to run. To make sure we have the right boards in our businesses, we have something we call Volati Board Academy. We meet up twice a year. And to ensure culture and proudness of being part of the group, we run a Volati management meeting for all leaders every second year. I'm now going to hand over to Andreas, who's going to take us through a little bit the financials and the acquisitions.
So, hi everyone. Just spending a couple of minutes on our M&A agenda and M&A work. Starting with this, as Morten told us, we had a very strong operational cash flow over the last 12 months, which of course puts us in a very good position with regards to M&A. The net debt to EBITDA ratio is 1.3, and if you compare that to 12 months earlier, the corresponding number was 2.4, so we're in a good position. When we're looking or reviewing add-on acquisitions, we categorize them into 3 different categories. Starting from the left, add-on acquisitions. That's where we see new add-ons to our existing business areas and business units. That's continuous work that we do within our business units. The management teams, operational teams are working with it continuously. It's part of their strategic toolbox. They both identify and actually go through with the acquisitions. And that's something that we've seen being very successful in the last 18 to 24 months. I think if you look at what we've done 2019, 2020, we've done seven of those kind of add-on acquisitions. And synergies is an important part of those transactions. We need to identify synergies and then, of course, work with them afterwards. The middle category might not in the short term be as synergetic. It's more about finding new add-ons to the existing business areas. We find companies that complement each other. They might share similarities. And we've done continuously those kind of acquisitions as well. I think T-Emballage, which we did a couple of years ago, is a good example of that, which was added to our trading business area. And then the last category, new platform investments to Volati. That's an area where we're now putting a lot of efforts in identifying these. Typical situations there is where we perceive the risk probably slightly different to the market, which means that we could come into what we believe is a fair or good value. Other situations is where we have complex situations where we can draw upon our previous expertise, our fast decision routes and so forth, and be competitive. Akademi Bokhannan and Besikta are 2 good examples there. So these are just to show the 7 add-on acquisitions that we've done since 2019. It's extremely happy also to show Pisla here, which we did, I think that was announced last week. A very good add-on acquisition to our business area trading. It's a good example of what we want to do. So Pisla is the market leader in Finland with regards to fittings. We own Habo, which is number 2 on the market, and of course together those 2 will have a very dominant position. We're also getting some additional products, and we're getting access to the Baltics. So that's a good example of what we want to do. Our financial targets, just quickly address those. As you can see, I think we're very happy with the EBITDA growth, well above our target of having an excess of 15%. Return on adjusted equity, I think we're slightly behind there. But if we exclude the impairment of intangible assets, the write-down that we did in Q3 last year, we're up at 18%. So I think we're on a good way there. And the capital structure already addressed there. That I think we are well below our target. So that's something that we need to look into. But on the positive side, I think that gives us a lot of room for add-ons. So yes, just a minute or so to sum it up. We are very confident about our earnings growth. I think we proved that in Q2. We had a very strong growth. And also looking at a longer perspective, 90% annual growth since the IPO and so forth. I think we're on a good path there. We are very proud about and confident about the strong business area organization. I think we've proven that in the pandemic now, that we can work very efficiently through our business areas. And we have also shown that with regards to add-on acquisitions, where we're very successful with that. And then finally, the financial position. I think that enables us in a very good way to continue not the least the M&A path, which we are putting even more focus in going forward. Yeah, I think that's...
Thank you very much, Martin and Andreas. So you have a target of growing EBITDA by 15% and have surpassed this historically. Yeah. So looking forward, how much of this could come organically from your businesses, and how much would you have to acquire to reach this?
Should I start, Andreas, perhaps? I think the target is actually at least 15%. Yeah. I tend to be the optimistic one. I think over the years we've proven we can do a little bit more than that. I think we can continue to do that. We have a strong balance sheet. We have a great organization. And And currently, we have a lot of opportunities for acquisitions. If you look at Volati, it's an acquisition-driven growth story. We acquire, as I said, well-run, stable, proven businesses. Some of them have some type of organic growth built into them, some less. What we do as owners is that we focus on building that long-term organic growth story. And if you look back, it's been a very important part of what we do. It takes some time. We acquire the business, we set the strategy, we get the management, and then over time, we have developed a lot of our businesses in a fantastic way. So we will have solid organic growth, but if you look at the numbers, 15 plus, of course, that's an acquisition-driven, mainly the acquisition-driven story.
So when you're now looking to deploy capital in this market, how are valuations looking and the number of possible targets, and have Corona affected this in a way?
I think what happened to the market was that, in March or early March, of course, the M&A market, slowed down significantly. We also paused all our M&A work, so we acted the same way. I think even before summer, we reinitiated the discussions we had that actually enabled us to do one acquisition before summer and one now after. And I think many others have reacted in the same way, and also the sellers have started to be there. So, and what we've seen so far this fall, activities are picking up. I think one important thing for us is that it's, building an M&A pipeline. It's a long-term work, so it's not short-term. So that means that most of the discussions that we have right now were initiated, 12, 18, 24 months ago, and those they don't disappear just because of the current situation.
Yeah.
If you want to speculate a little bit, it's my personal speculation. I think that where we have been very strong over the years is the mid-sized, privately owned, entrepreneur-owned businesses. And I would believe that some of them would come out after this pandemic. When we come out of the cycle, when people start feeling a bit more comfortable with their results, I hope and believe that we're going to see quite a lot of opportunities there in that market.
Yeah, all right.
Yeah, and also we prefer situations which are not standard broad auction processes. We are happy to participate in those as well, but if there are some additional complexity to the situation, that suits us even better. And I think this environment that we are in right now benefits us in that way. So having bilateral discussions, one-on-one discussions, identified situations which we can work on. I think those, yeah.
Yeah. So I think my next question builds on that. So you're not really alone in being an acquisition-driven company. It's quite popular here in Sweden. So how do you differentiate yourself from peers in the industry? How is Volati different?
Should I start? No, I think we've done this for quite a long time. I think for we've done this for 15 years. I think we have done it well. I think we have a strong reputation with entrepreneurs that want to sell their businesses because they have seen that we take care of the businesses, we develop them, we are good long-term owners. I think we're good with a lot of intermediaries because they know they have a high transaction security with us. So when we say we do something, we actually execute on it. And that takes 15 years to build. I'm not saying that there are not other players that have that, but I'm very confident with our position in that sense. I think that differentiates us. And then I think we have a little bit different view on certain things, at least, on how we create value.
And also, we touched upon us making add-on acquisitions, and that's to a certain extent that's new for us, and that kind of brings us also in the bracket of being an industrial buyer. So if you combine Volati in the back and all that value that brings together with us actually being an industrial buyer, I think that's also what we've seen, that it's enabling us to come in and be very competitive in situations.
Yeah, if you look at the last acquisition, Pisla, which is sort of a mid-sized company, it's actually not a Volati acquisition, it's Volati Handels, which is sort of an industrial player in that sector. They know each other. They've sort of been instrumental in that. And I think we see more and more of that.
Okay, and that also builds on my next question. So Pisla was an add-on acquisition, and you've done quite a few of those recently, but not many platform acquisitions in the recent years. Are you looking mainly at add-on acquisitions going forward as well, or also, as you've said, you have quite low net debt to EBITDA and could probably do a bigger platform? Is that something you're looking for?
I think when it comes to the platform businesses, you never know when they occur. That's quite. We've done. If you look on our history, we've done it every 2 years, more or less. We've done Besikta, we did Långmon Industri, Akademi Bokhandeln. We've done them every 2 years. It's very hard. It needs to be. the right specific situation, the right company, and the right moment. I'm sure that will come. Exactly when, it's hard to say, but it's an important focus area of ours.
Yeah, exactly. So I think we're putting a lot of efforts on that right now. But it's again, we have to be disciplined. So it's not that it's when the situations occur, then we want to be there, and we definitely have room for it. So that's
yeah. And one more competition. We've heard from some of your peers that the Swedish acquisition market is quite competitive, and many companies are looking for acquisitions here. Are you looking for other geographical areas as well as Finland with Pisla, or are you mainly looking at Sweden still?
I think a comment on the competitors, the Swedish M&A market has been, it's a professional market for the last 10 years. I think they're professional buyers, they're professional intermediaries. It's sort of an efficient market in that sense. I think we've been able to create a lot of value in that market. So for us, it's not a change. I think when it comes to the Nordics, I think we're more and more comfortable. I think particularly within certain of our business areas where we already have a presence. I think when it comes to specific add-on acquisitions to a business unit, it could actually be outside of the Nordics. Would we do a platform outside of Sweden and the Nordics? Perhaps in the future. I don't think that's the focus right now.
All right.
No, but we are evaluating also opportunities outside of the Nordics. But then it's probably in an area, an industry where we're already existing through a business unit. So
all right. Thank you very much. I think we're up on time right now.
Okay.
So I want to thank you very much for coming here, and also to everyone listening in. Thank you.
Thank you.
Bye.
Hello. So good morning and welcome to the Introduce conference call with Danish listed Green Mobility. My name is Laurits Kjærgaard, analyst at ABG, and with me I have Anders Well, VP of Investor Relations of Green Mobility. You should have the company slides in front of you, so thank you for being on and welcome to Anders. Shall we begin with a walkthrough of your equity story, please, Anders?
Thank you, Laurits, and thank you, everyone. Good morning and welcome to Green Mobility. We are a sustainable car-sharing company, meaning that we work entirely with electric vehicles to benefit the city environment. Green Mobility is founded on 3 megatrends, so the urbanization, the green agenda or sustainability, and the sharing economy. As we are all moving into the big cities, and if we keep bringing private cars with us, naturally the problems that we have will increase. Problems like parking, pollution, noise, and so on. That is something we have to change. At the same time, we have to have more a better city environment with cleaner air and a better environment for future generations. That is something that the sharing economy, who's been with us for the past few years and growing tremendously, is something that we can accelerate the change in mobility with. So for Green Mobility, this is what we're looking at. Improving and reducing private cars in the cities. This is something that politicians all around is looking at the moment. And this change has accelerated dramatically. When we go back a few years, cities and countries around Europe, around the world, set clear climate goals on whether it was for 2025, 2030, on how much CO2 emissions they had to bring down. Still, at that time, it was very new. How did we actually have to do this to achieve it? Today, we see that mayors, prime ministers, and so on, they are actively putting measures and actions into action. Green mobility is a big part of this. We have a solution that actually can impact mobility in the city and in an environmentally friendly way. One of the things that is needed in order to solve problems in the city is ultimately to remove private cars, which can be scary to many, but the foundations to actually do that is to have alternative types of mobility. A lot of it is already in place. We have what we call long-distance traditional public transport, trains, buses. We see a lot of short distance, like bicycles, kick scooters, and so on. And then we have the traditional mid-distance, typically 7-8 kilometers. This is what Green Mobility offers. But this is also how we replace private cars. So when we have these 3 in place, we don't really need private cars anymore. And that may be sort of scary to many, but this is actually the direction we're going in. Maybe for longer distance outside the cities, you will still need private cars for a while, but within cities, we need to dramatically reduce the number of private cars. And with these 3 in place, we actually have that already. From our operation in Copenhagen and other cities, we see already now that we are able to reduce private cars in a ratio of 1:4, meaning for every electric share car we bring in the street, 4 private cars are sold. And additionally more are postponed and purchased or so on. Green Mobility, we are a Danish car-sharing company. We were founded in 2016, and today we are operational in 4 cities here in Denmark and in Sweden, so Malmö, Gothenburg, Copenhagen, and Aarhus. We were listed on Nasdaq in 2017, and since then we've seen tremendous growth, and this is just continuing. As of today, we have active plans of entering Belgium, which is actually going to be done later this month in Antwerp and Ghent, and the same for Helsinki later in the year. We see a lot of potential around Europe. I'll get back to that in a little bit while. But here on the map, you see the current cities that we're in. An important part for Green Mobility, of course, is the CO2 that we are saving by using our entirely electric fleet. This is something that we are measuring on a daily basis. Currently, we have 700 EVs in operation and expecting to have a fleet of 1,100 EVs before end of year. And if we look a little into how the performance has been for the past period and essentially back to when we started, We have this graph. I think it shows very well the activity of the company. This is what we call active customers over essentially back to when we started. And here you see the natural activity level. We have seasonality, classic when we have Christmas period, summer period, and so on. So that's actually quite well. We saw last year a dip in our operation due to a platform that had some problems for us. So over here by the figure 1, we chose to change our platform. We actually took the entire fleet out of operation for a 2-week period, and that has a massive impact. But it was also clear that bringing in a new platform brought back customers, and we were quite quickly on a growth path as well. Then, as most others, we were hit by Corona, which naturally brought down a big impact on the business. So in the start of Corona, we went down to an index of around 30. Naturally, people are sent home from work, schools are closed, the airport are closed, and so on. But what we saw quite quickly was that there was a change in mobility patterns. So even though a lot of people still home, there were new types of mobility needs that we had to service. So we only had a short while sort of at the bottom, if you like, and then we grew day by day. At the end of June, we were coming out of the Corona crisis and ending at an index of 120 compared to just before Corona. So we've shown very clearly that a shared mobility solution can actually benefit from a crisis like this. Since then, we did have a summer period, smaller than usual, but now we've seen a continued growth. We reported after in combination with our Q2 results that we were able to have a break-even in our Copenhagen business. And last week we announced that as the first EV-based car sharing ever, we have a positive result in our Copenhagen business with a profit on a monthly basis of 350 Danish kroner. This has been a huge milestone for green mobility. There's been sort of doubt, can car sharing in general be profitable? We've shown that it is profitable, and we've shown it in an EV-based car sharing business. It is generally a much more expensive business to run. It is a different type of vehicle, but it is definitely also the future. So we are looking ahead for the coming month, but also coming years in our growth plans. Very simple. Green mobility, naturally, it is 100% green. We are using entirely zero-emission vehicles, only EVs. It has to be that, and it will continue to stay like that. We might use different types of vehicles, but always zero-emission vehicles. The solution we have is app-based. Naturally, that's the only way we do it today. And you can access all the features there. Our emphasis is to keep it very simple. So the focus is that you can get your mobility on demand wherever you are. Has to be very simple to use the app, but also very simple to use the car. The emphasis should not be on complexity or a lot of features, but rather to get you where you want to go quite quickly. To most people, I think it's more about where you want to go rather than how you want to go, especially on short trips within the city. We also have what we call designated hotspots. I think this is a unique part for green mobility as well, that when you are using a car sharing service, you will still need to park the car, even though the parking is included in the price. But finding a parking spot quickly is of the essence. You don't want to spend time, regardless of the vehicle, but also you don't want to spend unnecessarily time when you're paying for it. So we have reserved parking in specific spots around the city, strategically located, to ensure that you can always get to the restaurant on time, to the theater, or wherever you're going, friends and family, so on. It is about speed, but also convenience. So you don't have to worry about how you get there, just go where you want to go. The heart of the company, as I see it, is our back office, our team that handles the fleet 24/7, year-round. We are always driving. You can use the vehicle 2 a.m. Saturday night, so of course we are available as well. We have a very strong backbone that connects with the cars, of course with your app, but customer service that you can call and ask questions, I think this is a very strong point. There's always someone you can reach out to. Car sharing is still new to many people. So again, having this ease of use where you can always reach out. Data, of course, is also an important part of our business. We do gather a lot of data, but this is how we develop the business. Based on the data, we can continuously improve the company. And this is something we do in-house. We have our own tech department who, based on the data, of course, input from our customers, can continue to not only develop products, but also different combinations, new types of mobility services that will be needed. At the same time, we also use the data to optimize the fleet and to ensure that we have vehicles where it's needed. So an example is that at any given point in the city, Tuesday afternoon, we know the usual need for mobility in that area. So if we don't have any cars there, we can highlight that area with red in our office and in our customer service, so they can choose to dispatch vehicles to this area. So having this balance of the fleet to ensure maximum availability is key to our business. We don't want cars, of course, in places where there's no business. Yeah. Being green, it is part of our name, but also a true core of our company. We like to say we were born green. It's the natural thing for us. I think for all my colleagues in our team, it's just something that is inherent. Maybe don't even think about it. But of course, this is something that is key to what we do. I think it's very key to the society and the cities that we are in. So we work closely with UN Sustainable Development Goals. We have specific actions for goal 11, 12, and 13 that is the ones that are most relevant for what we do. But that we can report directly on actions and results taken on all three of them. Same way, on an ongoing basis, it's part of our ESG program. The most sort of obvious one, of course, is that we have the measure of CO2 saved, but we also look at NOx levels. We look at a lot of other things. We look at noise, and also how can we contribute beyond our own fleet in reducing the emission of greenhouse gases, but also other gases that can impact the society. And a way to measure this, I think for us, in doing this and working with CO2 emissions, it's usually something where for most people it's very big numbers, it's on national level, and to most people this is hard to understand. What can I actually contribute? How will I impact this? What changes can I do in my everyday? So we actually put that down to something that's very specific and concrete, and in an average trip with our cars, you tend to save at about 1 kilo of CO2 emission. And then you can say, okay, what does that actually mean? That's the equivalent of 3 cups of coffee. So the trip to the coffee shop, well, if it's done in a green mobility car, you've offset the emissions that your coffee is putting into the air. So it is about small things. It's small steps that we can do every day for our customers, but it also affects the business and how we can grow. Looking ahead, as I mentioned before, we are operational in 4 cities currently. We have 3 more cities in planning that will be launched this year, but the potential is much, much more. We've proven the business in Copenhagen. We also expect that the business in Aarhus will become profitable within the next 12 months, and after that, of course, the Swedish cities will follow. But in our mind, we've only in the beginning of this. We've proven a profitable business. Now it's about scaling. When we look across Europe, and for now, Europe is our focus because there's enough cities. We have about 160 cities with more than 250,000 inhabitants. So the market opportunities are, well, not endless, but there's a lot of possibilities out there. And I think there's another difference we've seen. When we started 4 years ago, we were looking at cities with 1 million or more. Now we can actually make car sharing operational and profitable with just 250,000, 250,000 inhabitants. So that has also increased the number of cities, increased the market size for us. We are, of course, not the only one. We do have competitors around Europe. We do see other companies, but most are still operating with traditional cars, not entirely EV fleets. And even though it seems all that simple, you can just swap the vehicles, it's not as simple. So we actually do have a competitive advantage. There is a difference in operating traditional cars versus electric cars. And it will take them amount of time to actually catch up on that. And then even when we look at the current competitors, I think to one extent competition is good, but we also have to look at this is still a new industry. To take an example from Copenhagen, we, together with our competitor, operate around 900 shared vehicles, but Copenhagen has 120,000 cars entering the city every day. So this is about building a new market, the future market for mobility in cities. And we see similar numbers if we look at Berlin, Hamburg, and throughout Europe when we compare to the size of the cities. So the market is there. There's been a number of studies made on how shared mobility will grow. So we are quite confident. We are looking ahead. We are ready to grow the business. And the business is essentially very simple. When we go into the new city, we know the cost levels. We can forecast that quite precisely. We know the holding cost of the car, leasing, parking, damages, and so on. So it will have a curve, and this is maybe even not correct, because now we actually expect that the cost level curve will drop in time. Electric cars will drop in price. We've seen that already in the past few years, so the curve will get better. The challenge for us is, of course, to build up revenue, meaning customers, number of trips, and do that fast enough. When we launched 4 years ago, we estimated that it would take us 3 to 5 years to become profitable in a city. Today, we can narrow that down to 2 to 3 years, depending on city size. So we've perfected the business. We've improved time to profitability, and of course now it's still a matter of can we move this marker even further. That we do in some cities where we work actively in partnerships with, it could be an energy company or something else, where there's a marketing corporation that can bring in customers faster. So the business is accelerating, and some of the factors that we see here are, as I mentioned before, electric cars are getting cheaper. More and more OEMs are producing electric cars. Again, when we started, we had maybe 3 cars to choose from. Today, possibly 20. In a few years, 50 or more models to choose from. And at the same time, prices are going down. As we grow in scale, of course, we do have other positive impacts in the business as well. And another part, we're looking at how can we utilize the vehicle. Of course, we see traditional use throughout the day. You go to work in the morning, you go home in the afternoon, you go maybe to a few meetings during the day. That's where the car is typically used. But it could also be used at nighttime when, let's say, private people are not using it. We already have a cooperation in Copenhagen with Volt, delivering meals in the evening, so their staff can use our vehicles at a reduced rate. But it's at a time where we usually don't have the same sort of occupancy in the fleet. So finding ways of having the cars used more. And naturally, with more cities, we have bigger scales. It will have an impact on our buying powers when we sit down with OEMs and need more cars. And ultimately, it also leads to a reduction in investment going into new cities. We've seen that already. We've perfected a lot of things in operations, but also in our platform. And I'm sure that this will be able to be brought down further. When we look ahead, our aspiration, of course, we see that the green focus is creating sustainable mobility for private, but also for shared vehicles, this has had an increased focus with politicians, but it's also a need in our society. We have to have a better environment, which means lower CO2 emissions and fewer private cars in the street. That is something green mobility delivers, and also why we have a clear aspiration of being a leader in shared mobility by 2025. And with this, I conclude my presentation.
Thank you, Anders, for the very interesting presentation. Maybe a few questions from my side. The first one being, as you mentioned, car sharing is still very new to many people, and your biggest competitor is essentially, by and large, private car ownership. Could you talk about some of the cities which have implemented share mobility? Now I'm thinking, for example, Berlin, which have used it for many, many years, and what effect that has on private ownership. You mentioned this, one EV replaces 4 private cars in your PowerPoint, but could you talk more specifically about, what you're seeing when you introduce mobility solutions on sort of the overall effects of transportation?
Sure. You're right, Berlin has been sort of a center for shared mobility for quite some years. But still, if we look at Berlin and compare it to let's say, Copenhagen, the adaptation is more or less the same. Remember that Berlin is probably around 5 times as big as Copenhagen. But it has changed people's sort of habits in an everyday life. I think more and more people are becoming aware of the cost of ownership when you have, especially if you live in or close to the city. That you have to buy the car, whether it's a down payment or you lease it or whatever you do, insurance and so on. When we look at young people today, and Berlin is actually quite a good example of that as well. A few years ago, young people, car ownership was about 28%. Now it's down to about 3%. So whether young people are smarter than my generation, I don't know, but at least they are much more conscious about the other opportunities that are there. And why own a private car when you live in the city? There are so many other things that you can use your money for.
It obviously costs money to grow in such a sort of rapid expanding market. And you did 2 share issues or 2 share emissions last year of around 30 million DKK each, and you're flagging for a new one in the second half. Could you talk a little bit about the share issue which is pending, the size of it, and perhaps even your plans in terms of entering the main listing of the Copenhagen market next year in 2021?
Yes. We did initially expect to transition to the main market in Nasdaq this year, but due to COVID, we chose to postpone it. We simply see that the opportunities for doing that and successfully is better placed for next year. But naturally, as I mentioned, we are a growth company. It will require additional funding to scale the business to much more cities. And it is also an element of timing. We've proven that the business can be profitable, but if we should sort of wait for all cities to become profitable and then go into a new city, we will lose the market entirely. This is a time to market where we see maybe 3 to 4 years. It is about getting out and controlling as many cities as possible. Therefore, we also will require additional capital to continue the growth. And as you point out, we are planning to raise additional capital this year in the manner of somewhere between 50 and 100 million Danish kroner.
That's very clear. And finally, a last question from my side. When we look at the price of using mobility solutions, those have been coming down while you have been initiating new packages to essentially more effectivize your fleets and get more activity in your cars. Could you talk about these packages and how they have perhaps led you to a break-even or even a profit territory in Copenhagen? What type of packages are these in order to more effectively use your cars in Copenhagen?
Sure. I didn't bring a slide on that, but we did In addition to our standard price where you pay by the minute, we also offer different packages. Historically, we've done that for a day or 24 hours, but before summer we introduced several new packages where you can have the car for 2, 3, or even up to 7 days. This was actually some we saw from based on our data, as I mentioned before, but also specific requests from some customer groups. And at the same time, we also saw that typically in the weekends and when you have national holidays, summertime, we tend to have a drop in our usage because people simply went out of the city. But this was still people who didn't own a car, so why shouldn't they be able to bring a green mobility? So we introduced the new packages to the market, and we've seen a very successful uptake in that, where people have taking the car out for a week or a couple of days or whatever. Naturally, this impacts the average price. I mean, if you have a car for a full 7 days at a fixed rate, then the average minute price will drop. But on the other side, we see usage of the fleet. We see new customers coming in and different types of usage of the fleet. So all in all, it's a very positive thing.
Super. Thank you, Anders, for being with us today, the first time you're joining this seminar. I wish everyone who's listening a very good day from my side. And thank you, Anders, once again.
Thank you, Laurits.
Hello, everybody. We're currently online with Kim Millman, CEO of Concordia Maritime, a leading product tanker and crude tanker company. Concordia today will be presented by Kim, and he will go through his slides now.
Okay, thank you very much. I hope everybody both hears me and see me. Thanks for the invitation. And after a turbulent year, this year, which has not in any ways finished, we again hope to be able to heave the anchor towards the end of the year and sail into much better markets. Now again, I'll get back to that. I will be focusing quite a bit on the market, tanker market as it is. Next slide. Okay, just some key facts about Concordia Maritime, international tanker shipping company, 12 product tankers, 1 crude tanker, and we're part of the Stena Group. They own 52% of the shares, and we're part of their established pools and commercial operation. And we've been listed in Stockholm since 1984. Next page, please. Page number 3. Our business model is, in a way, simple. It is daily operation of tankers. You either go on the spot market or you're exposed to the spot market, or you can go on various contract forms, time charter or consecutive voyages. But the important thing is, of course, that you buy the right ships at the right time, and when the opportunity arises, you sell vessels as well. That's part of the business model. Next slide is slide number 4. Tanker industry. Where in the tanker industry are we? From crude oil to consumption. Well, you dig for crude oil out in the ocean and on land, and you transport that crude oil with big VLCCs and Suezmax tankers and Aframax tankers, so-called crude oil tankers. And you put it into a refinery and you make various products out of it, and then you transport those products with product tankers. And on the consumption side, you can see that still some 70% of the oil consumption is for transportation. Next slide, please. Slide 5 is just a picture of our fleet, the 10 P-Max product tankers and the 2 IMO2 class product tankers, and 1 crude oil tanker as of today. Next slide, slide 6, is just the first half in 2020. In short, it's been a strange year in spite of the fact that we've had Corona effects. We have made profits, but for different reasons, and I'll come back to that in a while. So we made some nearly 60 million kronor first half, and we have total assets of 3.5 billion and NAV per share at 19.6 Swedish krona. Next slide, please, i.e. slide number 7. A few months ago, we were at Haymarket, and we were all there at the time, and that was in December last year, at a similar forum. And at that time, I did at that time say that we were in the beginning of the next upturn in tanker shipping. And we had several factors to base that on robust oil demand and balanced inventories and fleet composition, etc., etc. And how did it look? Next page, sorry, page 10. Well, towards the end of the year, the market did shoot up, as we had predicted. Some of us thought it was going to happen a little bit earlier that year, but it did happen in Q4. For all those structural reasons I mentioned on the previous slide. So there were good reasons to believe that this was going to last. However, what we also showed back in December, you always have, even if you have robust arguments for a market going in a certain direction, there are geopolitics or there are unknowns, and we call them wild cards. And of course, page 12, page 13, well, we all know what happened in January, February. And what happened in January, February had a significant impact on consumption of oil. Basically overnight, for the first quarter at least, we the world lost 20-25% in oil consumption, just like that. Next slide, 15, is pointing to another diagram, which is the tanker market. And the tanker market, of course, in the first quarter was affected by the virus. However, in April, May, things started to shoot up very strongly. And that was not because of the COVID, that was because OPEC decided to flood the market with oil, and oil prices went from $70 to $20. And when prices go from $70 to $20, people start to stock up. And that's exactly what they did. People bought a lot of oil in spite of the fact they didn't really need it. But it was good for the tanker market for a short while. Then OPEC, came to the conclusion, we need to cut the production to be more in line with the consumption. And tanker rates fell off. Next slide, 16, is showing the synchronization between oil production and consumption. We know that the consumption went down, the blue line, but the red line shows that the production was kept up. And if you continue to produce all that oil and it's not needed, you're going to put it up in stocks. And that is a stockpile we have now. But you can also see on the slide that the blue line is starting to go up again. So the consumption is coming back and have come back since May, June, July. And with the production cut from OPEC, we are now consuming more than we're producing. So we are drawing from the stocks, which is good. We need to be doing that to clear that overhang. But it hurts right now, but that's the way it is. So simply put, next slide, 17, when oil companies are stocking up, they need a lot of transportation and rates go up, and vice versa when it goes down. And they can draw from their own stocks, which is necessary, and that's what they are doing now, which is why the market is very low at the moment. Let's call it challenging. It's very low at the moment in third quarter and fourth quarter. We said it all along, this will have to be a natural response to that stock building earlier in the year. But we need to clear that, and we need to clear that overhang. And that takes us into our focus on the tanker market going into 2021, where obviously we're not any different to any other markets. Supply, demand, we need to put that on a scale. And on the demand side, you have lots of various variables that has an effect, of course, on your oil transportation need. There you can see them all listed there. And on the right-hand side, I hope we're all on page 21 now, really. And on the supply side, on the right-hand side, we have to count all the number of ships that's being ordered and how big the scrapping pace is, and to just have a very good picture of what the supply is looking, because that is going to balance the demand side. Okay, next picture, 22. You can see the expectation of the worldwide economic growth. Certainly a big setback in 2020. This is IMF. Is it what wishful thinking? I do not know, but this is IMF's figures that this will rebound during 2021 for all the good reasons that we all know. We expect, not only us, but I mean, most of the analysts, not only have we started the upward trend on oil consumption in 2020, but we expect that to continue. And sometime during 2021, it will be back to pre-COVID-19 levels, which is good. So we're back on track. 2020 will be a lost year in a way, but we're back on track again next year. The right-hand side of the scale, as you saw, is the supply side. Ships. Are there many ships ordered? Well, not so many right now. We have an order book, which is new order compared to existing fleet, which is 6% of the fleet. in August. It has been a lot higher, as you can see, as the picture shows. It's been very much higher. So we are on a historical low when it comes to order book. Next, page 25 is, okay, showing the same thing, but just split out how much is the fleet growing year by year. And for the next year, with some expectations on scrapping, we expect the fleet to grow only a little over 2%. Next slide, 26, is of course you have to have a very humble approach to this, analyze as much as you can, but of course there's so many unknowns and you do not know what will happen. You have things that will, have a positive effect to the market and even accentuate the expectations that we have had or have today, but you also have the downside, of course. You have the biggest one, the second wave of COVID-19, of course. So, but when we put all this together and put it on the back on the same scale, we see a demand growth of 5 to 10%. And very many analysts we have had discussions with over the last 10 days are absolutely in the double-digit figure, because when things recoil and go back and kick back from very lows, then you have the psychological effects on this too. But we have a very steady growth of 5 to 10% against a supply side that is only, as we showed, growing by a couple of percent. Next page is 28. Obviously, that shows our fleet. And this is trying to depict or describe the fact that we have a few contracts during next year, a few time charters, few other contracts. But other than that, 75% of the fleet is towards a spot market. We hope and we believe that that is the right mix as we speak right now, since we are believing in a much better market from next year onwards. We think this is an okay disposition of the fleet. So finishing off, why Concordia Maritime? Well, on the left, I changed page by the way, so I'm at 29 now. I hope everybody's on 29. Thank you. Market recovery process has started. I mean, it's not fake. The oil consumption has started to go up. But due to the high inventories, Q3 and Q4 will be tough. Well, not only will be, Q3, we're almost through with Q3 as we speak. But so that is certainly a tough quarter. We've said it many times before too. And 2021, well, we definitely believe we're back on track and we can put 2020 behind us to a big degree. Concordia, well-functioning operation, right position vessel, small flexibility. We have access to a big sphere in the Stena shipping sphere. And the NAV we have talked about before. So we now again, in a way that we said in December last year, we had good reasons for doing that, but now again we said, well, this fall or this autumn, towards the end of the year and 2021, the restart of the next upturn in tanker shipping. That concludes the presentation. I'm not sure I'm within time or without time, but my presentation is finished anyways. Thank you.
Thank you very much, Kim. Very enlightening presentation. Just a few follow-up questions, if that's possible. Now that you're sort of entering this a bit more challenging period of the market because of the destocking, do you think that you will be going on more long-term time charters? Do you think that you will stay in the spot and sort of try to capitalize on an upturn in 21? What are your thoughts around this?
Well, the bad market has already started, and we've had it since July, and so you don't see too many charters out there. And follow the school book. If the spot market is low, the time charter market is probably low too. So it's not really an ideal time to do long-term time charters today. unless it's very specialized business with a premium being paid for specialized tonnage, and we can justify it from that point of view. Then we would do it. But other than that, not really. I almost would like to flip the coin and say that if there is anything we should be doing over the next 3-4 months, is maybe to add capacity, because we think it's a good opportunity to do that in this low on the market.
And since you're following up on that, are there any ideas you have now currently about creative fleet growth opportunities? What sector would that be in? And do you really think the pricing is great right now? Could it improve? And sort of what is the upside also in asset values, if I can throw in another question there?
Yeah, the prices on the second-hand market, I mean, did go up during 2019, when things started to look better, and have, of course, over the course of this year, gone down, whatever, 5-10%. I don't think that the prices will go down very much further. Is it a good time to buy? Yes, I think it's a good time to buy. On the prices, I think the prices are as good as they get in this low cycle. Do we have any specific plans? Let's call it that we do have plans and ambitions, and following this market very, very closely. And the fact that we've been talking about maybe moving to another stock exchange and things like that, all these things were put on hold during the worst part of the corona. But it's a constant ambition we have, so we're looking into all sorts of things.
And you also said, I think, in our previous quarterly call that you would potentially consider new builds if there was long-term project-based conditions for that. Is that sort of the right way we should be thinking, or should we only focus on secondhand for you guys?
Oh, you're going to get one of these answers. It's a combination of both. Best of both worlds. And new builds, not really, because we do not like to add speculative capacity to the market. Full stop. If you do it against long-term charter, it is a different story. But long-term charter is not 5 years. It's got to be more than that in order to be called long-term. So it's a combination of both. And a new building you won't get in 18 months' time. So you really need something now as well if you want to add your capacity next year.
And since you're talking about the supply function of the fleet right now, the order book is quite low. So do you think, what do you think about your peers? Do you think they're going to order vessels, or do you think that a lot of them are holding back, trying to sort of preserve cash in a way?
I think they're holding back. I hope they're holding back, because we should all be holding back, and not read too much into a very nice figure, 6%, absolutely. But we have had exceptionally high times too. Sometimes I use the expression that, sure, the order book is historically low, but it has been times when it has been hysterically high too.
All right. Thank you very much, Kim. Hopefully everything goes well and you guys are also able to capitalize on these growth opportunities. Thank you for being with us today.
Sure. Thank you. Thank you all.
Hi, and welcome everyone to today's presentation. My name is Stefan Knutsson, and I'm an equity analyst here at ABG Sundal Collier. First of all, I would like to say that the presentation of Bergs Timber will be held at 12 o'clock because of technical issues. But today I have with me Polygiene and the CEO Ulrika Björk. Welcome.
Thank you, Stefan. Hello, my name is Ulrika Björk, and I'm the CEO of Polygiene. I would like to introduce you to the business case of Polygiene and also leave some comments on the quarterly report we launched last week. So Polygiene has a very strong vision that we want to transform clothes from consumables to durables. The textile industry, where we operate, is one of the hardest polluting industries in the world. Only the gas and oil sector are worse. But there is a positive thing, though. It is that everybody, you and me included, we can actually make a difference. By changing our behavior, we can actually contribute to make a more sustainable textile industry. I will start to share a slide with you, and this is from a recent launched report. It is made by McKinsey in partnership with the Global Fashion Agenda. And the purpose with this report is to show how and where the potential areas to reduce the greenhouse gas emissions that was agreed in the Paris Agreement a couple of years ago. And you see the blue color here, 61%, shows that the potential are biggest in the upstream production. And that means when you're manufacturing the garments. And that could be everything from using renewable energies to using a more green chemicals, and also in transport and packaging. And then we have the yellow, 18%. It comes from the brands. They can actually make a huge impact by choosing the right materials, how they operate the retails, and also packaging, transport. But the biggest, absolute biggest potential is in how they control the overproduction. And then we have the red area, 21%. And then actually the potential where the end consumer can contribute. And this is the area where Polygiene is working. Before I go into the offer we have to the market, I would like to take you on a small journey to recap some highlights of Polygiene's history. So the reason why we exist is actually because of the outbreak of SARS back in 2004. The demand for antimicrobial treatments were growing rapidly, and at Perstorp Group, they invented a product that was shown to be very efficient against bacteria, viruses, and other microbes. And Polygiene was a spin-off from this company and was founded in 2006. And the name Polygiene is actually a mix of the two words polymer and hygiene. So we started out in the healthcare sector, treating mainly hard surfaces. But in 2008, the sport and outdoor industry approached us to ask if this was efficient in textiles too. And test shows that it was very efficient to take care of bacteria and prevent odor in textiles. In 2012 and 13, we had a major breakthrough. The world-leading brands as Adidas and Patagonia signed up with us and opened the door in this segment. And in 2015, the former board decided to raise external capital to build the ingredient brand Polygiene around these technologies. So in 2016, we were listed at Nasdaq First North, and we also entered some new segments like home textiles and lifestyle. And in 2018, there were major changes in the company. The board decided to change the position of the company to focus more on sustainability. And I was appointed as a new CEO in January. And what we did was to build up a new organization, revise the sales and marketing strategies, and we also took a decision to focus more on innovation and product development. And in 2019, we could launch our second product, Odor Crunch. That is a non-biocide product, award-winning. And we also decided to established some subsidiaries in China, in Shanghai and Hong Kong, to expand further. And now we are in 2020, and we launched another successful product, Viraloff, that is an antiviral treatment. And I will come back and talk a little bit more about that later on. So what is the Polygiene brand offer? It consists of 3 parts. It's the technical part, that is the function itself, the chemical. Then we have the marketing part that is very important for us, as it's very important to communicate the functionality to the end consumer to be able to change their behavior. And then the third part is the service and support we provide. Polygiene is a reliable and trustable partner in every sense. So I will go further into these 3 areas. And first is the technologies. As I said, we have 3 products now. It's the Stays Fresh that we've been working on since the beginning. And that is a product that prevents bacteria to grow, meaning you can actually create a textile that don't stink. And then we have the Odor Crunch, that is a non-biocide. And apart from Stays Fresh, this one will have the bacteria. You will have initially an odor, but the product absorbs the odor molecules and break them down to something your nose can't sense. And to combine these 2 products is actually to create a premium odor-free product, where Stays Fresh can take care of the bacteria growth and odor coming from inside, and Odor Crunch can absorb odors coming from the outside, like cooking fumes, like cigarette smokes, and other odors. And then we have the Viraloff that was launched actually 5 months ago today, the 7th April, and it's been a huge success. And we had a lot of attention around the world. And today I'm very happy to announce, we did a press release this morning, that we can now prove that Viraloff is efficient against the new coronavirus, the SARS-CoV-2. And we are the first company in the world who have tested against the ISO standard. And that's a huge breaking news, even if we knew since the beginning that it will work, because we tested on SARS-CoV-1 back in 2004, and we also tested against the surrogates, and that was working fine too. But it's really good to have it on paper to actually show the efficiency. So how does the product go into the fabric? This is a very simple schedule of how the process, how you produce a T-shirt. And in this green fabric processing stage, Polygiene's product is applied. And we use existing water baths, so there is no extra cost on the environment or for the brands. So it's a very simple and straightforward method to get the application on. And this is the 5 segments we are operating in. We have the sports and outdoor, that's still the biggest one. But we are growing in home textile, we are growing in lifestyle. And lifestyle fashion is everyday clothing, and the potential are huge in this area. And then we have footwear that add enormous value for the end consumer, but it's more challenging to get into the value chain. That's why I'm very happy and proud that we could announce the partnership with Dr. Scholl, who is one of the leading in technical insoles last week. And then we have workwear that we broke out from lifestyle because it's like 2 different kind of customers. So this is the segments we're working in. This is just to show some of the brands we are working in the different regions. And now to the marketing support. And this one is very important for us. This is actually what differentiates us from the competition. We support the brand partner, we add a value to them because they need to communicate this function to the end consumer to get them understand what they are buying and what is the benefits. So we help them with labeling, hang tags. We make sure that the hang tags are correct and compliant in all regions. We help them with digital sell-through campaigns to show them that you can sell more with adding this value. We can also support them in retail stores when we can help them with the POS material to actually communicate this. We can also provide them with in-depth studies and marketing service we made. We can show them that the end consumer appreciate and values this functionality and actually are willing to pay more if you communicate it. So to the left, you have a T-shirt retailing 25 without Polygiene. And then if you add this function and communicate it and put a hang tag on, then our research shown that the customer is willing to pay up to 50% more, sometimes even more in other segments. And this is great value for the brands when they need to decide or not to go for this. We also built a concept regarding wear more and wash less. And this is a tagline we have to show the end consumer what is the benefit with buying a Polygiene-treated garment. So to summarize the positive life cycle of a Polygiene-treated garment. If you have a Polygiene-treated garment, it will protect your garment from viruses and bacteria. That means that the garment will stay fresh and odor-free. And you can wear it more and wash less. And washing less actually helps to reduce the amount of microplastics going out to the ocean, which is a huge problem. And you will save enormous amount of water and energy. So this will extend the lifetime of the garment. And a fresh garment can also be sold again at the second-hand market. And the biggest impact is that you prolong the time until the new purchase of a newly produced garment. So that is the biggest saving. So Polygiene could provide conditions that enables a more sustainable textile industry. And the third part of our offer is the global support team around the world. We have a global network working for us. And as you can see, the orange circles, it's the Polygiene team. We are 26 people, 20 if you count them full-time. And they are strategically located where our customers are located and also where the production is. And the blue dots, it's the agent network. We work with commission-based agents in these regions where we don't have our own staff. And the black circles is the distributors who actually, they make sure that the product, the chemical, is in place when the production will be. And this network is supporting the whole business model. This is a very simplified model just to show how we operate. So we buy chemical from a supplier in Europe. We ship it to the distributor for stocking it to be ready to send out just in time. Then they will get orders from the mills. A mill is a fabric manufacturer, or it could be a vendor or a garment maker. They apply the additive on the fabric and put the hang tags on. And then the products are sent to the brand to be sold retail or in online. And after the end consumer will buy this product. And Polygiene supports all the way. And we are not happy until the end consumer understands the benefits and wear more and wash less and change their behavior. Moving into the Q2, just very quick a recap. It's been all about viral off, of course, since we have an ongoing pandemic. We started out by treating face masks and scrubs and medical protection clothes, but soon we found new areas. And for instance, this collaboration with Milano Colori, who is the Italian consortium, they will make aftercare spray to spray on textiles after it's made. And this is very exciting for us because they will sell this globally through pharmacies, through other resellers like other brands, etc. And they haven't started yet, but I know it's ongoing because they are marketing very heavily now. This is another collaboration that is really interesting for us. We partner up with Diesel, and they want to launch a collection with virus-free jeans together with Odor Crunch. And I hope the production will be soon, because these are going to the market next year. And we got so much attention globally on this collaboration, so we actually made it to Good Morning America, where my colleague was interviewed. And this is another interesting Italian collaboration, Marsotto, who will offer viral off on all their textiles to their premium customers. And just a small comment on the quarterly report. This is just a graph over the sales development the past 7 years. As you can see, we have a little bit slower on the first half of the year, and we have more sales on the autumn. And here are some quick highlights. The net sales growth by 37%. The first half year, 18%. And I'm really satisfied with that, since we have this ongoing pandemic. We've been in lockdown. Many of our customers are suffering a lot. They actually skipped some collections because of the overstock that is built up in the world now. Gross margin around 70, which is good. External expenses decreased by 18%, mainly due to canceled trade shows and also less traveling. And we have operating EBIT on minus 1.1. Compared to last year, it's a huge improvement. And the cash flow was unchanged in the quarter. And the last slide is just to comment on the share. We are listed at First North. We have 20.5 million shares out there. And the price, I think I need to revise this one, because today we hit the all-time high this morning. So I think it was almost 29. And the owners are growing with us. We have almost doubled since last year, which is very, very, very nice. And we have a certified advisor with Erik Penser Bank. And thank you for listening. And I think we will have some questions now.
Yes, thank you, Ulrika. And my first question is regarding the viral off. You launched it in April, which was very quick following the pandemic. How come that you were so quick to market with this brand?
It's because of our history. We had this knowledge within the company. And as I said, we actually exist because of the former SARS epidemic that it was. So we just dig into all the test data. We did some new testing and decided to launch it as a new trademark, viral off.
And obviously, the short-term demand has been very high.
Yes.
But how do you view the long-term demand for a product like this?
I see this is absolutely here to stay. Antiviral treatments will be growing. I saw research made in April that they predict the market for antiviral finishes in textiles will grow from $10 to $20 billion just in 5 years. And that is due to this pandemic. So the awareness is bigger than ever for this kind of functionality.
And do you think that it will affect your other business as well, like awareness of what you're doing or something like that?
I think that will also, that's included in the antimicrobial market. And as I showed you on this new McKinsey report, shows that we need to do something to change the consumer's behavior. And this is the product who can actually do it. So I think that will also grow for us.
And you mentioned that you are in a couple of different segments and that your material is applied in the middle. But how do you charge your customers for the product?
Our customers is mainly the brands, the end brand. And we have different business models depending on what kind of product. So we can charge per treated yard, we can charge per piece or per kilo. It depends a little bit of what kind of product. And we also have the price consists of actually 3 parts. It's the additive itself, and it's the right to use the brand name, the license cost. And then we have for hang tags. And this is, we mix together and present one price for the brand. But it consists of all these 3 things.
Okay, and then also on your core business, the Stays Fresh and the Odor Crunch, you mentioned that you had seen some short-term negative effect because of cancelled cancellations.
Yes.
But how do you view the long-term demand after the COVID-19 pandemic?
I think this is temporary. And we saw it in Q2. We had major customers that actually just skipped one collection. We see that some of them are picking up in Q3, but I want to be a bit reluctant to see how long this effect will be. But I am sure in 2021 this will be over, because then they need to restock and they need to produce again. So I think this is very temporary.
And obviously it's been, I can imagine, a hectic time here for you the last couple of months. What will be your main focus now to go to the end of the year?
It's still quite chaotic. We have still a lot of inquiries, and I think with this test result today, I think it will increase even more. But for myself, I will focus on building this new management team that I just appointed 2 new people to work on developing the company, and then the regions just concentrate on doing business.
Okay, Ulrika, thank you for today's presentation.
Thank you. Thank you.
Welcome back to the ABG Investor Days. We now have the pleasure to welcome Håkan Lagerberg, CEO of Swedencare, to the stage. The floor is yours.
Thank you so much. Yes, my name is Håkan Lagerberg, and I'm the CEO of Swedencare. We are a small company in the pet health sector, and we work with different brands. We have one priority brand for us, at the moment at least, is ProDen PlaqueOff, an oral care product. Then we have NutriScience, a wide selection of nutraceuticals, and recently we acquired a company in the US called Stratford, so with also a good, well-known brand, but they also work in the private label sector. We have exports to over 50 countries. We have our own smaller sales offices in 8 different countries, and we have had strong growth the last, let's say, 10 years, and specifically since 2014, when we made a new business plan to be a bit more active. I also joined the company in 2014. In 2016, we went public to Nasdaq First North and have had let's say well-received years there from the stock market, and also we've been growing the company with good profit. We are 62 people all over the world, and we sell products for dogs, cats, and horses. We have one production facility in Ireland, southern part of Ireland, in Waterford, where we produce different nutraceuticals, and we also have some collaborations in the pet food business. Pets have had a strong, the pet market as such has had a strong growth the last 10 to 20 years. More and more pets all over the world, in both cats and dogs, but primarily dogs 10 years ago, and then cats the recent 5 years. And the big difference why people spend more and more money on their pets is that they are really treated as a family member. And of course, family members you want to take good care of. So that has increased the spending of more let's say, exclusive pet food, but also in the line where we are in primarily pet nutraceuticals. Is of course that the better you take care of your dog and cat, the longer they live, and you get lots of age-related problems that you want to take care of. And our main product, ProDen PlaqueOff, is in the dental care sector, and specifically for dogs, it's a really big issue to have a product that can help you with the famous dog breath. People live very close with their dogs now and even sleep with them, so really a bad breath gets a bit annoying, and people really look all over the world to find a good product for that, and lucky for us, we have an excellent product. The market as such, Europe and the US are fairly equal when it comes to number of dogs and cats, but the spending is quite different. In the US, they spend an average $1,200 per pet, and in Europe, 600 euros. So it's nearly double, perhaps a bit less now with the weaker dollar. Markets that grows in the world, I would say now with this COVID year, there's been a lack of dogs and cats basically everywhere. So the market is definitely growing this year in all markets. But Asia, primarily China, is a double-digit growth market in number of pets and also spending. So and we try to cover the most important markets. US is definitely our biggest market now after our Stratford acquisition. Europe is really important for us, and Asia has been the growth factor these last 3 to 4 years, but the US is also really strong. Other markets that are interesting but not so strong for us is Russia and Brazil. They are really big pet markets. Company timeline started off early 1990s when a dentist/scientist discovered that a specific algae called Ascophyllum nodosum has an effect on plaque formation and tartar buildup. He met a guy in mid-90s, and they started thinking of business ideas. So they presented a product for humans that in a tablet form that you should take every day and get rid of the plaque formation. And they sold it fairly successfully in the early 2000s. But they went over to producing a product for dogs. It was quite by accident. They just tried it on their own dogs and saw that it had a tremendous effect. And the reason why it has more effect on dogs than humans is very easy. Most humans brush their teeth twice a day, and definitely most dog owners, they don't brush their dog's teeth, even though the veterinarians tells you to do it. But early 2000, even the veterinarians didn't say that much about it then. But they started selling a powder product, going out in the world with exclusive distributors. They found the early ones was a guy in UK, one in France, and one in US. So those were the first markets in the world. And interestingly enough, they still are part of the Swedencare group. At that point of time, they were individual entrepreneurs building up a business. But in early 2016, prior to our IPO, we acquired them. And they are still hanging in there and developing their markets, quite different from early or mid 2000 or 2010. But that's the way our company is set up. We're a bunch of entrepreneurs, very fast-moving company, and really down to every individual of our 62 people. They know what they're doing, and we're very focused in growing the business. When we made the IPO, we did it not that we really needed the money for growing the ProDen PlaqueOff line, but we wanted to widen the offering and also take part of the consolidation in the pet business. And so in 2016, November, we bought the Irish company with a production facility called NutriScience. And after that, we've been growing either by acquisition. Last year, we bought a Greek company, our distributor in Greece. But we have also started up our own sales offices without buying a company, as we did in Spain the last year as well. Let's say a big game changer was this year when we bought Stratford, because it's a fairly big acquisition for us. 2019, they had a turnover of a bit over $7 million. So the US market now will be definitely the biggest market for us. And also they have why they were so interesting for us was their channel into the vet market in the US. The strength of Swedencare, as I said, the pet business has been growing basically all over the world. So most companies, at least if they are fairly well run, have had growth and fairly good results as well, profits. But Swedencare has, outperformed the market in talking about growth, and we also in a high tier of when it comes down to EBITDA and EBIT, because we managed to be very agile. We are very, let's say, focused organization, not much red tape, and we are more, let's say, not specialists. Everyone in the company is working within different areas. We also have very loyal customers. We have products that the pet owners love, so they keep on buying them, and they also recommend it to other people. Now, these last 3-4 years, we've been focusing a lot more than we used to before on marketing, specifically in social media, online campaigns, but still it's low numbers if we compare with the big players we are competing with. So it's still very much a success story with loyal and happy customers recommending our products. We sell in the veterinary channel, the pet retail channel, and also in some retail chains, more high-end premium chains in some markets. We're also fairly unique in having a global reach. We sell our products, as I said, in 50 countries. It's not that easy to cover all these markets, but we are also as I said, we're very active in following up and working together with our distributors and customers. So it's really a winning concept that people, our customers, so they really appreciate our efforts. We're always fast moving, getting back with answers if they have any questions. So it's really, we get lots of feedback from our customers out in the world that they enjoy working with us. This a bit more of our lead product or lead brand, ProDen PlaqueOff. It's a powder-based product. Primarily, we have it in 3 different sizes. We have a special cat product. It's a bit more appealing to the cats because they are a bit finicky. It's a 100% natural product from a certain species of algae. We have a certain species or certain way of harvesting it together with our partner. We harvest it in a particular period of time of year. We also have a special way of drying the product, and because I often get questions about the next line is that we have a patent. We have a patent in 30 countries. We sell it in 50 countries. The patent runs out next year, so I often get questions about that. And what I tell them is that our producer, we have an exclusive agreement with them. We have together with them developed a special kind of producing this product, so we know that our product is superior to competitors. We've seen it in markets where we don't have a patent, and that's also important why we do clinicals. Clinicals in the pet sector is not that complicated and costly, but we do it to prove that our product is really good and working. So we keep on doing that for our different kinds of products in this ProDen PlaqueOff series. So now we have a special brand, as you see here, called VOHC, Veterinary Oral Health Council. It's a sign you can use if you have produced 2 different clinicals where it shows a good effect compared to the placebo. And we have it now for the powder product for dogs. We are just wrapping up a study for the cat product. We have it for our dental bites, more of a treat product, and I wouldn't be surprised if we start a clinical with our dental bones that we have launched in several countries now with great success. So we are really trying to appeal to the pet owner, finding a product that suits them to get the ProDen PlaqueOff effect. So we have a powder product, a bit more, let's say, a bit more complicated. You have to give it every day, you sprinkle it over the food compared to giving not complicated, but I would say it's a bit more thrilling to give a nice chew bone to your dog because they really appreciate that compared to the ordinary food. But still, we try to find different ways of administering, and we have new products with new products to be offered in this line. As I said, we have a wider selection of nutraceuticals for both cats, dogs, and horses, and those are for different problems that a pet can have. And so it's the classical ones, joints and mobility, of course, especially dogs, when they get older, they have problems with their joints. Skin and coat is a big issue as well, and with the Stratford acquisition, we got a whole line of dermatology products, special shampoos and grooming products. That's a really big sector where we haven't been before. Also, different multivitamin supplements and the calming supplements. We have a very, very strong position in the calming products. It could be for fireworks, New Year's Eve, and whenever you have that, you can have it. You can take it when you travel with your pet, etc. With the equine range, we are primarily focusing with the equine range on a couple of markets. It's the UK market, it's the German market, and we've launched it in the Nordic market. It will probably be launched in a couple of more markets, but the equine sector is a bit more complicated to get in. What we do have with pet food, we don't have our own pet food, but we have collaborations with currently with 2 brands. We will launch a 3rd one end of this year or early next year. but it's where you have the protein plaque off as an active ingredient in the dog food or the cat food. So you get the daily dosage with the administering the normal food. And that's an area where we will definitely grow and have lots of contacts. The unfortunate is that those kind of projects take time, but we will launch a couple of more in the coming year. Stratford Care, as I said, very important acquisition for us, changing our setup. It's a company that reaches out to over 10,000 veterinary clinics. And if we look at the US market, that's the one market where we have been a bit different. We have 85% of our sales in the US with the pet specialty retailers, and 15% in veterinarian sector. If you compare to Europe, we are basically 50-50. So it's really a good acquisition for us to get the ProDen PlaqueOff brand out to the veterinarians in the US. They have had a strong growth as Swedencare, and we expect them to also improve in their margins. They have a bit lower margins than we, around 20%, but they will pick up now when selling the ProDen PlaqueOff line as well. Sales per region, this first half year, not that much different between 2019 and 20. But going forward, there will be a big difference. You see here that the North America is 29%. That will be a lot higher the coming quarter with the Stratford acquisition. Sales per product, very heavy in the brand ProDen PlaqueOff. 83% of our sales is related to ProDen PlaqueOff this first half year. That will also change, of course, since the product setup in Stratford is without ProDen PlaqueOff. So that will be, I would guess, more 50-60% of the ProDen PlaqueOff next quarter. Highlights, the acquisition, and the effect of COVID. I've got lots of questions about that. We felt it in as early in February in the Chinese market, and then of course in March and April, and a bit going into May. But June was really strong, and as I've said in some other presentations and the half-year report, that the trend is that July and going forward is strong. So we feel that we probably won't have more effects from the COVID-19 not affecting our business in a negative way. Going forward next year and the years to come, there will of course be positive effects due to the increase of number of pets. Online growth, we of course this COVID half year spiked the online growth. So Chewy.com in the US market is our biggest customer. Amazon, which we've recently started collaboration with in Europe, also growing a lot this half year, and we see that it will continue to grow. We had a turnover of nearly 70 million Swedish kronor first half year, with a profit margin of EBIT of 23.4. Would have been a bit higher if we would deduct the cost for the Stratford acquisition, but we have a not that strong growth this half year, but that was a bit set off with the COVID, but we see that the second half year will be a lot stronger. Share price has been strong since our IPO. We were introduced at 14 kronos, never traded under that, and now we're trading around 150. Very strong interest from the institutional sector. So we have institutional owners from Scandinavia, France, Germany, US, and that continues. And I think it's twofold. That the sector, pet health sector, is interesting, and there's not that many companies being listed all over the world. And of course, the most important is that we have performed really well and continue to do so. Prior to us in 2020 is really just accelerating the growth with good EBIT margins. North America, of course, will be a very important market for us going forward. We will increase the marketing. We see that we get good return on building the brand. We hired a new marketing director this year, early this year, and she and her team is really doing a good job, and we're rebranding some of the products and also focusing more how we present ourselves. And if we say different market, China is an important market. It's a bit slower first half year, but that will also come back, and China is still one of the fastest growing markets in the world. And we will look at new, let's say, acquisition possibilities, since we now see that there's lots of interest for companies joining Swedencare. We get more and more contacts, more without really looking, and we will evaluate every prospect. But we're kind of picky, so that's why we really haven't done that many acquisitions. But it's possible that it can be others. And we set our targets: 500 million in turnover in 2024 with a 25% EBIT margin. Now we put a new stamp on it to be reviewed. We will be discussing this in the board next quarter. So my guess is that it will be revised.
Thank you for that presentation. So a few questions from me. First of all, you're kind of touching on that in the presentation about the long-term aftermath of COVID-19. Can you go in a bit more detail about that, what you've seen?
I mean, there are basically no adoption dogs that are available now, and also, of course, it takes some time for breeders to speed up to the demand. But I mean, definitely more dogs and cats, and we see that difficult to say already what kind of percentage, but I would say that we were expecting, let's say, a couple of percentage increase, as I would say, in the US and European market, but that I would say that it's definitely will be above 5% next year. I mean, for the market as such.
Yeah.
So it's a strong growth.
That makes sense. So, looking at your production capacity, we were also touching on that in the presentation. So how much capacity do you have today, and how does the Stratford acquisition affect that?
I wouldn't say the production capacity is really it's not an issue for us. It has been with some let's say in the COVID we had to adapt a bit, and some of our partners and also our own production went down to perhaps working 3 days a week, but that is back to normal now. And also for us, with our own production facility, we work one shift, so it's easy for us to ramp up there. And basically all of our partners as well have a lot more capacity. But we have seen specifically in the US market is that we need to be more focused, and also with Stratford having, let's say, big volume sales for some products, is that the lead time is a bit longer. So we have to adapt to that and be more focused on planning with the logistics and the buying of the product. So it's a couple of weeks longer lead time perhaps, but we just have to adapt to that, and we solve it.
Yeah, that makes sense. So let's talk a bit about M&A. And first of all, I want to touch into a bit more about Stratford. So can you tell us a bit about the backstory there and the synergies that you plan to win out of it?
Absolutely. Yeah. The story is that we really tried to buy them nearly 3 years ago, and we lost to another player. But I kept in contact with the CEO because it really was the acquisition that I thought was the most interesting for Swedencare. When overall we've been looking for over this last 5 years, I would say. And the big reason for that is of course the management team, very good, and but primarily the concept that they have selling to veterinarians is that they offer some way of to some of their customers, they offer private label, so that a single veterinary clinic can actually sell a product called Dr. Bob's Special Formula for Joints, for example. And that's the reason and why veterinarians like that is, of course, that they don't want to have the competition from Chewy and Amazon with exactly the same product. So it's really a way of handling that a bit. And then also just the competence that they have with large buying groups for these veterinarians. In the US, there are lots of, let's say, independent veterinarians that go together, let's say, 50 or 100 clinics that go to, so they join together to be able to buy up, let's say, to better prices, but also for the single clinic not having to look at different products all the time. And Stratford has a very good organization for selling to those kind of customers.
All right, thanks. So the last question from me.
And sorry, I must say also that we were lacking the reach to ProDen PlaqueOff, the ProDen PlaqueOff brand to the veterinarians in the US.
Yeah.
So and they actually made a pre-marketing in Stratford these last weeks, because they have just received the first products, but they have never introduced a product and a product brand and having that much interest as with the ProDen PlaqueOff brand. So I expect a lot from Stratford sales in ProDen PlaqueOff as well.
Yeah, that makes sense. So again, last question from me. So on Friday, you will you will hold an extra AGM regarding the ability to issue new shares, essentially. So how would you describe the M&A strategy going forward? Is there anything extra interesting?
I would say that, as I said, we have received more interest than in the market, and of course we want to be able to act agile if an opportunity arises. So that's why we want to have this this authority for the board's perspective. But I mean, we're still picky. So what we're looking for is really companies that would fit into our way of working. And if you look at markets, I would say we are primarily looking at targets in the US and Europe.
Thank you. So with that, our time is up, and we thank Håkan for his presentation. Thank you.
Thank you.
Good morning and welcome to this presentation with Bergs Timber. My name is Øystein Lodgaard and I'm the analyst at ABG covering Bergs Timber. Now allow me to introduce Peter Nilsson, CEO, and Anders Marklund, CFO. The floor is yours.
Thank you very much and welcome to Bergs Timber. We are going to make this presentation and I will start and then Anders will take the last part of the presentation. So please, if you can change to slide number 2. Bergs Timber is born out of the forest in the southeast Sweden actually, and has been a sawmilling company for many years. It's actually a bit more than 100 years. And has been very much focused on the sawmilling and with good results, but the last, I would say, 15 years with quite a bumpy situation and quite hard at times. And during the last years, we have started to change the company into more, as we call it, further processed timber, but still with the forest products as base and of course lumber. The change has been fairly big. I mean, it is a growth from 500-600 million SEK revenue up to a bit more than 3 billion in 3-4 years. So it's, of course, it has been a fast growth, and it has we had a big need of evaluating the strategy going forward, taking the next steps. So we made quite a big job in the autumn and winter with the management and board to look at what directions are we aiming. And it ended up with this strategic agenda with the main strategies of growth in the further processing. We'll come to that later. Routines and increased cost reductions that we have been working hard the last 6 to 12 months to get on top of everything, and of course to form new follow-up systems and etc. etc. And there we have come quite far, and we are more or less ready for the next steps. And then of course we see big potential with sustainability in this company, and as you know, we are based on the forest raw material, and we have lots of advantages in the long run, especially. So we have formed a sustainability program as well, which we will be back later in this presentation. And then the brand, and there we have taken some steps, but we have more to do in that direction. And then here it's very important to tell you that everything we do in our business is very much based on decentralized organization and structure. So that also has impact on how we brand the company in the end. But then we had the fourth sort of area that we have been working, I would say, the most during the autumn, winter, and spring, and that is to develop our current strategy. And we have sawmills in the Baltics, in Latvia, and also in Estonia. And in Latvia, we have a big mill which is really advanced, and it is very sufficient. It's delivering good results since at least 15 years. So there we see a potential to develop further and to continue to make good results. We have a smaller mill in Estonia, which is partly it is feeding our further processing company in Latvia with raw materials. So that has also a strategical strong position in our company going forward. But Then we have been evaluating the Swedish sawmilling structure, and going back 2 years, we had 5 sawmills, and then we closed 1 down. And then we have been evaluating what to do with the rest. And of course, we could see some strong potential going forward, but it also with a big need of investments and further development, and which was a possibility, but at the same time quite, I will not call it dangerous, but quite a big thing to do, because it would take a lot of resources, investments, and even other resources management, etc. There we would like to put these resources in to grow the further processing. And then we have discussed it, and we could see that it was not ideal and maybe not even realistic to grow the both areas in Bergs going forward. And also, again, very risky. And there I would also like to mention that it is quite a tight raw material situation, and between, I would even name Södra and Vida. And so in the end, we decided that ideally we could actually divest these companies, these sawmills, which we now have made. We have made the deal, and actually we have also closed it. So we have, from 1st of September, we left the Swedish sawmills to Vida, and I will be back a little bit more with that later on. So this is the strategic agenda which we are working with, and of course it is with the aim to increase shareholders' value. That's what it's all about. Then I would like to change to the next slide, which is here you can see our on the map where we are located, and it's Sweden, UK, Estonia and Latvia. And in total, after the divesting of the Swedish sawmills, we are 850 people, employees, with about 50 in Sweden and 50 in UK. So the Baltics, and especially Latvia, that's a big part of our business as is today. If we then look at important events so far, 2020, it is of course the divestment of the Swedish sawmills, which we mentioned. And that gives us a completely new balance sheet and actually a lot of room for maneuvers going forward. So the company will be in a completely different situation with a lot of opportunities for the future, and then it's how we use them, but that's the next steps. We have started Woodworks by Bergs, which is like a startup company, but with the aim to sell our products in Sweden, which is further processed, doors, windows, etc., with a focus to sell it to end consumers and projects. So it's not for the builders, merchant, DIY chains. It's more direct sales, which is very encouraging, and we are learning a lot, but we are getting increasingly optimistic how this could develop. We have made an organization review, and then of course it's COVID-19 handling, which it's on everyone's agenda, whatever we are doing, but the main thing of course is safety, health for our employees, and as we all know, it was a lot of uncertainties in the beginning of this outburst, and we were traveling a lot Jan, Feb, and then everything stopped, and we we have been staying at home. Now we are staying in our office here in Vimmerby. But we have been able to, we haven't had any major disturbances or illness in our company. But of course, we were also very unsecured about how the market would develop, and we were really afraid of, by the lockdown in the UK and even on other markets, that we will lose a lot of business, and we reduced production in the beginning, especially in April and May. But everything has turned out quite differently from, at least from what we were afraid of in the beginning. So we have had a really good demand on most markets, especially in Sweden, Baltics, US, even Central Europe recently. Maybe with the Japan as one exception, there has been a little bit slowdown, and also part of North Africa, but in general, very good demand. And because of a lot of restrictions in production, sawmilling production, the balance has been really in the favor of the producers. So we have had quite good market and also strong results recently. And it's not only for the sawmilling, it goes for all our products, actually. Then we should change into slide number 5. And then to look at what will happen for the rest of the year. And of course, we are still, as everyone, it's how to handling the COVID situation, and we have concluded that we would, the rest of the year will be more or less in the office and very little traveling. Of course, a bit in Sweden, etc., but we will have to control our companies in the Baltics and UK from by phone, etc. But what we are starting up tomorrow, and that's quite a big strategy process in our company. And that is how to take the next steps for the further processing part of the company. And just to remind you that it is planing for do-it-yourself, it is joinery, which is doors and windows, it's house production, it is wood protection, which is treatment, fire protection, etc. And it's also garden products. It's quite a big package of different products. And it's now how we are going to use this as an advantage on the market, how we're going to invest to have organic growth, and what kind of acquisitions we should target. And then, of course, new goals for the company, including financial goals, and also how to profile the company. So it is an exciting work, and it is, of course, very good timing for, as we have changed so much. Maybe you can say ideally we should have done this before we made the divestment of the Swedish sawmills, but timing is not always ideal. But now this is going to be the main focus for the rest of the year. And we should be able to start to communicate the results by end of the year or beginning next year. Then, of course, things can happen in between. Then we have a few slides, which is more like, I would call it examples of products from Bergs, woodworks, what we're doing. We are quite big into the small houses, as you can see on slide number 6. To the left, it's doors and windows. Number 7, slide number 7, it's one example of our products, garden, furnitures and fencing and houses. Same on slide number 8. Time is flying, and now I leave slide number 9 to Anders.
Thank you. As Peter said, that sustainability is an area of most importance, of course, both for us and many others. And we have done quite a lot of work to establish a sustainability platform for Bergs. We have done that during the winter, and those has been based on the UN goals. And we have defined them in separate sections, and we also have KPIs for those as well. So the next steps for us is actually to implement them in the daily business, which is very important for us to be a bit of the daily work. And one area of sustainability which I think is very important is profitability. And going to the next slide, we can see that we are currently in a very good position, and we have very favorable market conditions for us. And the numbers you are looking at, I would just make a remark that these numbers are for the remaining business or continuing business, which is the accounting word for the businesses, and that means that the Swedish sawmill business has been subtracted. So these are the numbers which give you good guidance for the business going forward. And as you see in the graphs in the bottom of the page, we have had a quite tough ending of last year. Q2 started to be a little bit lower prices in the sawmill business foremost. And then Q3 and Q4 was very poor performance actually, and mostly related to the sawmilling business. Then we had a different picture at the beginning of this year, and Q2 was actually very good, and the best quarter since many years ago. A clearly V-shaped recovery we can see. And also give you a little bit picture of how the business is divided. We see the net sales by segment, that the sawmilling business is now about 35% of the total business, whilst the further process is more than 60% of the business. And before the divestment of the Swedish sawmills, the relation was opposite actually. Profit-wise, the sawmills are doing very good at the moment, but long-term I would say that the further processing business is have both higher margins and more stable margins. So going to the next slide, it's also for you to get a feeling of the difference in profitability between the continuing operations, also the remaining business, and the divested Swedish sawmills business. And we can clearly see that the margins in the remaining business is higher than the Swedish sawmill business. And that has been for a long time, actually. So to summarize, we will be a smaller company at the moment, at least. But we will have higher margins for the remaining business than we have had previously. The volatility will be much less, and we will have a very favorable balance sheet also with very low net debt, and that will give us a clear platform to develop the business and grow also in the segments that we are finding interesting. So by that, I think we thank you for your attention.
Thank you very much. Now let's go over to a bit of Q&A. You stated that growth within value-added processing is a key strategic focus area for you going forward. Can you name some of the products areas where you see the biggest potential for growth organically in the years to come?
Yeah, it's if we look at wood protection, that is there we have a lot of potential, and we have the biggest capacity in Europe looking at that, and there we see, I mean, fire protection, it's ordinary protection, it's even coloring, and to supply like a concept for cladding for wooden houses. That's a big potential, and also in garden products, doors and windows. We are not that sure about how much we should grow the house part of the company, but I would say this is the main focus areas. And then, of course, we have pellets as well, and then we are looking at how we could develop the sales and distribution, which is there is a lot of potential.
And when it comes to M&A, where do you see any potential areas for M&A going forward?
Yeah, I would say it is in these three areas: wood protection, doors and windows, and the garden products. That's the main, and then how we could take steps to improve the market position, and then again talk about logistics and how we distribute our products. There we see quite big potential and very interesting opportunities.
Thank you. And we all know that building in wood is much more environmentally friendly than other types of building materials. Do you see a higher demand in the market for building with wood due to environmental reasons?
I think we have been talking about this for 20, 30, 40 years now, about wood as a really friendly and environmentally good and potential, but it just recent years, and I would say the last 2-3 years, the interest has really been increasing, and also a lot thanks to development of the products like glulam, better protection, fire protection, etc. It is now possible actually to use wood in higher buildings and in towns and cities, and so thanks to a lot of development, we can actually now see the growth coming, and a lot of, I mean, possibilities. And now it's very much up to Bergs and to us to decide in where exactly do we want to have the growth and the strength, because it's such a big area, so we can't be all over the place.
Thank you. That was very interesting. Thank you very much, both Peter and Anders, for taking the time to present to us today. And thank you to all who listened in, and have a nice day.
Thank you.
Thank you.
Hi and welcome everyone to today's presentation of Scout Gaming Group. My name is Stefan Knutsson and I'm an equity analyst here at ABG. And today I have with me Anders Ternström, CEO of Scout Gaming. Welcome.
Thank you very much. My name is actually Andreas Ternström. That's not the first time it happened, but that's how it is. And I'm CEO of Scout Gaming Group. Scout Gaming Group mainly is a B2B provider within the fantasy sports. That means that, in essence, what we do is that we provide a technical platform, games, stats, pricing, and trading to the operators such as Norsk Tipping, Stickeman, Puff, etc. And in their turn, they market this to the end users. We also have a B2C brand called FanTeam, which we mainly have used as a test bed for new games and new sports, etc., but has been growing a little bit lately as an effect of the pooled liquidity network that we have built. Typically, we are listed on First North. We are a staff of approximately 83 people, from where around 55 is based in Lviv, Ukraine. We're also based in Bergen, Norway, and in Stockholm. The growth for Scout Gaming primarily comes from high-value clients such as Norsk Tipping and Puff, etc., but also from the high prices we and our operators can present to the public, which creates high attraction to the market. And on top of that, we are supplying new games. Just short about our business model, it's a combination of fixed recurring fees, setup fees, etc., but mainly scalable revenues like a rake, where we take a part of the staked money we take, around 10 to 15%, or a gross win that comes from our betting games, which is stakes less winnings, more or less. We have today around 30 plus customers across the globe. Some are media customers, but mainly we are in the gambling operator sector. Our management team and board consists of industry veterans with a mix of founders and investors in the gambling space, such as Anders Enoksson, who is chairing our board, and he's out of Knutsson Holding. When it comes to shareholders, our largest shareholder today is from the US, Topline Capital, out of Santa Monica in California. We have the founder and his father representing quite a part, and then we have institutional investors such as the Lundström family and the Knutsson family, but also Swedbank Robur and some others. As I said, I strongly believe that we are a world leader in what we do. I honestly haven't seen anyone having a pool liquidity network consisting of different operators yet, at least not in the sense that we have. So we have some kind of first mover advantage for good or bad, but we are supplying all over the world. Just some very important components that makes this a successful company in the future. We are kind of late to the party. The company was founded 2013. We launched a B2C site 2014, and then 2016 we launched our first B2B customer. We did this on our own in-house built technology. So being late to the party meant that we could choose the latest technology that makes things much, much easier. So a proprietary tech platform, We supply our own pricing and trading in-house. We do that from Ukraine, Lviv. That's also very important because that means that we can set up more or less any sport and price up the leagues wherever they are, as long as we can get hold of some stats. And the data is ours. Around our B2B customers and together with Fanteam, we then created a pool liquidity network. That means that the operators and their end users stake money in the same tournaments. So the more operators, the more consumers that can stake, the higher the prize pools. We control this network liquidity today. What's also good about that is that the higher the prize pools, the higher the hurdle for anyone else to get in actually in competition with us. On top of this, we build our own proprietary games. So we have today DFS, daily fantasy sports, we have season-long fantasy sports, we have play-for-free games, but we've also built pure betting games on player performance odds. So we use the same game rules, we use the same pricing, but you can now play over-under on certain players and matchups to each other. On top of that, we have a combination of some other games as well. I'll come back to that, I believe. This, together with a very young, agile culture and organization, we are able to turn around quite quickly when things happen, right? And when we see new opportunities. Just some short mention about the market. What we see is we always say that concept is new to the public. It is. We have 60 million, I think, Americans playing fantasy sports. We have now, I guess, somewhere around 7.5 million people playing the free-to-play game Fantasy Premier League. And this is all growing all the time, right? So merely what we do is that we try to convert these players in play for real. If someone is really good at playing, they are probably happy to stake some money to even win, right? Other parts that makes this growing is that it's a very sustainable game. It has very low acquisition cost. You play mainly with your skill, and that also creates quite high retention and a very long lifetime, which in a sense becomes high lifetime values. And I think that the gambling sector in some cases are in need of more sustainable games. So it's sort of coming in the right time. Yeah, and it's a social game. Right? All the tournament sports that you play, poker or not or whatever, it's a very social game. Good thing about this is that we also sell our software to media houses and sports federation. What's interesting with that is that if you look at the US market, they claim that fantasy sports, playing fantasy sports, even drives viewership to the broadcasted sport. So it's growing more or less. Just to talk a little bit about what really makes us grow, and I'll probably repeat myself a couple of times here, but high price pools is what attracts the players. It's the same with lotteries and everything else. And what we've seen so far is that when we launch, for example, the 250 euro prize pool for the start of Premier League 2019, the activity grew by 314%. So this year, with all the buzz now and all the uncertainty around Premier League, we're now launching a 1 million euro prize pool where the winner can win 2 million euros, which is kind of, sorry, 200,000 euros, which is kind of life-changing for some people. And it's going to be fun to see how much that makes us grow. This case, the second part, what makes us grow is that we constantly take new contracts, right? And we try to we probably integrated around half of all the contracts we've taken so far, and a lot of brands are now under integration or is about to launch. This means that we're now adding more and more B2B partners to the pool liquidity that makes us driving the prize pools even higher. And of course, we have to continue to sign high-valued customers such as Norsk Tipping and Svenska Spel or what have you, right? a third part is that we have now a base of integrated customer, and meanwhile we have been innovating new games such as player performance odds with a player performance sportsbook, with high cross-sell functionalities into the customers' other sportsbook, etc. And that's the third part of what will make us grow, is to really integrate the new games, and they are kind of really already integrated via the APIs they have, right? Some short comments about Q2. I mean, we have to be proud, and I'm honestly extremely proud of especially the organization and the culture we have in the company. So what happens is that the sport dies, right? There is no sport at all except for some Belarusian Premier League and some table tennis that won't save the world, as we've seen with other sports suppliers. But what we managed to do was to turn this around into e-sport. And especially CSGO has been very successful for us. And remember, this is during the times when people, the whole company is working from home, but the developers create new games for e-sport. The statisticians in the stats center prize players in different e-sport leagues. And we get it up in around 4 weeks after testing. We get it up on the testbed brand. We change the rules a little bit and out into the network. And we managed to grow by almost 60%. And I would say owning the technology from A to Z with a very agile organization and a very good culture makes this happen. So my opportunity here now is to thank my organization for being such stars, right? What else can we say? Yeah, we've seen sort of a good start in July and August. I think that everyone has more or less as sports coming back. We signed a Paris match, a big operator in the CIS countries, and we did a share issue during the summer. So we are well financed and heading for even more growth. Just to give that some kind of reflection, you can see for yourself. I think that we sort of, in a way, we are in a transition from a kind of a investment phase into a growth phase, where once again, it's extremely important that we continue to integrate the customers, sign new big customers, supply new games, and get higher price pools. And this is what will drive us forward. And just to give this also some historical performance, we have something we call an operator trading index for the market to follow our development when it comes to the variable fees, such as rake and gross gaming revenue put together. And we are growing that very nicely. You can also see the trailing LTM, which defines the year end, if you want, every quarter. That we are getting into a more of a growth situation. I think one of our toughest things and challenges right now is to figure out the trade-off between growth and profitability, right? And we will try to navigate that as good as we can, and trying, navigating in this to try to enhance some kind of shareholder value. And yeah, my honest belief is that the coming years will probably consist of a lot of growth, and is going to be as fun as that has been since 2016 when I joined this. That was more or less what I had.
Thank you, Andreas, for that presentation. First up, I just want to talk a little bit about geography. We've seen a lot of things happening in the US. How do you view that opportunity in terms of long term?
Yeah, I think that US is still an opportunity for us. And it's been a question if we should go into the US or not. But to be honest, I see that we have so much things to do in other markets, and our main market, Europe, still that is not a necessity at all for us anymore. But we of course will be happy to get into that market. We have two very strong B2C players over there that is pouring cash into that market to be market leaders, and get into that fight. I believe it could be slightly tough for us. So I would say that Europe, South America is very interesting, Africa, and even parts of Asia, like India, for example, where fantasy sports is still legal without a license, or unregulated but legal, or whatever you want to call it. Yeah.
And to continue on that discussion, you have said earlier that fantasy sports prize pools must be reach considerable sizes to be as big in the rest of the world as there are in US.
Yeah.
What sizes are we talking about here around different sports, and how far have you come?
I think that the 1 million euro, if you ask my two management colleagues and founders, Andreas and Björn, I would say that they will agree with me, saying that reaching a 1 million euro is a milestone for us. We believe that if we can get a good activity growth on that means that we can then run the weekly tournaments, what we call the weekly monsters, maybe on 100,000 euros per week. Then we are getting up to a level where this can grow heavily. I think that we still have to grow the prize pools, though, and it's more of a trade-off of what else is offered out there in the market. It's not Powerball, but it's still very high prize pool. So I think that somewhere where you can present kind of life-changing money to people is where you have the level. Yeah.
And is it mostly football that you see an opportunities in, or?
It's interesting because as we now launched esport during COVID-19 days, we see that esport have had a very good uptake. So I'll believe that football, basket, and some others are extremely important for us, and it has always been very important for us. But we sort of now see that esport is becoming like a new sports vertical even for us to bet on. So we came out of the COVID quarter with a new sports vertical that will help us grow even further. So and that is might be the opportunity for us also to get into the US market and markets where we to go.
And speaking about the 1 million game here that you mentioned, what is your view on the demand for that game? Are you satisfied with what you've seen?
Yeah. So I mean it's always an estimation when we do these things, but the estimation and what we see so far is looking really good. I don't think I can really say much more than that, to be honest.
Okay, but then let's talk a little bit more about esports then.
Yeah.
Can you give us a little update on the esports related market post the launch, and what's your view on interest in the market going forward?
I think the interest is huge, and I mean, being slightly older and grey on the side of the hairs, I listen a lot to the younger people, right? To try to understand esport, and it seems that is a tough thing to understand. But what I figured out, and what someone told me, is that if you look at the e-gamers and the people understanding, the youth understanding esports, it's a skill game, right? So if you put a skill game into a skill game format, it seems to be successful. And as DFS and fantasy sports being a skill game, it happened, right? And it happened for us, and we just see that it's a global sport. It's not Premier League for Europe or NFL for the US. It's truly a global sport, which I like. So I can't point out any certain markets. We are treating it as a global market when it comes to esport, which is kind of interesting, where everything else is local.
Yeah. And you've signed a lot of clients. You've come far, but you also have dialogues with clients that we don't know yet. Can you say anything about what regions you're targeted and how the sizes of the clients that you're talking to now?
Yeah. So typically, I think we said even in the prospectum when we IPO the company on that we will go after the tier one customers. And the tier one customers for us is typically, you know, we have Sticky Man in Greece, which is the market leader. I guess they have somewhere around 50% of that market. A fantastic company in many ways. That's a true tier one customer. But also like Norsk Tipping that we signed, you know, which has a big part of their revenue today coming from pool betting is extremely interesting. So the ones like that, you know, the OPAPs of the world, the Svenska Spels of the world, is what we're aiming for. Yeah.
Perfect. And lastly, what have the activity been like on the fan team post in June? And what would you say that is your strategy there versus the extended external operators?
Yeah. So fan team has been growing, right? And as an effect of you know the network liquidity, where the prices also has been rising on Phantom. We have been using Phantom as a test bed brand where we try out new rule systems, launch new sports, try new game formats, etc. But that's kind of being successful. So what we see is that there's an opportunity for us to use that example. If we want to get into a new market, we don't get any new customers, B2B customers in that market, then we can actually go in with our own brand and create some buzz, as we are fantasy sports believers. But we can also try out how the market works, figure it out, and maybe then be better on upselling to B2B partners. So we use it mainly as a test brand for new innovations, but also potentially getting into new markets.
Very interesting. Thank you for today, Andreas.
Thank you very much for having me. Thank you.
Welcome to Introduce Investor Days. My name is Stefan Bilov, and I'm an equity research analyst here at ABG. And with us here today, we have Cibus Nordic Real Estate, and I'm very happy to hand over the word to the CEO and CFO of Cibus.
Thank you. Thank you very much. Yes, today's presenter is, apart from myself, Sverker Källgården, the CEO of the company, Pia-Lena Olofsson, who is the company CFO. I won't take you through all the numbers in this summary, as Pia-Lena will go into those more in detail. But we have had some significant events during this period. At the annual general meeting, we elected a new board member in Stefan Gattberg. We have also recruited Peter Löfgren as the new CIO of Sweden. And despite the corona pandemic, we have continued to acquire new properties. We have acquired 23 properties in 2 different transactions. First, we bought 18 properties in Finland, and then also 5 properties in Finland after that. And on the financial side, we issued a new green senior unsecured bond of 600 million SEK in June, and just after that we announced a voluntary redemption offer for our outstanding 135 million euro bond. And the days after that we issued a new bond of the same amount, 135 million euros, and we redeemed the existing bond. So we are now fully refinanced. And then, just before the Q2 report was released, we announced that we are going to hold an extraordinary general meeting next Monday, on the 14th of September, to vote on the board's proposal to go into monthly dividend. A couple of slides of what Cibus is. Cibus is a daily goods properties company with strong tenants that provide dependable income to our shareholders. We are focused on real estate or the grocery stores or daily goods stores of supermarket size, as we think they are the most resilient store size, and we'll come back to that later on. We fill the properties with the best-in-class grocery chains, leading grocery chains in the Nordics. And the story about Cibus is more or less the story about portfolio diversification, because traditionally these kind of assets were owned as either single assets or in small portfolios, or maybe 2 to 5 assets, which meant that there was a very high risk concentration. You came into a weak negotiation position with the tenants, because if the tenants left, you lost all your cash flow. The banks realized this, so it was hard to get bankability, which meant it was a high risk and high return business. What Cibus realized is that if you own 280 of these properties, you diversify the risk and you lower the concentration. None of the assets now is worth more than 2.5% of our NOI. And as you own a lot of properties, you become an active cooperator with the tenants, not just a landlord negotiating rents. The banks realized this, so the bankability is much higher, which means that you lower the risk, but you have the same return as for single assets. And as we are a real estate company within retail, it would be stupid not to talk about e-commerce. And the Swedish Institute of Trade has produced a report on the effects of different types of retail when Amazon now enters Scandinavia or Sweden. And as you see to the right of the scale, with a high effect are electronics, books and toys. But on the other hand, on the far left side are daily goods, which is of course because that the Amazon are not focused on daily goods, as the margins are too low and the costs of handling, packaging and distributing the goods out to the consumers are too high. And to prove it, we can see that we have a resilience towards e-commerce. We see a negligible negative effect of e-commerce. During the corona pandemic, the percentage of online trades has risen up to approximately 4% in Scandinavia. But a large share of that volume is click and collect, which is collected from our stores. And you can see there are very few operators worldwide who make a profit on online food sales. On the other hand, we see a notable positive effect of e-commerce, as our stores are a natural distribution network pickup points for other goods purchased online. This is a very, very strong trend all over Scandinavia, as the Swedes and the Finns are fed up sitting at home waiting for DHL or PostNord to eventually turn up with the goods purchased online, so they have them delivered to a pickup point, and all our stores are pickup points. What about the corona effect on Cibus business? Well, we have a business model that is non-cyclical. It should work whatever economy we're in, and the corona pandemic has really proven the business model, as we have seen a very limited negative effect. The grocery sales are on record levels. The tenants have handled the increased demand very professionally, and approximately 90% of our incomes come from these leading food chains. And more than 99% of our invoiced rents for Q2 have been paid. But of course, we have some additional small tenants. It might be a restaurant or a pub or a hairdresser that is connected to the food store. And for example, in Finland, the government closed down all restaurants and pubs. So we have helped them with around 200,000 euros during the second quarter. But bear in mind that all rents for that quarter were over 16 million euros. So it's a very limited effect. What we are doing that stands out a bit in this segment is that we are building a proper real estate company. A lot of the other companies who are present in our segment are institutional money and funds without an own organization. But as we have now hired Peter as the CIO of Sweden, we are now fully staffed, and we have staff working with our properties, our tenants, and with the financial market 5 days a week. So it's very easy to get hold of a Cibus employee. And it means also that we can actively work with both the tenants, the properties, and with new acquisitions. Talking about sustainability, which is a very important thing to focus on if you're in the real estate business, because of the huge impact on the environment from real estate. And we are driven by the conviction that we can contribute to a responsible, social, and environmentally friendly neighborhood where our property is situated. But how can we work with this? Because we have a lot of our portfolio is under triple net leases, which means that the tenants takes care of all the refurbishment or capex in the buildings. But what we do to work with sustainability is to work together with the tenants. The best thing we can do is to continue to buy properties with the best-in-class grocery chains in the Nordics, because they are extremely good working with sustainability and having a sustainable store. And one example on how we work together with the tenants is the picture on the slide, where Tokmanni asked us if they could use our roofs to put solar panel plants on top of them to reduce the electricity consumption from the store, which we of course said it was okay. And now they have generated about 260 tons of carbon dioxide, and that's the electricity consumption for about 920 apartments. And as I said, we have to strengthen the living local community. We have also supported these additional small tenants with 200,000 euros during the second quarter to enable them to reopen again when the economy is back. And we are also proud to have issued our first green bond to finance our energy efficient buildings. If we look at the shareholders list of the last of June in 2020, the 15 largest shareholders owns approximately 45% of the company. There is no distinct head owner. We have a very good shareholders list that we are extremely proud of. The fourth AP Fund is the largest shareholder, followed by Marianne Dragicevic, Länsförsäkringar Fonder, and BMO Global Asset Management. And how has the share performed? Well, since the IPO, there is a very good volume, an average daily volume of around 27 million SEK, with about 1,200 transactions a day. And although our operational result was negligible, impacted by the coronavirus, the share price was affected. But if you look at the trading price today, it's over 160 SEK, so we are well back on track. Then over to Pia-Lena for the financials.
Thank you, Sverker. I will just go through some key figures for the second quarter. So rent income grew with 30% to 16.4 million euros. Net operating income grew with 32% to 15.1 million euros. Profit from property management was 7.8 million euros, and earnings after tax was 8.9 million euros, or 0.24 euros per share. But we do have some items that are affecting comparability in the quarter. We have higher administration cost due to the 2 new bonds that we have issued, but also the final cost for the restructuring that we have done in the Finnish group. Net financial items are affected by redemption premiums. We have redempted the old bond, 114 million of the 135 was redeemed during the quarter, and 21 million euros is redeemed the 9th of July. So that had an extraordinary cost of minus 2.9 million euros. And then we have a positive exchange rate difference of 1.4 million euros. Looking at unrealized changes in value on investment properties, it was 3 million euros for the quarter this year and 5 million euros the same quarter last year. This is our current earnings capacity. We have acquired properties in July, so that's why we are disclosing the earnings capacity from July. As you can see, net operating income on a 12-month basis now is 65.1 million euros, and profit from property management 40.8 million euros, or 1.09 euro per share. Here's a snapshot of our portfolio at the end of the second quarter. We had 275 properties at a value of 1,124 million euros, and we had 664,000 square meters. Our anchor tenants are Kesko, Tokmanni, Coop, and S Group, and they stand for about 90% of our net operating income. We are now disclosing our figures in our 2 segments, Finland and Sweden. If you look at the net operating income, Finland stood for 89% and Sweden 11% for the first half year. But then bear in mind that we acquired the Swedish portfolio in March this year. If you look at the property value, Finland stands for 84% and Sweden 16%. Cibus strategy is to give our shareholders stable and reliable dividend that increase over time. Our dividend policy says that we should increase our dividend with 5% per year. And the board has proposed that the dividend increases with more than 5% this coming 12 months after the annual general meeting that we had in April. So in total, 0.89 euros per share. They also intend that we should go to monthly dividend. We have called for an extra general meeting now the 14th of September, where the meeting will decide on the remaining 0.67 euros per share. Looking at our balance sheet, as I said, we have property value of 1,124 million euros. We have 4 bank loans, in total 551 million euros, giving a loan to value of 49% on senior secured debt. And then we have 2 bonds on the market, and also we had 21 million that was redeemed in the 9th of July. That gives a net loan to value of 60.5%. Our EPRA NRV was 439 million euros, or 11.8 euros per share. Our average remaining lease time is 5.5 years, and it's been quite stable at 5.5 years. And this is due to that we renew our leases on a continuous basis and also acquire new properties with usually longer lease time. Looking at our financing, as I said, we have 4 bank loans of 551 million euros. With an average floating interest margin of 1.7% over Euribor or STIBOR, depending on currency. Our average tenor is 3.3 years, and 67% of our bank loans are hedged with interest rates derivatives. And we have only long-term financing. Our first loan that matures is in 2.6 years. And we then have 2 new bonds on the market. 1 SEK bond that matures the 12th of June 2023, and the new Euro bond that matures the 18th of September 2023. And then we had 21 million euros that was redeemed the 9th of July. Over to you, Sverker.
Yes, thank you. What about the future? What we are focusing on now? The focus areas going forward is to continue to build a professional, transparent, and accessible company and organization. We have started work with a list change to Nasdaq Stockholm's main list. We are monitoring the other geographies in the Nordics, but focus now is on continued growth in Finland and in Sweden. Of course, we like to be more effective and increase the return from the existing portfolio. And last but not least, what are the primary reasons to invest in the Cibus share? Well, we produce a high and stable yield. Since the listing, it's been around 7%. There is a potential for favorable value growth. Due to the risk factor I talked about earlier of owning 1 or 2 of these properties, there is a fact that we can always buy single assets or small portfolios to 50 to 100 basis point higher yield than our portfolio is trading at. And we have an investment plan of around 50 million euros annually. We are present in a segment with a long-term resilience and stability, which the corona pandemic has proven. And last but not least, we pay out quarterly dividends that will increase gradually, and we have a plan for monthly dividend. Thank you.
All right. Thank you very much for this presentation. Now we move on to the Q&A session. And I would like to start off with a strategic question. So from a strategic point of view, you have been focusing on grocery retail assets or daily goods retail assets in Sweden and Finland.
Yeah.
And will you always continue to focus on this asset, or are you interested in adjacent assets such as warehouses or logistics for grocery?
We have a very clear and simple business model where we focus on the supermarket-sized stores because we think they are the most resilient. And it's very important for us that our shareholders recognize the company in the transactions we do. So we will stick to that strategy, yes.
Yeah. And you mentioned in the annual report and here in the presentation that you benefit from e-commerce, and you elaborate a bit on it here. And if I understand you correctly, the main benefit you have from e-commerce is that your daily goods stores can become distributors. Would you conclude with that it's the main benefit, or is there any other benefits that you would like to highlight?
Well, there are really two benefits. The first one is that we are a pickup point, but the other one is click and collect. As a large percentage of the e-commerce groceries are click and collect. That it's purchased online but collected at the store. And for our stores, if the volume comes from e-commerce or from physical shopping, it really doesn't matter, because the store benefits from the e-commerce as well. And you always know that when the customer comes there to pick up the grocery bag, they always remember that they've forgotten something to buy. So they'll take a stroll into the store as well. So there are benefits.
And looking at the ownership structure of these kind of assets, if you look at proportion-wise, how much is owned by private real estate companies and how much is owned by the grocery companies themselves?
I'd say it's very difficult to give an exact figure on it, but a lot of these properties are still owned as they used to be traditionally. So there are a lot of small portfolios out there in the Nordics. And we own 280 out of maybe, 20,000 stores in the Nordics, so there are plenty more to buy.
All right.
Yeah.
And do you see a risk that your existing tenants would like to prefer their own assets, or?
The trend is not that. Well, there are some companies that Inga or Kesko have joint ventures together with Alekta and Ilmarinen in Finland, but that was just a placement for when Kesko and Inga wanted to reduce their balance sheet. So they are there, but they're not very active in the market.
And if we look at the existing tenant base, how many tend to renew their lease, and do you typically do any changes when you renew the lease?
It's a different situation in Sweden than in Finland, because in Finland has the world's most landlord-friendly legislation in the world, because the tenants have no rights. There are no possession rights in Finland. So the leases tends to be very long. So a typical lease in Finland is first a 10-year lease, and then they have 3 5-year prolonging options. So in practice, the contract is 25 years.
Okay.
But we can only include in the vault the existing of the first or the original contract or the option period where they're in. In Sweden, the vaults tend to go a bit shorter as they have possession rights. So a typical store in Sweden would be somewhere between 0 and 3 years of average remaining lease time, apart from our model or our portfolio. When we negotiated 10-year new triple net leases with Coop, we took the Finnish model into Sweden.
Yeah. And one final question about the transaction market. What do you think will happen with yields the coming 12 months, and do you have any typical competitor when you're looking for acquiring an object?
The yields on these kind of properties has been stable for the last 10 years, and that's because the valuation of these properties has also been stable. Because a lot of these, or most of these assets have fixed rents with just the index upgrade calculation. So you don't get the big fluctuations as you have in office rents or other retail if you have turnover-based rents. So the yields have been very stable, which also is a fact for the transaction yields. So, and I haven't got any indications of that it would be a significant yield pressure or anything. So we think it's going to be like this for the coming future. And during this pandemic, we haven't seen any bank forced sales or anything. So it's more or less business as usual.
All right. Thank you very much.
Thank you.
Thank you.
Welcome to today's presentation and the Introduce Investor Day. My name is Eric Castle and I'm an equity analyst here at ABG, covering Nordic waterproofing. Today I have the pleasure of introducing the CEO, Martin Ellis. We will have a 20-minute presentation followed by a short Q&A from me. With that, I'll leave it over to you, Martin.
Yeah, thank you very much. Hello, everybody. Thank you very much for joining. I'm proud to present Nordic Waterproofing to you. Our business is to protect homes and buildings, and I would add also to promote sustainable building solutions. So moving right into our presentation, a short update on the COVID situation. Basically, we are focused on keeping our employees, customers, and suppliers healthy, and we've been very successful in that with very precise measures to continue to do so. And we have to say we haven't had any negative impact really on our financials so far in 2020. The future impact on business is difficult, obviously, to assess because it's very dependent on future GDP development. So if the pandemic, which is likely, I guess, has some negative impact on GDP, we will ultimately be concerned by that also. We expect that to happen maybe in the next 6 to 18 months. On the other hand, we also see some medium-term potential positive impacts, and mentioned two of them here. One is increased e-commerce requires additional warehouse building to deliver the goods, and big boxes buildings is typical something where we do a lot of business. And the other aspect is that obviously demand for data centers will increase further, and that is also an important part of our target buildings, large buildings, and a lot of those are built in Scandinavia. And we also see some more marginal positive impacts from the stay-home effect, where people focus more on their home. And we see that in our Distripond business, where we create environmentally friendly ponds and swimming ponds for people, mainly in Belgium right now, but it's a business which we would like to expand into the rest of Europe. Moving on to page 4. Our basic mission is to protect people and what's important. And the key is reliable waterproofing. The quality of our products is absolutely paramount. On top of that, we also emphasize the ease of use of our products. We want to make the life of our customers, who are basically the roofers, people who install these products, we want to make their life as easy as possible. And we've been successful in that. Next page, 5, you can see the typical building, which is the bulk of our business. It's a big box type building, and what we do there, we supply and also install ourselves, in some cases, bitumen membranes. That's the largest part of our offering. We also install EPDM, roofing membranes, which is a synthetic rubber product, which has the same function, basically, slightly different characteristics. We install insulation, which comes with the waterproofing solutions, a number of accessories, and we also cover parking, bridges, railroads with waterproofing materials. We provide geomembranes to isolate geologic stratas in mines, for example. And we also prefabricate facades and roofs. That's a relatively new business in our company, where we supply finished elements, which can be up to 20 meters wide, one story high, which are prefabricated in a plant and which are extremely fast to install on the building. So it makes building much more efficient. We also offer green infrastructure, could be a green roof, and it can also be public surfaces which are green, and obviously there's a strong trend in favor of that. And for the last few months, we have also been installing solar panels in Finland, relatively new product line. Moving on to page 6, you can see that we are also active in the pitched roof. more individual house sector. It's a smaller business for us, but we basically propose the whole range of our products and services there. We also have a business in Finland and Sweden where we do roof maintenance for individual houses. And of course, we install solar panels on such buildings. On page 7, you can see our basic geographic footprint and also a bit of the structure of our business. You can see that we are very much centered in Scandinavia, in the Nordic countries, but we also have businesses, especially in the synthetic rubber business in Northern Europe, UK, Germany, Benelux, and Poland, where we basically prefabricate roofs, and we also supply facade elements based on material which we produce in Sweden. So we produce a EPDM roll, and then we are able to measure out the roof and prefabricate the whole surface in a shop. And again, the idea is that it's much faster to install than the job site and a much more efficient solution for putting on a roof waterproofing system as fast as possible. Looking at the split of our business, I mentioned we produce, so we're an industrial company, but we also install waterproofing solutions as an entrepreneur. And the split is 73% industry and 27% installation services right now. You see that on the left pie chart. In terms of the exposure to new build versus renovation, it's about 50-50 right now. That makes us quite resistant to building cycles. The new build is more cyclical, more volatile than renovation work. Renovation is very stable and basically follows GDP. In terms of the country split, you can see that we're big in Finland, in Denmark, Sweden, a bit small in Norway, where we haven't been present as long as in the other countries. And we also export in the Sileco synthetic rubber business throughout Europe. Moving on to page 8, it's a short description of how we go to market. So you can see that the biggest part of our channels is direct sales to basically roofers and also general contractors when we talk about the prefabricated facade and roofing elements. What happens there is we usually sell to smaller roofing companies, and we have a very strong relationship with them. We supply products and services, of course, but we also help them with a number of things like apps and advice on legal, on marketing and financial matters. So we're talking about small companies, 5 to 30 employees maybe, and we help them with a number of things which they basically don't have the size to deal with themselves in all cases. But we also distribute about 30% of our products and services through builders merchants. Builders merchants sell usually to smaller roofing contractors who buy a whole bunch of products in one outlet. So when we sell direct to our contractor customers, we can fill up a whole truck with our product and send it to the job site. When the job site is small, then our customers will quite often go through a builder's merchants where they can get a full supply of all types of products they need for a given job site. So the distributor has a logistics function in that respect. Usually our costs are a bit higher when we sell direct because of the services I just mentioned. And we have slightly higher gross margins and distribution, lower gross margins, but also lower cost. Moving on to page 9, I would like to talk about our acquisition strategy. We've been quite active in acquisitions over the last 3 years, and we continue to have a pipeline of acquisitions. The key focus in our strategy there is to add sustainable solutions to our portfolio. We initially, what we call our core business is waterproofing, products and services, and we've expanded that into sustainable solutions like the wood-based construction of our prefabricated elements, which basically is a great way to reduce the CO2 footprint of a building by replacing cement, which has a very big CO2 footprint, by wood, which basically absorbs CO2. The second example is the green infrastructure I talked about, where, again, we help to basically give the environment a better feel, but also to absorb heavy rainfall, to delay the transfer of water into the sewage system, which is a problem, especially in urban areas. And last but not least, we install solar panels, which obviously have a positive climate impact. Another key idea in our acquisition strategy is to enhance our product and service offering, basically trying to sell more product categories to our customer base. So whenever a customer needs products which are somewhat related to what we do, we try to be able to supply those to our customers. They like our service level, and we represent the one-stop shopping opportunity for them. The downstream integration, that is also a key idea, which applies especially for the synthetic rubber business, where, as I just mentioned, we not only produce the rolls, the material, but we also then prefabricate roofs, especially with our material, and that's a local business. And we have acquired a number of these companies in Benelux and other countries in Europe to go to the end customer with our product and service. Multiple acquisitions and a pipeline also in the present situation. To some extent, the pandemic has slowed acquisitions down slightly because it's a bit more difficult to do due diligence. Physical travel is a bit more complicated right now, but we don't expect that to change our strategy at all. Moving on to page 10, sustainability, as you realize, is key to us. ESG is an important aspect. So in terms of sustainability, I described what we're doing in our portfolio, and we've come quite a way in increasing the sustainable solution part of our business. In terms of ESG, we obviously have a code of conduct which is in line with the UN's Global Compact. We have a whistleblower policy, and we also obviously make sure that our suppliers and subcontractors adhere to the same codes as we do. I'm now going to move on to an update on our current business, and this is going to be based on the Q2 figures which we published last month. So moving on to page 12, I'm happy to report that we had a very strong development of our business. Our sales were up 7% year over year, and that's all organic. 1% from acquisitions and a slight negative from a stronger SEK. EBITDA and operating profit both increased significantly, 34% and 43%. And we had strong cash flow from our operating activities, 114 million versus 78 the year before, the corresponding period last year. And here I would like to remind you that we are a strong cash generator, obviously a very stable business, and a very strong cash conversion in our business, which is usually between 70 and 90%. So basically a very stable stream of cash generation and therefore dividends. Moving on to page 13, a bit more color on our second quarter. Sales were basically the highest we've ever had in the second quarter. Strong underlying business conditions continuing. Part of that could be the fact that our customers obviously were focused on doing their business as fast as possible before any possible shutdown of job sites, which fortunately hasn't happened, but which obviously remains a risk because of the pandemic. Some of them might also have bought a bit of inventory to make sure that we could deliver, but we've been able to deliver as much as our customers asked us to deliver. The operating profit is due, of course, to the sales increase. We also have good cost control on our raw material input, and also a slight effect of reduced traveling, some savings in that respect, and no material negative impact from the pandemic so far. Moving on to page 14, you can see our balance sheet, and you see that it is quite strong again. We had, for example, at the end of last year, a 1.8 ratio of net debt on EBITDA. That's on the bottom line, you can see that. And we have reduced that to 1.6 times in the middle of the season. And that means that at the year end, it will likely be significantly lower. You can see that last year we were at 2.9 in the middle of the season. So we've a significant reduction from 2.9 to 1.6, and we would expect at the year end to be at about 1 maybe. We are also happy to report that our ROCE is above our target level of 13%. We're at 15% right now. And we have a new agreement with our banks. So we've just renewed our financing agreements. So we have ample room in our credit lines also. And last but not least, the board of directors has been authorized to distribute a dividend of 4.5 SEK per share as soon as we get more visibility on the pandemic development. Moving on to page 15, that's a bit of a summary of what our financial targets are. And you can see that sales growth, we have a target of basically taking some market share and growing faster than the underlying demand, and we've been able to do that again this year. In terms of profitability, I mentioned the 13% ROCE target. We've achieved that and even slightly more. And we also have a solid capital structure, which means that we are ready to use any acquisition opportunity. We're actively looking for acquisition opportunities, and we have the balance sheet to make those acquisitions. Moving on to page 16, the outlook. Obviously, we can't make a forecast as far as our profitability to the year end is what it's going to be because of the pandemic right now. As I mentioned, we haven't seen any effect so far. We can see maybe a slight slowdown on the horizon in Finland. And we haven't seen that in our sales yet, but there is definitely talk about somewhat less projects coming onto the market, which might impact us in about 6 months. In all other countries where we operate, we don't see any significant sign for a downturn yet, but it is clear that if the pandemic continues, if there's a strong second wave, there will ultimately be a GDP impact also on the building industry, which has resisted so far very, very well. But we don't have any reason to be pessimistic at this point at all. So that was my comments on the situation. Again, we believe a strong investment case, good cash generation, good dividend potential, and a stable business model with some potential upside in terms of further acquisitions. And now we'll be happy to answer your questions.
Certainly. Thank you, Martin. And firstly, the oil prices have been very volatile in the past few months, as raw material cost is a very large part of your business, and your cost base, I mean. How do you handle these fluctuations?
Yeah, first of all, I would like to maybe specify that we have three main raw materials in our core business in the bitumen-based products. So bitumen is just about 1/3 right now of the total raw material cost. So a bit of a it's an important part, but it's not the only cost we have, far from it. But your question is very valid. There has been volatility. We've seen a very low point in March, April in oil prices. What we usually do is we hedge oil prices from time to time when we think we have an opportunity. And right now we're hedged until the end of first half of next year. I would say the impact has been slightly positive, of course, but it's not a major factor in our total cost position. So I would say we don't expect any negative impact in the short term at all. We also have recently diversified our bitumen supplier base. We used to buy most of our bitumen from Nunes, and Nunes has been struck for some time with US sanctions. That has been lifted now, so they're operating absolutely normally, but we thought it was prudent to be able to also operate without any Nunes bitumen. We've achieved that, but I'm happy to report that they supply normally and we continue buying from them.
Perfect. That was my next question, so I'll skip ahead. The waterproofing market is quite consolidated, and acquisitions has been very important for you for growth. What's your view on your current acquisition pipeline?
Yeah, as I mentioned, it's a bit slower in terms of executing those, but in terms of the pipeline, we're quite active. We are right now looking at smaller targets, a number of smallish targets, but we're quite hopeful that we will manage to do some of these deals, and it means that in the short term there will not most likely be any medium or large acquisition in our books, but it might well happen next year. But right now we're sort of dealing with smaller targets in the immediate future.
Okay, perfect. And looking at acquisitions you've made acquisitions in green roofing, solar, and prefab elements. Which of these business areas do you find most interesting?
Yeah, I think in terms of the mega trends which we're trying to profit from, we have made the right choices. So these trends have been confirmed and continue quite strongly. What we did have, and we reported on that in the last 2 quarters, is we have some execution issues in the prefabricated element business. So we're working on that. We're having a significant profit improvement program there, and we're not sort of out of the woods yet. It's not a huge part of our group, but we're dealing with that. But in terms of the underlying trends, I think it's very encouraging. So we are looking for increasing that exposure further. And right now we're trying to do that mainly in terms of increasing our geographic footprint. So what we usually try to do is we buy one company that's active mostly in one country, and then we try to replicate that in the other countries we know well. And we've done that with prefabricated elements. We're doing that right now with the green infrastructure. We are going to do that with the solar panels. We've done it with a Finnish roof maintenance company where we now have a significant operation in Sweden, etc.
Okay, perfect. And one last question for me. Looking 10 years ahead, as you're focusing more on non-bitumen products, do you still expect the bitumen products to be a majority of the group?
That's difficult to say. I would say our target is probably to reduce it maybe to 50. I mean, to expand the other businesses to the extent that it's maybe half of our business. It could, in the longer term, 3 to 5 years, it could maybe be 40%, something like that. But it will remain a significant part of what we do.
Okay, thank you very much, Martin, and to everyone else listening in.
Yeah, thank you very much.
Okay, everyone, let's get going now with the next presentation today. My name is Victor Forsell. I'm a research analyst at the healthcare team here at ABG, and we're glad to have GOP's CFO, Philip Delborn, with us today.
Thank you, Victor.
Warm welcome, and let's get going with the presentation.
Yeah, right, thanks. Hi, everyone. I'm going to introduce you to GHP. We are a Swedish healthcare group with a strong international presence. We have about 23 clinics currently in the Nordics. It's specialty clinics, which means that they are focusing on certain disease per clinic. So each clinic are specialized in their patient group. In the Nordics, we've decided to locate our clinics in the bigger cities. There is a reason for that. First, that's where we have most of the patients, of course. And secondly, that's where it's often more easy to find the really good specialists and doctors. So in Sweden, we have clinics in Stockholm, in Gothenburg, in the Skåne area, and also a large clinic in Copenhagen. And the most important statement for us at GHP is quality through specialization. And that's something that we every day work on. And what we mean with quality through specialization is that if you do something really good and you focus on that and you do a lot of it, you also get high quality and you get efficient. So today you will hear me talk a lot about quality through specialization. In addition to the clinics in the Nordics, we also have 5 management contracts, or 2 management contracts covering 5 hospitals in the Middle East. So we have hospitals in the UAE and a hospital in Kuwait, which we operate. In addition to that, we also have 2 capitation model contracts with insurance companies. I'll get back to that in a minute to explain a little bit more about what that means for us. We have decided to organize our group in 3 segments. First, we have the Nordic segment. That's where we really focus on the quality through specialization in each clinic. So each clinic focuses on 1 patient group per clinic. We like to have the high volumes and have a trained team to take care of everything a patient in that patient group might need. So it could be surgery, it could be physiotherapy, it could be a lot of different things that a certain patient group needs, and we would like to have all that in each clinic. And in addition then, we have our international segment, GHP International. And as I mentioned, in that segment, we have management contracts. That means that we operate the hospitals, we have a management team in place, and we make sure that these hospitals improve every day. So that's what we do in international. I'll get back to more about international in a minute. Then we also have vårdsamverkan, which is a fairly new but very exciting segment for us. In vårdsamverkan, we are trying to move away from the traditional models of delivering healthcare and getting reimbursed for healthcare to a new model where we have a capitation reimbursement, which means that we get paid for the full healthcare procedure, not just a single procedure, but the full patient journey for that patient. So that's a segment where we think we can work with both prevention, digital tools, and also more traditional healthcare to lower cost and increase quality. So that's GHP in a snapshot, you could say. If we then take a step back and look at why do we exist? There's, of course, several reasons for that, but one of the most important factors behind this is that when we look at healthcare today, the quality differences between different caregivers are significant. You can see here on the chart on the left side that in some clinics you have 10 times higher risks for example, a reversion. A reversion is when you have to redo a hip implant, for example, compared to other caregivers. And that's, of course, a problem in the system when you have so much differences between different caregivers and between different clinics. So there we can see if we can minimize that difference, you can get a much better healthcare system and much more care for the money. Also, we can see that there is a low efficiency in the system today. If we look at Sweden, our main market, there is significantly lower patient visits per doctors compared to other Western countries. There is reason for that, of course, but the difference is huge and indicates that there is a real inefficiency problem in the way healthcare is delivered today. Then thirdly, there is a lack of coordination. And by that, I mean a patient throughout the care journey visits several different caregivers. It could be a doctor, it could be a physiotherapist, it could be a radiology unit. But it's important that these caregivers communicate and for the patient to always be located and directed to the correct caregiver. And today there is a lack of coordination for the patient. So all this we believe that we've found a solution for. And again, we think one of the most important parts here is quality through specialization. If you're specialized at something, you get good at it, you get better quality and more efficient. The next slide is a slide which I think is very interesting, and it also supports what I've just said with high volumes and the correlation with quality. If you look at the risk for a complication within 90 days from a hip surgery and match that with the doctor that's been doing this operation or this procedure and how many procedures this doctor is doing every year, you can see that the more procedures a doctor is doing per year, the lower the risk for complications. And in this case, on this picture, you can see data from VGR, which is the public healthcare system in the western part of Sweden, a large region. And as you can see, the more each doctor is performing, the lower the risk for complications. These doctors are, of course, also doing other things like educating new doctors, research and stuff like that, which is important. But at the same time, if you compare to GHP, this is where we are at. We are somewhere between 2 and 3% risk for complication, which is significantly lower than the other doctors that we compare with here. You can also see that our doctors are doing many procedures per year, which makes them good at what they're doing. So this, I think, really support our quality through specialization mantra that we're always going back to. For the patients, the quality is, of course, also extremely important. We can see that when we measure the satisfaction from our patients, we do that in all our clinics. In this survey, almost 500 clinics, public and private, participated, and we had 3 GHP clinics in the top 12 of these clinics in terms of patient satisfactory. This chart shows our spine and orthopedics clinics in Sweden, and as you can see, high numbers everywhere. Let's have a look at the numbers. These are full year numbers on the top. We have a turnover of just above 1.3 billion SEK in 2019. We have strong growth, 17% in 2019, and we also increased our EBIT in 2019. We have a fairly stable and strong balance sheet, not that much net debt. And if you look at the second quarter this year, our most recent quarter, we can see a drop in sales, which is related to Corona, of course. Our organic growth in the second quarter was negative 8%. On the other hand, we actually managed to improve our EBIT year on year. So we had an improved EBIT, but a decline in sales during the second quarter. The improved EBIT is based on several different aspects. First, I think all our clinics did a really strong job in being quick in adopting to the new circumstances when Corona hit us in the second quarter. We terminated some temps. We reduced working hours for certain staff. We found new ways of using our resources. So we took new contracts, which we normally are not doing, but that gave us revenue to support the lack of patients in some of our clinics and supported us in terms of keeping up our profitability. If we then have a look at our three segments, I've talked about Nordics a bit already, but what we build our Nordic business on is these three boxes, you could say. It's the quality through specialization, it's a decentralized model with partnership, and with that, I mean, every clinic has a lot of freedom to operate their clinic in the way they think is best. We, as a head office, we are there to support them when needed, but they have a lot of freedom and mandate to operate their clinics in the best way for that specific clinic. In addition, we allow key employees, very often doctors or the managing director for a clinic, to have a stake in their clinic. So in most our clinics, we have minority owners in the clinics. Sometimes they have 3%, sometimes 49%. But they also are invested in our clinics, which is a good incentive for them to really try to improve their clinic every day. And it's also a way of getting them really connected to GHP for a longer period of time. And that's been very successful for us. Thirdly, we have a small but dedicated central team. Our clinics are not huge, so they cannot afford all the support functions everywhere in all the clinics. So when they need our support, it could be in HR or in IT or something like that. We are there for them and we try to support them. But at the same time, since it's a decentralized organization, each clinic should have the freedom to do what they want and ask for their help when needed. So this has been the success factor for us so far, and it's also enabling us to grow the business in a quite high pace. If we then look at international, our second segment, we've actually been present in the Middle East for 12 years now. It all started with a diabetes clinic where we were asked to operate and manage that clinic in Ashman, which is one of the Emirates in the United Arab Emirates. We took over that clinic and built and developed it over several years, and it became a really, really good diabetes center, one of the best in the region. That led us some years later to a larger management contract in the UAE, in Ashman. Since 2015, we are managing 4 hospitals in Ashman. It's 3 hospitals located fairly close to each other. It's an emergency hospital, it's a women and children hospital, and it's the diabetes hospital. And the 4th hospital is a bit more remote in a small town called Masfout. And we were awarded that contract based on the strong work that we had been doing for many, many years in the diabetes center. In this region, it's extremely important with good relations and good reputations and building a network. And that's what we've been doing the past 12 years. With these contracts, we felt confident that we could expand the business. So we've established a business development office in Dubai. That team in Dubai are always working on several different projects. You always need to have several initiatives ongoing. And they managed to secure a contract a bit more than a year ago in Kuwait. So now we're also running a hospital in Kuwait since 1 year back. Our third segment, vårdsamverkan, maybe requires a bit more explanation because it's a little bit untraditional compared to the rest of our clinics. In vårdsamverkan, we are developing and rolling out concept where we take the full responsibility for the insurance company's population, which means that we are responsible for getting each of their customers and patients the best care from day one until when their treatment is over. So we are not getting paid per surgery or per doctor visit or physiotherapist visit. We are getting paid for the total patient journey. And by doing that, we can streamline this process and measure the quality in all steps of the patient journey, and we can also lower the cost for the insurance companies. So as a result of these capitation models, we can guarantee that we lower the cost for the insurance company, we have satisfied patients, and we can improve the quality. So that's extremely important for us. And a very exciting new area, a new way of delivering healthcare. If we then look ahead, what are we working on now and what do we want to achieve? In the Nordics, we would like to expand with more clinics. We have a strong organic growth in the present clinics, but we would like to expand even further. We can do that with startups. We have a good track record in starting new clinics and getting them scalable and profitable. So that's something that we will continue to do. We would also like to increase the pace of our acquisitions. We made a couple of acquisitions last year, but we think still that there are clinics that would be very well suited for GHP. So we would like to do more acquisitions going forward. We are a bit picky in terms of what we acquire. It needs to be a high-quality clinic with a strong team that could be developed together with GHP. Within international, we're looking at rolling out diabetes centers. It's early still, but we are now putting more and more effort into expanding within diabetes and within new countries in the Middle East. So we strongly believe that diabetes is something where we could do something really good based on our track record in Ashman, but also our work with specialized clinics in the Nordics. Of course, we would like to have more management contracts. We're working on that as well. These processes take time, so it's difficult to say when we will have a new management contract, but it's absolutely on the agenda, and the team in Ashman and in Dubai are working on that as well. Within vårdsamverkan, we have 2 major capitation contracts today. We would like to expand with more contracts like that, so we get even more scale, and we now know that it is working. The customer is happy. We can deliver good healthcare to a lower cost. So we would, of course, like to have more of those contracts as well. Vårdsamverkan also gives us the opportunity to streamline and find smarter ways of delivering healthcare. And the reason for that is that we have so much data to base our procedures on now. We can see what kind of care each patient is most likely to be better from, so to say. If we decide to start the patient journey with an MRI scan, instead of first going to the doctor and then an MRI scan, we've made a smoother and more efficient care chain, and at the same time saved money and get at least as good quality result out of it. So in Vårdsamverkan, we have a unique opportunity to really develop new ways of delivering healthcare based on all this data that we are owning, so to say. Yeah, I think I'll stop there. You probably have some questions for me, Victor.
Absolutely, Philip. Thank you very much for that. And I think I'll start with a question regarding, I mean, obviously we're amid a pandemic here and it affects not only your operations but your patients as well. Just to get a sense of what you've learned as an organization amid these times, as well as if you can give us some quantitative comments as well of what you're seeing, since I think you commented in your Q2 report that you will keep good control on your costs from this level and when growth picks up again. So it would be interesting to hear both, I mean, internally in your organization, but as well as the financials here.
I think one of the big lessons from this spring is that our decentralized model works very well in these cases, because each clinic are responsible for what they're doing, so they are on their toes, and they're really passionate about controlling the situation. We in the head office, of course, supported them, but we noticed that each clinic, you don't need to tell them what to do; they do it anyway. So that's a lesson that we've learned, that the decentralized model works very well in situations like this. From a financial point of view, it's a bit linked to this fast adopting culture that we have. I think what we've learned is that if you are a bit creative, you can find new ways of using your resources and survive this tough period, so to say. So from a financial point of view, new contracts like geriatrics, for example. We had a short-term geriatric contract during this period to support the public system that couldn't take care of this for different reasons. That gave us revenue, so we could, so to say, use our staff that normally did not do this kind of care in this geriatric contract, for example. Secondly, we can see that there is a potential for cost savings. That's something that we can bring forward. We will, of course, see cost increase in terms once the healthcare starts to increase again in the society. We will have a lot of things to do, and we will need resources to do it. But we can still see that we have an ability to manage cost in a very good way, and I think that could be good for us also going forward.
Very interesting. And coming to Vårdsamverkan, we've seen a lot of uptick in health insurance enrollments this year. With specific health insurance companies. We saw, upticks of 20% in August alone. What does that mean for you in terms of discussions with potential expansion of contracts, as well as perhaps new health insurance companies to expand this model that you're in?
I mean, GHP is the go-to group in terms of private insurance or healthcare for privately insured patients. So we are, of course, in a very good position to meet that increased demand. Also, we are in very close dialogue with all the big insurance players in the market. So we're in a good position to make something good out of that expansion as well. So we continue to work with these Vårdsamverkan contracts, the capitation model. It's a way for the insurance companies to manage their cost and feel comfortable that the care that their customers will get is the absolute best care they can get. So, yeah.
And have you seen some uptick in discussions for expansion or talking with your current contracts?
I would say to a certain extent, but we've always been in very close dialogue with all the insurance companies. Sure. So it's not that we're waiting for them to call us. We are always in a dialogue. So but there is, of course, a huge pressure in the market for healthcare now when the corona situation is a little bit less acute, so to say.
And I think just lastly, I want to touch upon the deferrals of elective surgery that we've seen in all regions, basically amid the pandemic. And Just to get your feeling, also we saw the Swedish, the proposal of Swedish budget today of support of, I think, 4 billion for a recovery of the elective surgery. Any sort of comments from you, from your side on how you think this will play out over the next years?
We will have a lot of healthcare to take care of, so to say. And I think if you see an increased cost for healthcare, which I think the society will see, the best solution, in my view, is of course to use the healthcare provider who are most efficient and who has the best quality. And I think that's where we play an important role. We are very efficient, so you get a lot of healthcare for your money. At the same time, you can feel very comfortable that the quality that you get is extremely high. So we're in a very good position for that, I would say.
Yeah. Philip, thank you very much for joining us today.
Thanks, Victor.
Thanks.
Good afternoon. My name is Rickard Anderkrans. I'm a healthcare equity research analyst here at ABG Sundal Collier. So we're moving on with our agenda today, and I'm very happy to present the recently appointed CEO of OssDsign, Morten Hannevall. So without further ado, the floor is yours. Welcome. Thank you.
Thank you very much. Good afternoon, everyone, and welcome to OssDsign's presentation. Just before we get started, as Richard said, I just joined OssDsign the 1st of September, so I felt it was appropriate to share a few words about myself. So I'm a Danish native. I'm 43 years old. I've been in the game more or less 20 years, a little bit more, and actually spent the last 12 years in the medtech field, having various senior positions, not least with Zimmer Biomet, one of the orthopedic giants, where I had multiple roles. During my time, I've spent a lot of my time on what I call transformational leadership. So either in pure turnarounds or, more importantly, actually around growth acceleration. So that was about me. It's not about me today. It's around OssDsign. So I suggest that we move on. So OssDsign at a glance. The company started in 2011. We are about 40 employees today. And last year, we IPO'd. Essentially, what we have is we have developed a platform that shows much improvement in bone regeneration. Bone regeneration is a key topic across the orthopedic field because it leads to better clinical results. And what we also have now is we've proven it clinically across a number of studies. And most recently, we also published the studies that actually show that we can replicate the same thing outside the field we're in today. We did it in oral cavity. Still indication, but it shows that this is the platform we're dealing with. The company has consistently delivered high growth rates since we started to commercialize. Today, we have a commercial footprint in place. We have regulatory approvals. We have sales forces, either direct sales forces or distributors in all key markets, and most notably in the US, which is the most important market for OssDsign. And what you hear me talk about a lot today is growth, and it's growth acceleration. And that's the thing I would like you to take away from this presentation is OssDsign is around growth, and it's around growth acceleration. If we just take a little bit step back and look at where we're coming from and that brought us to today, then you can see the movement has been quite fast actually in the company. But I do want to draw your attention to the fact that in 2018 we announced that we had done 500 implants, but only a few years later, that number, which we just communicated this morning actually, is now 1,000. So I think that's a testimony to the acceleration and the growth that we're seeing and the underlying momentum we're seeing in the business. Today, we operate in the orthopedic industry, but specifically in the CMF, and our addressable market today is a subset of the market. But it's a very attractive niche. It's worth about, give or take, $500–600 million. It has underlying volume growth. It has good pricing. So we feel comfortable actually where we are. We can grow in the space that we're in today. But it's also very clear that we have a number of opportunities, if we wish to pursue them, to go into adjacencies. We can either develop the technology platform, as I said earlier, or we can use our established commercial footprint and the infrastructure to actually bring new products into the portfolio. What we are addressing today is a very clear unmet need. 10–15% of implants has to be removed today. It's an unacceptable high amount of patients, and the clinical outcome are clearly not as we want them to be. It's either caused by bone resorption or because the implant gets exposed or infected. But 10–15%, that is the average of actually unsuccessful outcomes today, and which is way too high in our view. So what we have developed is really a unique calcium phosphate composition that, together with the mesh, which is the titanium 3D printed, just generates it generates more bone ingrowth, and it generates better clinical outcomes. To deliver that, we have developed a bespoke digital platform that actually allows us to interact very, very closely with the surgeon from the very beginning, where the patient comes in, until the implant is delivered. And the outcome is very clear. We did a post-market surveillance study that we published a little under a year ago on almost 700 patients, and 2% of implants were only removed. So I'll just pause here. 2% of implant were removed. It's an X 5 to 7 compared to what we see in the market. So we think there's enormous potential in this product. And it has also been supported today by numerous publications in peer-reviewed journals. And those results has also allowed us to really build a strong key opinion leader network of people that want to work with us, that want to continuously prove that this is a good thing for patients, it's a good thing for healthcare systems. If we look at the portfolio as it looks today, then it's essentially 3 different categories. We have our patient-specific implants, where the cranial clearly is the dominating product across those products. We've also introduced what we call an off-the-shelf implant, which is the cranial plug, which has been launched just before COVID. And we think that that is an essential product actually to help us drive scale in the product, because in the business, because this is not something that is specific to any patient as such. It's really something that we can help to drive scale. And last but not least, as I said, we have the digital platform that really help us get those very, very good results because of the interactions and the close collaborations with surgeons. So one thing is the technology. The other one is the commercial platform or infrastructure, which is really paramount to the future of OssDsign. And that is one area where me as an incoming CEO is extremely proud to see what we have managed to achieve. So we have a full global footprint with regulatory approvals in place and sales forces in all key markets or distributors where they're needed. If you look at the US, we have 510K approvals. We have a direct sales subsidiary set up, and we have a number of what we call sub-dealers or partners across the country that help us drive sales. If we look at the US, we also have the regulatory approvals. We have a direct sales force set up in the key markets. So we have it in Sweden, we have it in Germany and the UK. And we have also started to enter the very important French market, where we're currently negotiating with a distributor to drive sales in the future. And in APAC, that's really around Japan. And this summer, we managed to obtain regulatory approvals, we managed to obtain reimbursement, and just some weeks ago, we also announced a very important partnership with a local company called Muranaka, which is an extremely well-known medical company in Japan. And together with them, we plan to launch the cranial PSI implant here when we get into Q4. So essentially what we have is we have a very strong sales engine in place. It's a sales engine that we'll continue to build on, and it's also a sales engine that allows us to entertain ideas of potentially developing or bringing in new products, because we have an engine that we can roll it out in. So it's something that I think OssDsign should be extremely proud about, and it's something that gives me as a CEO extremely confident in the future, because this is what's really important as we talk about growth acceleration. If we just deep dive a little bit on the US market, the US is and it will be the most important market for OssDsign in the years to come. We've seen good growth rates, In particular, since we went direct last year, we're really a peak in Q1 this year, or Q1 before we got hit by the pandemic. We have a very focused strategy by design, so we've targeted 10 states across the country with some additional metropolitan areas of particular interest. And those we serve, as I said, with our direct sales force, together with our multiple partners that we've signed. We are also working very, very heavily together with key opinion leaders in the US. Bringing in new products, bringing in new technology into an American market, it's crucial to have support from surgeons and you know, not just many, but also the strong advocates that we have. And that is something that I feel we've managed to build. We'll continue to build it. To me, it's not something that never stops. We will continue to build that key opinion leader network that really drives the support for the OssDsign products in the years to come. If we take a look at how OssDsign is currently performing and has performed historically, then we've delivered constant high growth rates throughout many quarters and several years. And we have a very strong underlying momentum, as you can see in the chart. Around the Q1, Q2 in 19, you know, something happened probably because of the IPO, and it took away a little focus. But in Q1 this year, you saw that really accelerated spike in sales, which is a direct result of some of the investments that were made, in particular in the US organization earlier this year. But of course, we've been hit by the pandemic like most other companies. But also have to say that the recovery that we are seeing is actually fairly strong. And without going into too many details, what we're also starting to see here, see throughout Q3, that is also a continuation of the trend that we are showing here. And just to give you an example, so in Germany, we've had an extremely strong recovery, most likely simply because that Germany was one of the first countries that started to open up access again to hospitals. So we feel that Germany is a good proxy as we look into other markets in the world and when they're likely to open up and what we can drive when they do. So strong confidence in the underlying momentum in the business right now. If you look at what our strategic priorities are right now, then it's very clear, it's growth and it's innovation. We have some very distinct regional strategies when it comes to the commercial entities. In the US, as I said, it's really about building market share deeper into the accounts, building more accounts, building key opinion leader network. For Japan, it's around launching our first product, which is the cranial PSI, and then simultaneously, we will continue to work with the regulatory bodies to also make sure that we get reimbursement for the cranial plug product. For EU, it's really zooming in on the key markets. So it's Germany, it's UK, and it's France. Those are the key markets, and that's where we will put our time and effort. But kind of irrespective of which region we are talking about, we also have some priorities, most notably around driving clinical data and health economic. When you're a new, relative new company at least, and you're bringing in novel technology, novel way of doing things, then in order to get surgeon support, you need clinical data, and you also over time need to demonstrate how it impacts the wider society with health economic data. So that is something that is a key priority and something we will continue to focus on for many, many years. We will also look into expanding our portfolio. You know, as I showed it, we have a number of products there. It can be homegrown or it can be brought in, but we have a technology that we know has the potential to go into new areas. We have a commercial platform that we also know we can leverage to launch new products. So we will continue to grow and expand the portfolio when we see meaningful opportunities. And last but not least, as we're getting more and more volume in the business, making sure that we we keep driving margin improvements, that we keep an optimized, smooth business that doesn't have excess cost, because excess cost means we can invest less in the business. So we will continuously look at ways to optimize our margin also as we get more and more scale. So in sum, what are the key reasons to invest in OssDsign? As I said, OssDsign is a growth case, and it's around growth acceleration, and I feel we're extremely well geared to do that. We have a proprietary technology platform that serves a very clear unmet need in the market. It's clinically proven. We also now have indications clinically that it can work outside the area or the focus area we're in today in CMF. It's a very attractive niche. We have the global regulatory approvals in place. We have the commercial infrastructure that allows us to leverage new investments or opportunities that may arise. We also have a proven track record, and I think that's important as a relative young company, in particular towards the investor community, that you continuously deliver on your promises, and I feel we've done that. And we have a proven track record that when we invest, we also see the payback. And then I think we've worked extremely well through the COVID-19. I mean, it hasn't been easy for everyone, but I actually feel that we're seeing a very strong momentum, both when we report numbers as we just did in Q2, but also when we look at the underlying cases that run through our company. So those are the key reasons really to invest in OssDsign. It's an extremely well-geared growth company for the future. And as a final remark, I just want to remind everyone about what the vision of OssDsign is, and that is to be the global leader in regenerative solutions for bone repair. That is our vision. So with that, I want to say thank you very much. Hope it was inspiring for you, and thank you very much.
Great, thank you, Morten. So we'll move over to some Q&A here. So first of all, you mentioned Japan has obviously been an important milestone for the company here, getting all approval, reimbursement, and a partner in place. So could you talk a bit more about your recently appointed partner, Muranaka Medical, and perhaps also pivot into the steps that are left to really unlock the long-term potential for the Japanese market?
Yeah, I think maybe I'll start with the steps first. I think as at least those of you that work in the medical field know that it's a very long process to actually get regulatory approval in Japan. So to me, we've overcome the big steps. It's also not easy necessarily to find a distributor. We also managed to do that. So I think we've overcome the big steps, and I'll come back to where we see the future. Regarding Muranaka, it's an extremely well-known Japanese company. It has a long history in the Japanese field. They have worked with multiple European companies on the entry in Japan. Very strong network, and specifically in the field we are in, which is around working with neurosurgeons. They are probably the ones to work with because they have an extremely strong network and key opinion leader network, not least when it comes to neurosurgery. So we're extremely happy, and it's obviously not my credit, it's the team, but I think it also says something about OssDsign that you managed to get a partnership with such a well-known local company.
Yeah, it sounds like an interesting platform for growth in Japan. So looking over in the US, are you happy with the progress currently in the US? And you have an ongoing launch of the volume product cranial plug going on as well. How is that launch going? It would be interesting to get an update for the US.
I think happy is a difficult word to talk to when we're in the middle of a pandemic. So of course I'm not happy with the absolute numbers, because if we hadn't had the pandemic, as you saw in Q1, I think sales would have been much higher than what we were able to report in Q2. I think having said that, we're seeing a very strong underlying momentum in the business. The cranial, we are approaching close to 100 VAC approvals, which is basically a license to sell. So we're really broadening our scope. We are signing more partners, and we have more key opinion leaders. So that I'm extremely happy about. And with cranial plug, it got launched just before we got hit by the pandemic. some really good signs, some great interest from the market. But of course, that's something that we'll have to kind of, as the market opens up, we'll have to relaunch in a way. So that I'm extremely happy with, but I will expect a lot more from the US in the years to come.
And also you mentioned it in the presentation, but OssDsign Facial is obviously very an interesting product niche as well. How is that launch progressing? Because there has been some reformulation and things going on with that product.
Yeah, I think OssDsign Facial is an extremely interesting product because it has many application areas actually in the face. It can be used for multiple purposes. I think when it comes to the facial implant, it's clear we need to work a lot more with the surgeons, and we really need to work with the surgeons to generate clinical data. So we see exactly where that product is best suited, also within kind of the context of a face. But it has a great technology. It's extremely novel. It doesn't exist in the market, but the big launch is just not around the corner. There's more work to be done, I think is the answer.
And as a final question, so what are your key priorities now for the next 12 to 18 months, and how will you balance this sort of pivot between focusing on very high sales growth and focusing on reaching positive cash flows? How will you balance that, and what are your priorities now?
I think I also tried to talk to in the presentation. To me, the very, very clear objective is growth. We are a growth case. We operate in a very high margin area with good pricing, good underlying volume growth. So the most important for us is to drive revenue, because once we drive revenue, profitability will follow, cash will follow. And if we see meaningful opportunities to invest in the business, to drive the business forward, we will be pursuing those. Rather than necessarily getting to a break-even point. I think it's much more important to drive a growth company here.
Great. So thank you very much, Morten, and thank you for all the viewers.
Thank you.
Good luck. So good afternoon. My name is Rickard Anderkrans. I'm a healthcare analyst here at ABG Sundal Collier. So our next speaker is Andreas Andersson, the CEO of Intervac. So without further ado, I will leave the word over to you. So thank you very much.
Thank you, Rickard. Thank you for having me, and thank you for listening in. I'm going to give you a brief introduction to Intervac, and then I'm going to focus on an update on all the exciting things that have been going on this first half year in 2020. So let's start. So Intervac, we are developing modern vaccines within animal health, and our lead product, Strangvac, is about to go into commercial phase here during next year. So we're in the regulatory phase now. Animal health as a sector is showing resilience in this COVID-19 pandemic. There are some easy to understand growth factors on the companion animal side, cats, dogs, including horses. We're spending more and more money on our pets. And at the same time, the demand for animal protein globally is also increasing. So those two fundamentals are making the sector grow with 4 or 5%. You also have the introduction of new technologies and new ways to treat our animals, which is also driving the sector. Vaccines are in the center of this growing sector, and it's growing a little bit faster. And the reason behind that is as governments want to reduce the use of antibiotics, especially within livestock, in order to combat the growth of antibiotic-resistant bacteria. Then when they implement regulatory measures, the use of antibiotics is reduced, and then the infection pressure increases. And when the infection pressure increases, the demand for vaccines grows. So the vaccines are growing a little bit faster, so 6 to 10%. And so that's the sector we're in. We have a pipeline of vaccines, and with the lead product and Strangvac, now in the regulatory phase, we are developing those vaccines using the same technology platform based on fusions of recombinant proteins. And we do this together with 2 excellent Swedish universities, the SLU in Uppsala and the Karolinska Institute in Stockholm. And we've been working with those research groups for decades. We have an intention to go global with our vaccines, and we'll go in and look a little bit closer at our commercialization strategy. We're a public company. We're traded here at Nasdaq First North in Sweden. So let's look closer at Strangvac. So this is a multi-component fusion protein, a subunit vaccine. It has an excellent safety profile. It has a very good protection, up to 94% efficacy, and this is shortly after the 3rd dose. We have shown a minimum of 12-month memory cells. So this enables you to have an annual revaccination program when you revaccinate annually or more frequent. Also very important is that this is an intramuscular administration. So this is a very easy way to administrate this vaccine and the way that veterinarians prefer to administrate the vaccine. There are other vaccines against strangles on the market, but these vaccines have limitations, mainly in terms of safety and administration. In some cases also in terms of protection. So what you need in order to reach a global market and get high penetration for a vaccine is that it's safe, it's easy to administrate, and it has good efficacy or good protection. And Strangvac has that. And therefore we can meet this global market, and it's a large unmet medical need. That's why Strangvac is a game changer in the fight against strangles. Now, let's look at the disease that we are fighting. Strangles is an equine disease, horses, and it's the most frequently diagnosed equine disease in the world. It's a very serious disease. It can be lethal, so horses can die from the disease, but most often they survive. It's highly contagious, and it has devastating effects when you have an outbreak. When you have an outbreak, you have to isolate the whole stable. And how long varies from country to country, but in Sweden, after the last horse is declared to be infection-free, healthy, then you still have to remain 3 weeks in isolation. So this is a process that often takes several weeks or months, and it's very, very expensive. And how frequent is this disease then? Well, it's very frequent. So if you compare to equine influenza or horse influenza, that is one of the diseases that we vaccinate against most frequent. In Sweden, around 60% of the horses vaccinate against horse influenza. So then in Sweden, you have a handful of outbreaks per year. As an outlier year, maybe 10 outbreaks of horse influenza, but most often less than 5. And in case of strangles, you have around 100 outbreaks per year, 60 to 120. So it's a much bigger problem. And the reason is that today we don't vaccinate against strangles, which we should. And the reason is that the vaccines available do not fulfill the criteria that vets demand in order to recommend and use this more widely. But our vaccine do. So it's a great medical need, and it's a great market for us. And there's a lot of disease here that we can prevent, a lot of suffering from the horses that we can prevent. Now, taking a look at the global market, because this is a global disease and a global problem, there's about 60 million horses in the world, and about a third of those horses are in what we define as our primary markets. So that would be Europe, North America, Australia, New Zealand, Middle East, a few countries like that. So roughly about a third of those 60 million horses are in those, what we call primary markets. And within those markets, 30 to 60% are medicated horses or see a vet regularly, so you have a sales channel, so you can introduce a new vaccine. And they're often in a vaccination program today, most often then against equine influenza. So if you talk about round numbers, maybe half of those 20 million, so it's 10 million horses is an accessible market for us where we target first. And now we are aiming at the whole global market with this vaccine, but I think those 10 million horses is a good first target market. Now, when a horse goes into vaccination program like the one with Strangvac, where you then frequently, at least once per year, revaccinate. You enter into this vaccination program and the horse stays in this vaccination program, most likely for the rest of the horse's life. So from an investor point of view, it's recurring revenue. You build the market, you go through the regulatory process for market after market, where you can then sell them the vaccine in those markets, and you penetrate the market and you build access to those horses, and you get a very predictable, good growth curve. So that is the future we're looking into with Strangvac. Okay, so that was a brief introduction. So I think many of you have heard about the Intervac before. So let's look at the past 6 months, the first half year 2020, and the Q2 report, or the half-year report that we released, and talk a little bit about the highlights of that report. So we have a very strong cash position. We're continuing to strengthen the organization in preparation for this commercial launch. Let's look at the regulatory process in Europe, and also we're looking at other markets, and where we are with other projects in our pipeline. So just before midsummer, we had a very successful directed share issue. We took in 147 million Swedish crowns, so that's roughly 14-15 million euros. In the Q2 report here, we had then roughly 170 million Swedish crowns in the bank. So it's a very good cash position. The reason we took in this money is that during this regulatory work with EMA and in the discussion with different distribution partners, we have seen that we could do the regulatory process in the US ourselves if we had the financial muscles. And the board took earlier this year a decision to go for that. And if you do the regulatory process yourself, then it's easy to negotiate a distribution deal instead of maybe a license agreement. So we don't close any door, but with this money, we can then focus into more to the regulatory process also outside of Europe. And it puts us in a much better position to get more of the revenues from the future sales of Strangvac. So I think that was a very, I think the absolutely right decision, and it puts us in an excellent position for a global launch and expansion. We've also continued to strengthen our organization. We can first take a look at the board. We had 2 new board members that joined Intervac here at the AGM. You have Nils Holk and Ed Thor. So both of those individuals, they add more knowledge and competence about the sales and within animal health and marketing and the global animal health segment. So Nils has a background primarily from the Scandinavian market, so he can help us a lot in building that organization and strengthening that on those very important direct markets. And Ed was part of the management buyout team that created Detta Veterinary Products, that is now 9th or 10th biggest animal health company in the world. So both those individuals add more experience to the board in those aspects, which is great. They can be very supportive in what is now ahead of us in our global expansion. On the management team, Dr. Andrew Waller joined us as Chief Scientific Officer. He started 1st of July. Our previous Chief Scientific Officer, founder, Dr. Flock, he's still within the company, and he's very passionate about the research, and he will continue to work on that research together with Andrew. But Andrew also adds a lot to the research projects. He comes from a background of heading bacterial research at Animal Health Trust, but he's also very known within the equine disease world. So he will be instrumental in helping us with the key opinion leaders and in the launch of Strangvac. So this is a great addition to the team, both for the R&D side, but also on the commercial side. So fantastic to have Dr. Waller with us. It's also a lot of enthusiasm and strength. So that's a good addition. Look at the regulatory process. Most importantly here now, Strangvac, we're on track with the EMA approval. So clinical trials are completed, the commercial scale manufacturing is completed, the dossier now was submitted beginning of the year, so we submitted this end of February. EMA validated and confirmed that the dossier had been correctly submitted on the 18th of March. So the 19th of March was day 1 in this scientific evaluation period. And our estimate is that this process of the scientific evaluation period is roughly a year, plus or minus a few months. So we are on track, and that's really good. Let's take a little bit closer look at this part of the process. So what we're doing now is that we're asking for market authorization for Strangvac in the EMA region, which covers on the European Union, plus Iceland, Norway, and Liechtenstein. Also very new is that the UK communicated here in the beginning of September that they will also recognize the market authorization holder process for within Europe up until January 2023. Now this is very new, but as far as the communication is so far, then this approval will also be valid then in the UK. The process step that we're in now is then the scientific evaluation, and if we look a little bit closer on that, so the day 1 was here in the 19th of March. We said roughly around a year for this process. We now in phase 2, so we have received the first set of questions, and we're now handling those questions. And then it's a dialogue with EMA for approval. After we have an opinion from the CVMP, then the European Commission then has to approve this or give the approval, and that takes roughly around a month, maximum 67 days. And after that, you can then start to sell in this region. Looking at the, we're also looking at the US regulatory process, and it's similar. Here it's maybe a little bit more interactive. You submit a plan to the CVB, which then they have feedback on. So that's the next step. We have initiated contacts with consultants locally and local labs that can help us with this. We foresee that we are going to have to do some local studies, mostly likely safety studies in the US on American horses. It's also likely that we maybe have to do part of the production locally, so the last part, the fill finish or the complete drug product is likely that we have to do in the US, but that remains to be seen. The whole process here we estimate to 18 to 24 months. So we will keep you updated how it's going on that, but we're very happy that we're taking this decision to go for the regulatory process in the US. Now, our commercialization strategy now is that you can sell direct, you can go with a distribution agreement, or you can go with licensing generally. And now our main strategy is to sell direct in our direct markets here in Scandinavia, and then a distribution agreement that has always been the focus here in Europe. And now with the when we're doing the regulatory process in the US ourselves, that is also the main strategy for the US sales as well. So that gives us a bigger part of the revenue. So that's now the strategy, and we intend to go global with Strangvac. Very short, as you see, this is a lot of focus on zoonotic diseases and vaccine development in general. So we get a lot of support from governments, and we're happy about that. And it's an important task to fight those diseases already at the animal health stage. And the technology we're using is those fusions of recombinant proteins. That is one of the main benefits of this is that the vaccines that you produce are extremely safe, and it gives you an excellent safety profile. And this is really, really important when you're rolling out the vaccine globally, and you want veterinarians and other key opinion leaders to recommend this vaccine. So all our vaccines are based on this type of technology. It's also very productive. So in each production run, you get a lot of antigens. So for each run, we get for several million doses of antigens. And then you use those antigens to put in vials and do the last part, the fill finish. Looking into our pipeline, our lead product, Strangvac, is now in the regulatory phase. And our next in line, we have a Streptococcus suis project that is targeting Streptococcus suis at pigs, and a Staph aureus project that is targeting dairy cows, or Staph aureus infection in dairy cows. And if you look at those, both of those projects are more in a preclinical phase. So we are still discovering more of what components we're going to use, what fusions of recombinant proteins we're going to use to make those antigens. And for piglets, we have continued to test those candidates in piglets and sows. And for the Staph aureus project, we have so far tested in rabbits, and now after summer, we're going to start to test in cows. So both those projects are progressing very well, and it's very, very interesting. But that's all I can say at this stage. So please keep following us on that. We had a publication in Vaccine. Published data is very, very important for us. It gives us a lot of credibility. This is open access, so you can log in and read those reports yourself. So this is about then the scientific advances that we did for Strangvac. To sum up, really strong momentum, great cash position. We're on track with the EMA approval. We're preparing the commercial launch for Strangvac in Europe. We are also now starting to prepare the regulatory process for the US market. Our R&D project that's based on the same great technology, the same partners are progressing as well. We're taking the next steps here. And we're now in a position where we get a lot of attention for our progress and our success, and we can attract international talent, both for our R&D projects and for the commercial launch. So it's a great position to be in. So thank you for listening in, and thank you for this, the faith that you're giving us in investing in Intervac. So with that, let's open up for some questions.
Yeah, thank you, Andreas. So we'll move on with a short Q&A session here. And first of all, you mentioned in the presentation that you're now into sort of the second phase here of the regulatory process here with EMA. So does that then imply from the first round of questions that they do not require any further investigations for Strangvac, or in the number of vaccinations or ponies or horses vaccinated?
Right. So it's difficult. You know, we're a public company and so on. So it's difficult to go into too much details. But we don't see any showstoppers, and we are on track with the timeline that we have communicated. So by that, there's no questions there's nothing in the questions of EMA that makes us deviate from that. You know, like that would be if they would ask for challenge studies or something like that. It would take us. So we can't keep this timeline. So there's a lot of questions, but there's no showstoppers, and we are on track. So that's I think that's a very positive message to the listeners.
Great. And obviously a big next step for Intervac here will be the potential distribution or partnership agreement here in the future. So do you have any news there, and do you expect to get that potential agreement in place before potential approval here in Q1, Q2, or how should we think about the timing, and what are you aiming for at least?
Yes, I understand. So it's always difficult to give exactly timelines, but I think those discussions for the distribution agreement in Europe is progressing very well, and they have progressed during all this time, and we have great potential partners that are very interested in distributing this vaccine. And I think the COVID-19 pandemic March, April, when it was all new and very that kind of prolonged that process a little bit, because those larger companies, the top management there, you couldn't access them. But then it came back, and it's now back on track. So we're in a position where we're not going to hurry. There's no reason to wait either. We just want to get the best possible agreement with the best possible partner, and that's what we're working on. And I don't want to put a timeline on it because it's one of the things that we have to be very careful on how we communicate, being a public company and all. But it's going very well. I'm very happy with the progress, and I'm convinced we're going to have a good agreement in place.
Great. And you're looking to ideally find one global partner, right? If I've understood it correctly, or are you willing to?
So right now we're focusing on from our perspective, we want to focus on the European market, so we don't necessarily need a global partner, and we're for our perspective, we want to. I think it's we're not closing any doors, but it doesn't necessarily have to be a global agreement at the once. We can take continent agreements or that size.
Okay, interesting. So also looking at the pipeline projects here, you said that you were quite restrictive on what you can say and at this point in time, but it would be interesting to hear if you can say anything about the time for development, and perhaps compare that to Strangvac and time to market and development costs, and if you could say anything in comparison to Strangvac.
Sure. Yeah. So Strangvac took several years to develop, maybe decades if you look at that. But that was because the technology really developed at the same time, and now the production partner is in place. The technology is really advanced and developed. So there's and vaccine development is going faster and faster. So in that aspect, I think that we're not talking decades, we're talking years. Now you can never predict when you have the breakthrough. So I think we are within the bacteria that we are really, really good at, and the teams are extremely experienced in this, and we're using the same technology. And I think what we can communicate is that we're doing those tests. And now in the Staph aureus project, we're taking, at least we think it's promising enough that we've gone from rabbits to cows. So I think that's a sign. But I can't say much more than that. We need to get the strong immune response to take it to the next level. And it's going to go faster than Strangvac, but it's difficult to say much more than that.
So right now, a hurdle, if you will, for these projects will be to find the correct formulation and the combination of these recombinant proteins fusioning. Yeah. And just as a final question, given the recent capital raise, do you expect this capital raise to fund the company until reaching positive cash flows going forward, or how should we think about the financing need here for the coming years?
Right. No, I think we have a very strong cash position. So I think that I think that we're fully funded for what we foresee now, and that would be included be cash flow positive. Then you never know what can happen if we have something really promising and there's a big cash need. I'm not going to close any doors to that, but for Strangvac and to go to become cash flow positive and to get this to market, I think we're very well funded. So that's, we're in a great position there.
Great. Thanks again, Andreas, and thank you all for listening.
Thank you for listening.
Best of luck. Thank you.
Thank you.
Okay, we'll get going with the next presentation here at our office today. We have the honor to have Handicare with us, CEO Johan Ek and CFO Pernilla Lindén. A warm welcome to you guys, and please go ahead with your presentation.
All right. Thank you very much. Good to be here. My name is Johan Ek. I've been the CEO of Handicare now since April this year. Prior to that, I was a board member from 2014 and onwards, so I know the company quite well, and I stepped in this spring, as I said. Today, what we have in store is a short presentation on Handicare, and then we hope to get a nice Q&A session at the end. What we thought we would walk through is first give you the key investment highlights as we see it from the management side. After this, talk about the very good structural growth that we have had over the past several years and that we also foresee to have in the future. After this, I will go through a little bit the operational priorities that we have in the business right now, after which I will reintroduce Pernilla and she will be talking about the financial development of the group. But just perhaps before we start, I just wanted to give a short introduction on the company for those of you who perhaps don't know us so well. So Handicare last year had revenues of some 230 million euros. The bulk of this is coming from the business that we call accessibility, which essentially is a stairlift business that is a product and a solution catered for the elderly population that allows them to stay longer at their homes with their loved ones, as opposed to perhaps ending up in institutional care because they have problems with their mobility. So these products allow you to live longer together with your loved ones, with your family, and stay in your beloved house for as long as possible, even though you get mobility disabilities. So that's the biggest portion of the business. The second portion is the patient handling business, which also is dedicated to creating independence in the mobility of our customers. This can be in a home environment or in a hospital environment with different type of lifting devices that we produce and solutions that we offer. Finally, we have a vehicle accessibility business, which is dedicated also for people with mobility needs in getting in and out of the vehicles. Clearly today, the biggest business is the accessibility business, which is the stairlift business. It accounts for 70% of all our revenues, for 90% of all our profits, and is also the clear focus area for the group. If we look at the geographical spread of the business today, some 70% of the business is from the European markets, 30% from North America. And in the accessibility business, which is the biggest and the fastest growing business, we have a very clear number one or number two position in Europe. We are a number 3 or a number 4, so a bit more of a challenger in the North American market. But I'm very happy to say that this has, for the past several years, been a market where we have had double-digit growth, and this we are very determined to continue. So we believe that the North American market is a particularly interesting one for the accessibility business. On the patient handling side, we are solely focused on North America today. So Canada and the United States, where we have a number 2 position in Canada and a number 3 to 4 position in the US. Vehicle accessibility is only a Norwegian business today, where we are the market leader. I promised to talk about the investment highlights, and I think the first one, which is important to understand, is that we have, over the past several years, had a very kind of strong underlying growth trend in the accessibility business. We are quite convinced that this trend will continue, and I will in a short while go through what the driving factors of this growth are. So it's just important to understand that in the key business, very good organic growth opportunities. These are very well intact. On top of that, there are also inorganic growth opportunities when we look at potential add-on acquisitions, etc. Secondly, we believe that we have created now a platform which has good operating leverage, which means as we grow, the margins will improve even further than the growth rate. This platform that we have built has been now trimmed even further thanks to the Lift Up program, which I will shortly talk about. So we believe that as the revenue comes back, there will be good margins coming out of this growth. Also, we have over the past 18 months showed that we really mean business with our focus. We are divesting and moving away from areas that we deem to be of lesser importance and less attractive to us, and we are focusing on the areas where we feel that we have the highest return. Clearly, accessibility is one such area. The geographical focus is also clear. It's Europe, it's North America. Now, on the accessibility side, since we have been in this business for decades and decades, we have a very strong brand name, we have a good quality, and we have a very good reputation in this market, and that is what we really want to build on for the next several years. As a result of the divestments that we have carried out, we have also strengthened the balance sheet. On top of that, we have good cash flow in the business. So I think all in all, these 6 factors here show a little bit why Handicare could be considered an interesting investment opportunity. It's also fair to say that we are a little bit in the midst of a transformation. At the moment of the IPOs a few years back, accessibility only accounted for 48% of the revenues, and you could say that at the time we had 4 businesses. Over the past 18 months, we have conducted a strategic review, we have divested businesses, we have scaled down businesses, and we have focused the growth on accessibility. So as a result of that, the accessibility or the stairlift business accounts for 70% of our total revenues, 90% of the profits, and this trend will continue. The reason for this is that accessibility is the fastest growing area, and clearly also when it comes to inorganic opportunities, M&A, etc., capital will be allocated mainly to this area in order to drive growth for the future. So you should expect the accessibility share of Handicare to continue to grow. It's not only about focus, it's also about improving margins and increasing the returns for Handicare and for you as shareholders. In order to get there, this past spring we launched a program called the Lift Up program, which is a efficiency program dedicated to really take stock on the fact that we are an accessibility company. So what we have done, we have streamlined the organization, we have cut down any type of duplication within the group. We were perhaps a bit organized like a conglomerate. Those days are over. We have streamlined resources, we have cut down on overhead, we have cut down on certain areas within patient handling, and we have put really all the focus on strengthening and focusing on the accessibility business. This was the first step of the program called Focus and Simplify. The second focus is to further improve margins by working on procurement, on a procurement program, working on select pricing measures. When this is in place, we will further have improved the operating leverage of the business. And after this, it's really all about pushing for more top line when we see that we have the really kind of a good operating leverage in the business. All these actions in total will yield an EBITDA improvement in 2021 of some 8 million euros. Since the program already is well on its way, we will already this calendar year see 3 to 4 million euros of EBITDA improvement for the 2020 for the year 2020. The restructuring costs related to this were also 8 million euros. Those were taken in conjunction with the Q2 report. And so the program is well on its way. With this, if we just then summarize the kind of priority areas, executing the program, the Lift Up program, priority number 1. Priority number 2 is to now put focus on accelerating growth within accessibility. Thirdly, strengthen the platform further, the operational platform. With this, we mean our factory footprint that we have. There is further automation steps to take. These we are carrying out as we speak. When this is done, I think we will already be in 2021, and at that time I think it's more interesting to start looking at activating some of the M&A dialogues and possibilities that we see, but this will most likely then be small accretive acquisitions in the area of accessibility. If you allow me, I wanted to say a few words about the growth, because I think there are not so many businesses that can look back and say that over the past 8 years we have grown organically 7% per annum. But within Handicare accessibility, this is a fact. Of course, now we have a COVID year, so this year will be an exception. But we believe that the past 8 years have been actually quite representative of the potential that we have in this business, and we expect this growth to come back. The reason for this growth increase and this good organic growth is that the demographic development, the share of elderly people above 65 continues to increase. That increases at roughly a few % a year. On top of that, there is a clear demand and interest on behalf of the elderly to stay at home for as long as you can, as opposed to ending up in institutional care. Also for society as a whole, there is a clear cost benefit in having people more in a home care setting, living in their houses as opposed to ending up in institutional care. All these are factors that are driving the growth that we have seen of the past several years. And as I said, we expect this to continue. And as I said, now with our Lift Up program, we expect this growth to come with better margins for Handicare as well. A few words about our operational priorities. We see that we have a good market growth backing us. Now it's all about making sure that we continue on this growth path that we have seen over the past several years. In order to get there, we need to continue our efforts to work on kind of facilitating the fact that it's easy to do business with Handicare. This can be by way of digitalization, by way of cutting down further on lead times, by really kind of being the preferred choice of our dealers, of our customers. We also want to drive dealer growth. There are still areas where we have a bit of a white spot on our map, where we could be more present, where we could have more dealer coverage. This we are working on. I think the product suite we have as such is quite complete and good, but as always, there are some areas where we want to improve as well. And finally, and I think this is very, very important, we want to win in the US, and I'll tell you shortly what this means for us. The US, for the past 4 years, has been a fantastic growth story. We've been growing 17% CAGR over the past 4 years. This is a great number, and we hope and we are determined to make sure that this continues. In order to do that, we need to continue to expand our dealer network. We need to continue to kind of in a structured way work with our dealers so that we really build them up and we make them successful while working with us. We also need to grow further in a couple of the bigger customer portfolios in the US, such as the VA. And I think importantly, we need to make sure that we can compete on equal terms on the US, which means that we need to offer exactly the same type of short lead times that the competition can. And this is the reason why the board took the decision in June this year for us to establish local production of stair lifts in the US next year. So when we come to the summer of 2021, we will have own production on the US soil. With that, I will hand over to Pernilla, who will walk through the financial highlights, and then we are happy to take some Q&As.
Thank you.
Thank you.
So if we're looking at, since our IPO, we have not reached our financial targets regarding revenue and profit, but we have reached our target when it comes to leverage.
Regarding the revenue, we've had a CAGR of 3% over this period in the total Handicare group. But as Johan has said before, the accessibility business have been growing with 7% over this period and is our focus area going forward. If we're looking at then Q1 and Q2, we had the COVID-19 effect coming in the end of Q1 and severely hitting us in Q2. And we can see a clear link to where the lockdowns have been, where we have had a reduced revenue. So in Q2, we had a decline of overall organically with 32%, but over the quarter it has improved, and we see an improvement as communicated in the Q2 reporting. If we're looking at overall what we've done as well, Johan was talking about the Lift Up program, a very important program to improve our profit and also an important program when it comes to the focus of delivering on our accessibility business going forward. When we started this program, we had to look at a representative base. So we took the second half of 2019 as a starting base as we started to do activities in the first quarter of 2020. And we have done then 8 million of sustained savings, and 90% of those is already implemented now by the end of Q2. So 8 million in sustained savings that will have a positive effect on our margins going forward. Last but not least, I talked about our leverage. And leverage has been in line or better than what we have had as a financial target. And this is results of two things. It's about our focusing on the operating cash flow overall, operational cash flow. And by focusing on that, we have been able to have a good operating cash return, but also due to the divestment of those businesses that is not in the focus area. We have a strong financial position, which by end of Q2, we had 55 million in cash and an unutilized facility with another 37 million. So a strong financial position for us for the future. Thank you.
Okay, thank you, Pernilla. Why don't you stay here so
Sure.
Maybe we take questions if there are.
Absolutely. Thank you very much, Johan
Thank
and
you.
Pernilla. Thanks for the presentation. I'll start with a question regarding the growth we've seen within accessibility and how you've managed to secure really your number one position in core markets and as well as growing very nicely in the US over the last years. I think in recent communication with the market, you've been talking about not only sort of growing in your core markets with market growth, but also, I mean, really continuing to grow a bit faster than that.
Yeah.
What makes you so certain that you will succeed in this field?
Well, you can never be fully certain, of course, but if we look at history, I think we are offering bespoke products, which is, particularly on the curve side, which is a very product in high demand that is quite difficult to manufacture. We are offering that product high quality and with the shortest lead times on the market. And this is due to the high level of automation that we have in our production processes. So this has clearly been a revenue driver in the European markets. On top of that, we had a very successful launch of the so-called 1100 stair lift, which is a straight stair lift, also a very good reception from the market on that. So I would say that is one part of the answer. The other is that we have found a model where we work in a successful way with the dealers so that it makes sense for them to work with us. We don't lock dealers up to us. They are allowed to work with others as well, but we tend to get the bulk of their business because they are profitable working with us, and we kind of have a good win-win model that we have built up over many, many decades of work. So we have a very low churn rate on them. They are happy working with us, and they are essentially the key sales force. So good sales force, good kind of structure in that combined with quick delivery times of a high quality product. That might sound cliche, but that's what it is.
And that's your main route to market at the moment, and will continue to be so going forward as well.
And I think also looking, when we talk about the US market, it's the same thing. We want to replicate this model, and we want to have local production in the US to be able to offer the product on similar terms as we do in Europe today.
And I think a very interesting point here is that you've gained a lot of traction already in the Lift Up program.
you communicated to us that 90% is already implemented of your first part. If I may look into the second part, the profitability side, if you could give us just a few comments on what you've accomplished so far, and how that is going on at the moment.
I mean, just to be clear, we gave that number 8 million euros. That is what you should have in your models when you calculate this. So we're not promising anything above that, but clearly, you know, the ambition is set that first delivering the focus and simplify, and then working further on procurement terms with our suppliers. That's in a very advanced, you know, many of those contracts are already in place. And now we are working then on pricing on certain of our product schemes. So also going well. So I think really we wanted to take ourselves into a position where when we come to Q4, much of this is in place, and then it's all about pushing for increased top line and getting good returns on that top line. So I couldn't be happier. We are exactly where we need to be, but I don't want to kind of oversell it. The 8 million is the 8 million.
But it seems at least as if you are sort of ahead of schedule, or at least in line with what you were hoping for.
Yes.
Yeah. And I think just really lastly from my side, looking at that you in conjunction with the capital markets update that you held in June, you remain with your financial targets that you had since the IPO. Just a question regarding how we should read that now that you're focusing even more so on accessibility and looking at specifically the organic growth target of 4 to 6% yearly. Given that accessibility now accounts for 70%, should we read it as if all that growth is coming from that segment, or how do you view patient handling now? We'll have to see what you will do with the segment, obviously, but also vehicle. If you could just give us some comments about that.
In general, you know, when we did this program, we of course made calculations on what effect we were expecting to come out of this. We felt that the financial targets we have in place, and I'm the first one to say that we have not met those targets to date, but that is a target that we have there, and typically, you know, it's a midterm target for the next 2 to 3 years, and we feel that with all the measures we have in place, we keep those targets. I think in a COVID year like right now, I mean, kind of top line is far away. We're working very hard to improve the margins. So I think all in all, the company is in the midterm set to hit those targets. Otherwise, we would have changed them. But, you know, I wouldn't want to speculate exactly on vehicle accessibility or patient handling, but kind of the totality should be able to deliver that in the midterm. Yeah. That's the reason we have those targets still in place.
Yeah, I think with that, I'll thank you guys for joining us today, and see you next time.
Thank you very much. Thank you.
Good afternoon. My name is Rickard Anderkrans. I'm an equity research analyst in the healthcare sector here at ABG Sundal Collier. So our next speaker today will be Bengt Baron from Enzymatica. So without further ado, I'm leaving the floor over to you, Bengt. Thank you very much.
Good afternoon, everybody. It's a pleasure to be here and to be able to present Enzymatica. I am the chairman of the board, and since it's the first time that I'm in this role, I provided a bit of background. Some of you have probably met and listened to Fredrik Lindberg, who has been the CEO for a couple of years in the company, but now is a board member. And his background is very much medical, viruses, whereas my background is much more consumer and brands. So slightly different, and therefore probably slightly different depth when it comes to detailed understanding of various aspects of the business. I've been involved with the company since December 2016 as chairman. Enzymatica, for those who haven't seen the company, have been close to the company before, very science-based company, lots of impressive PhD knowledge. We have a very unique enzyme R&D unit and manufacturing site in Reykjavik, Iceland, which is sort of the home base of the research efforts, whereas it is head office in Lund in southern part of Sweden. First major product is ColdZyme, which is the cold spray that is still leading the charge, and I'll come back to that pretty soon. And it was CE marked in 2013, and both for prevention and alleviation of the common cold. Listed the company on First North in Sweden in 2015, and as I mentioned, head office in Lund in Sweden. It was launched in Sweden in 2013, and it has actually climbed consistently up in the rankings and is currently ranked as a third largest in sales product in the Swedish market. Currently, it's available and being sold in 15 markets around the globe, primarily in Europe, and in addition to South Africa and Hong Kong. In 2019, the annual sales was 61 million Swedish kronor, but it's a high growth company, and I'll come back to the financial numbers in a sec. The heart of the company is ColdZyme, the oral spray that protects against common cold viruses. It can help shorten the duration of the common cold if used at an early stage of the infection, and alleviates the common cold symptoms and soothes sore throat. These are the claims that are supported also by our CE mark class 3, which was just renewed. The uniqueness is the way it acts, is that it creates a barrier that protects the oral mucosa with a glycerol film. And in that glycerol film, there is also active enzymes from deep sea cod, Penzyme, which actually deactivates the viruses and therefore prevents them from attaching to the pharyngeal cells. And I think this is extremely important because this is the first cold product that actually does not act on the symptoms, and it's not the symptom reliever, but it's actually a product that addresses the cause of the common cold, i.e. the virus, and actually deactivates the virus and thereby makes a difference. And this, to me, is the heart and soul of what we do and where we differ ourselves. Of course, lots of research in these areas. We have a number of studies that support that it can shorten the duration of a common cold. We just published a double-blind placebo study. We have done a number over the years. 4 of them are more major, and they consistently show the same thing, which are the 3 statements that I made earlier on. And also, we have tested it quite broadly. This is from results from in vitro studies, where we tested the product versus the most common different cold viruses, where we deactivate up to 99.9, but typically above 90% of the viruses in vitro, which is quite impressive and unique, I would say. And of course, in these days and times, there's a lot of interest around the COVID. And we also did an in vitro study that we published the results from as well, where we actually could show that we deactivated 98.3% of the viruses in vitro. Also very important is of course, the belief in the product and the support in the product. And here I put up a number. It's quite a busy chart. The message is quite straightforward, which is that this is the most recommended products if you go into pharmacies and ask pharmacists, what product should I take versus cold? Regardless of which pharmacy you go into, the most recommended product by the pharmacists is ColdZyme. Also, we do a number of surveys with consumers where we consistently get very, very high remarks for effectiveness of the product, trust in the product, and it's a product that I would recommend to others to use as well. And this is, of course, ongoing and making sure that we're tracking. This is a company that is under rapid development, and this is now the 2020, I would say, recent achievement. We're only halfway, a little bit more than halfway. But we have announced distribution agreements of a large player in Japan, second largest player in China, for products to be launched in 2021 and 2022. I'll show you the numbers in a sec, but we more than double our sales versus last year. Very exciting is that we got our patent prolonged. It's a new patent which covers our trypsin, which extends our patent protection to 2035, which is of course very important that it gives us time to build up the brand recognition, the brand strength, which in the long term, together with the product's effectiveness, is going to be the greatest barrier to entry and the greatest assets of Enzymatica. We have had a relationship with Stada, major player, and it's also very encouraging to see that they wanted to extend the partnership from the 3 markets we're working with them. Now we're added 19 more geographic markets for rollout starting in Q4 2020, most of them in Eastern Europe, but also including Italy, for instance. CE certification for our 3 claims was renewed. They reviewed all our documentation and made sure that we are up to par. So we got the highest classification for medical devices, which I think is very reassuring and another quality stamp of what the team is doing and producing. I mentioned the ColdZyme's ability to deactivate SARS in vitro, 98.3%. We have published positive results from double-blind placebo studies, and very recently we also did a study on British endurance athletes, where we again showed that we could really reduce the length of the cold and also the symptoms and the soreness. So busy year, and we expect that to continue to be busy going forward. Financials, just a couple of highlights. First half year, doubled the sales, did it both in Q1 and Q2. So versus the last full year of 61 million, this year we have sold 40.7 million worth of products in the first 6 months. And we're still a relatively small organization, 18 people, rapidly improving our cash flows. And I will come back to the model going forward as well. And one of the reasons why I think Enzymatica is a very exciting investment proposition. Consistent growth is what we all like, and this is the curve is MAT sales going back to 2013, and it's been quite consistent with some ups and downs depending on when we have launched and had pipeline fill in the various major markets. So, but consistently growing in a very, very promising way. Growth strategy, we communicated this in 2019, very basic. We think we like to stay with basic because typically it's quite effective. Number 1, continue to grow market share in our core markets. Sweden being where we are actually doing the sales work and the marketing all by ourselves, which we do in Scandinavia. Just to have that as a showcase, and we continuously grow sales as I showed you, and we are number 3 product by now in the cold segment. Of course, we're interested in geographic expansion, and so the Stardust of the world is very exciting. We signed up with a partner in Japan, we signed up for a partner in China, and we're ongoing, we're looking at additional partners, and it's exciting to see that the partners that are going with us, like Stada, continues to broaden the relationship with us and are seeing success in the marketplace. And then in the longer term, of course, we're always interested in new products. being it line extension. Here in Sweden, we launched a flavor variety strawberry, but we can also think about other applications of the barrier technology in the much longer term. Currently, we're quite focused on ColdZyme and our cold spray. And the desire, of course, is to build a global brand based on our unique active barrier technology. Why do I believe that Enzymatica should be a very interesting investment case? I think the themes are 5, quite appealing. Number 1, we are in a large global market. The cold has always been here, the cold will be here. Now it's been much more dramatic in the corona period, but the cold is here. It's a large market segment. We offer, as I mentioned, a paradigm shift in the treatment alleviation of the cold, as we are addressing the viruses rather than the symptoms. Technology is unique. It's patent-protected platform technology. We have strong claims. We are backing it up with clinical evidence. We are continuing to do research and surveys and clinical tests, and we will build that fact base as we go forward. It is a technology that we believe can be extended into new applications in the more longer term. It is a proven performance. 7 years of growth in Sweden consistently. It's not just 1 quarter here or 1 year. It's actually 7 years consistently. Very loyal consumers, attracting new consumers, but as I said, very loyal consumers as well. And as we're building the track record and as we are starting to roll out internationally with success, we're attracting a growing number of international distribution partners that showed interest in taking the product globally. We're a fully fledged medtech company. We have all the skills and all the expertises that we need in-house. It's not a large organization, but this is a scalable business. We have cutting-edge research and development. I don't think there's any company out there that understands more about the enzymes than our team does. And we have complete control of the change from the cod to the finished product. And maybe most interesting from an investment point of view is a very asset-light, scalable business model. It's a distributor-based model. In Scandinavia, we do it all the way to the consumer, but outside of Scandinavia, we work with distributors. And that allows us to expand much more rapidly, and it also gives us local knowledge, resources, and muscle to build the brands. And the production itself is outsourced to contractors. So I believe that these 5 fundamental principles makes Enzymatica a very, very attractive proposition going forward. And with that, I would like to open up for questions.
Great, thank you, Bengt. So moving on with some questions, I'm going to mix in some questions I've heard from investors and also from my side. So there's recently been some medial controversy regarding the in vitro results from the SARS-CoV-2 in vitro study, which was published previously and mentioned in your presentation. What was that critique based on, and what was the response from Enzymatica? What is your view on the situation there?
Well, I don't think it was in vitro. I think it was when we did the placebo, double-blind placebo study. Okay, I think the in vitro is quite straightforward. Okay. And there are some discussions on whether the results were impressive enough or not. We feel that they solidify what we've shown in study after study after study, that we shorten the cold and we alleviate the symptoms. So we feel that it's just one more block in building the fact base around ColdZyme.
And can you talk a bit more about the Japanese partnership? Has there been any delays in the discussions with the Japanese partner, or when are we on track for launch, and how are you? Can you say anything more about that opportunity and how it's progressing?
We're still aiming and we're still working for 2021. Of course, this is a lot of regulatory, making sure, testing the product, making sure getting the right applications in place. So it's a process, it's moving. So far, so good. No major bumps in the road. So we feel good about our ability to be able to launch in 2021.
And you briefly mentioned it as well, but you also quite recently at least announced an expanded agreement with Stada for Europe wide launch, I guess. And how should we think about the timing of that? Are we seeing that in Q3 already, or is it more of a Q4? And can you talk a bit more about that commercial opportunity and what it implies for Enzymatica?
Well, it's exciting. We worked with Stada for a couple of years in Germany, Belgium, and Austria. Now we're expanding, as you mentioned, 19 more markets, and it will be primarily Q4 where we'll see something in the numbers. So it's also about ramping up and getting everything ready.
Yeah, of course. And how are things progressing for trying to find a new CEO after Fredrik's departure? Very interesting to hear about that.
Well, I think the organization, I've stepped in a little bit more, and we have a very well functioning. So Klaus on the CEO, Klaus Ekstrand, doing the commercial part, Therese Filmersson on the CFO. So I think the trio is working well. So we can take our time to make sure we get it right. But of course, it's desirable to get the long-term solution in place. So we're working on it, but right now, there's so many things that are going quite well and progressing, and I'm very, very impressed with the way the team is handling. We're talking a rapid growth environment, and they're handling it beautifully. So we feel pretty good about where we are, but we'll come back when we have an announcement.
Interesting. And just as a final question, now heading into Q3, there has been some positive clinical data coming out. Have you seen this reflected in sales already? There's been quite a lot of medial interest in the product, and how, in light of that, how do you feel about your current cash position and funding in light of that as well?
One thing I've learned is I never make predictions. I never give forecasts or look out into the future. I think it's interesting. If you look at Enzymatica going forward, it's going to be difficult for everybody to predict. I mean, there's so many things moving. We're growing in our existing markets. We're adding new markets, which means pipeline 1 year, not the pipeline the next year. We are having behavioral changes right now, which means that maybe the cold season is going to be slightly lower than before, but we're adding new markets. So it's going to be lots of ups and downs. So I think we should really spend our efforts in explaining where we are, not getting expectations unnecessarily high, but always stay fact-based. And the problem when you start doing forward-looking is then you need to come back to what has changed and why, and then it becomes very, very complex. So we feel good about where we are. Consumers continue to be loyal and happy with the product. New partners are coming. So I think long-term, medium to long-term, we feel very, very good.
Great. So thanks again, Bengt. Wish you best of luck, and thanks for listening and watching. Thank you.
Thank you very much.
Welcome back to the ABG Investor Days. My name is Johan Braun, a retail analyst here at ABG. I now have the pleasure to welcome Kevin Kviblad, CEO of Urbit. The floor is yours.
Thank you, Johan. It's super exciting to be here to talk about Urbit and how our growth has become from the last quarters. I know it's the last presentation for today, so I'm going to make sure to keep it quite short and concise. So bear with me here. So the demand for high quality service has never been greater than today. And this is actually what's fueling our business. This is the trend we have seen for the past year and also been accelerated by Corona situation all over Europe. But before I go through the what is actually driving the growth, I thought we could watch a short video regarding what is Urbit actually and what are we trying to do. So simply put, our business model is to tap into existing ecosystem, partner with retail brands and logistic partners out there in UK and France, where we are operating today, to be able to perform deliveries, have an asset-light and eco-friendly delivery model. Basically using a crowdsource model to be able to deliver to the needs of the customers. What we have done is that we deliver best-in-class service with a customer satisfaction of 4.92 and also 99% delivery success for with the first attempt. So what is driving this? How is this possible? Our delivery assistants, as we call them in the crowdsource model, the Urbers, is the backbone of the service. They are performing deliveries by foot, public transportation, cargo bikes, or bicycle. That's actually the easiest and fastest way to access the urban environment. The recruitment process is that we are carefully recruiting and licensing and Urbers that we call. And only 23% of the candidates actually are accepted. The Urbers are guided by our Urbit support team and also constantly being educated regarding how to perform best service. And of course, when you're using a crowdsource model, it's super important to make sure that we have fair wages, we make sure that we have insurance, holiday pay, and pension for our Urbers, making sure that they can trust us and perform the great job that we are expecting them to do. So how is this possible? We have a platform that we use to monitor and enable these assignments that we call them. We have an API where our partners and platforms out there can integrate with us that enables us to trigger those deliveries. We have a consumer portal, as you can see to the right here, where consumers have full transparency over the whole process. They know when the product will be delivered to them, where, and by whom, who they can contact if there is anything that they need to be changed. So full transparency and flexibility. So last mile industry is growing, has been growing for several years, and actually been even more accelerated by COVID that we see that happening in Europe. So what is actually happening? We have the parcel boom. Basically, more and more people are buying online, and with that means more often purchase also. And with that also come the return process. A lot of packages is being handled and is increasing daily. On top of that, you have the customer demand, basically demanding speed and quality of service. It's not good enough to get your delivery a couple of days later, and you don't know when that will happen. So, and that is something that we see that the logistic companies are struggling with to perform the scalability to handle the parcels, but also the service quality. The third element is the ship from store that we also see. As you saw in the short video, we can pick up, and we do pick up from the stores. And this is something that has been discussed for several years within the industry, but actually starting to come in place during this year. Basically, retailers are looking for how to increase speed and cost efficiency by using the existing store networks and inventory they have and the store personnel, and taking the shortest distance from the product to the consumer. And this is where the stores come in. So timing, everybody talk about timing. Timing is crucial for businesses. You have to be lucky or just make sure that you actually find the spot there. And timing is now for logistics. And we have, Urbit has shown a proven record that we have a position play. The elements that we have proven ourselves is the scalability. The model is highly scalable. We have expanded to new cities within 3 weeks and a cost of only 7,000 euros to be able to do that. We have scaled our business with 300% over 30 days period. Doing that without compromising the quality of the service. 99% successful on the first attempt. I'm going to pause there because this is a huge number and I always get a lot of questions about that, but this is actually the fact. 99% successful on the first attempt. We have a customer satisfaction of 4.83 out of 5 during this period, even though we have been growing with 300%. And absolutely crucial for us, our community of Urbers. Urber satisfaction is 4.97 out of 5. Almost perfect score from our Urbers. They believe in us. They find us as fair, with fair employee benefits, etc. And we have done all this without compromising the environment. We have 0 carbon deliveries. We don't add any noise or congestion to our cities. And this is something that both our customers, such as retailers, but also consumers are valuing highly. So more proof here. We entered the partnership with DHL last year. We started with one location in Paris. Basically, what DHL contacted us was that they want to improve the customer intimacy and customer experience on deliveries. And this was something that we could provide. They are also looking into green delivery options. DHL aims to have 100% green supply chain within coming years. And on top of that, they are struggling with capacity, especially in highly dense cities such as Paris, and this was actually even more accelerated by COVID. So after proving ourselves and going through the process and showing that we can do what they are asking, we have entered a partnership, full partnership, and expanded our service to another 3 locations in Paris, totally 4 locations, and we are aiming to have 6 in total in Paris. In parallel, we're discussing also expanding the similar concept to Lyon, but other cities in Paris to be able to enable that, the benefits that the DHL is asking for. The customer intimacy, the green delivery, but also capacity to be able to handle that. And this is the ultimate proof for us to get this our model validated by such a big player as DHL, that it actually believes in us and actually continues to add more. So with that said, we are not satisfied yet. So we have an expansion plan for coming 2 years that we are executing on. We are currently operating in UK and France, and we started in Paris, London, and Lyon. We're expanding to several cities in UK and France, basically building the momentum where we have already seen that our model is successful. So cities such as Birmingham, Manchester, Marseille, Lille, and so on. And next phase we are looking into expand to other larger cities where they are highly populated, dense populated, and struggling with congestion and delivery problems, such as Madrid, Barcelona, Berlin, and Rome. So, I promise you guys I'm going to make this short and concise as possible. Hopefully I was clear regarding what we have done and what we have achieved so far. So tie back to where I started, the demand for high quality delivery service has never been greater. This has been a growing market before COVID with the digitalization and the need of purchases online, but we are seeing the exponential growth now with the situation we are in. And what is driving our business is service excellence, highly scalable, and also being an eco-labeled partner as we are with Bra Miljöval that is certified in Sweden. So that was everything from me. So thank you.
Thank you very much for that presentation. So first of all, I want to ask a bit about how the management situation looks like. What is the management team?
So we have a really small team, totally 30 people globally, and the leadership team is divided into each market. So we have a country manager for France and a country manager for UK that is driving the business together with support of me as a CEO and our product team, where we have a CTO that is supporting the team though. So it's a small team with totally 30 people in 2 countries.
All right, thank you. So moving on a bit to the payment model, how do you get paid by these retailers or your partners such as DHL?
So our customers are the retailers and partners, as you mentioned. So we are getting paid per delivery, not per delivery address. Sometimes it can be per delivery, and it's based on distance model and pickup location. So given that we operate in Paris and London, there is different zones. Depending on which zone we pick up and the distance to the delivery address, then we have a model for pricing. So this is nothing unique. We're basically using the same model that many logistic companies are using in these 2 countries.
Thank you. So moving on, you mentioned Paris and Lyon and such. What market or what category of retail do you see the most potential in?
I think our model works really well in highly dense cities all over Europe, and majority of retailers are struggling with getting the packages out from logistic hubs or stored today. So I wouldn't say this is a specific segment of business. Absolutely, we're not working with retailers that have very bulky products such as IKEA, that we need to carry a sofa on a bicycle, but majority of the retailers that have basically shoe size packages is perfect for this type of logistic deliveries. So we are looking into the size of the city, the accessibility in terms of public transportation, and also the type of retailers that we want to address.
So moving on to when you scale into a new market, you mentioned how cost effective that was. But what do you do operationally when you enter a new geography?
Basically, what we do is, for the first, we need to recruit our community, build up the community. We start by advertising that we need help and talk about the vision and the processes around that. This is a flexible job that you can have on your terms, basically. So building the community is the first step. And that takes a week or so, and then discussing, depending, when we expand to new cities, we often do that with the retailer or the customer. We start building that volume, that basically that the base capacity needed to be able to grow from there. So community comes first, together with the retailer that we are expanding to the city.
All right, thank you. So looking into competition, how do you view the potential threat from players such as Uber Eats or something of the such?
So last mile deliveries is kind of a big segment. You have the instant deliveries such as Deliveroo, Foodora, Uber Eats, etc. And they are struggling with peaks during the day, lunch peak, and then they have dinner peaks. And it's basically instant delivery in terms of that the order is placed 1 hour or half an hour before you need the food. And then you have a very short amount of time to deliver that. So that segment is really crowded right now. That's not where we operate right now. We operate in the segment we call the courier deliveries, basically delivering from retailers to that has on-demand production or on-demand inventory, such as florists, pastries, etc. And there is a even kind of a volume peak during the day. And then we have the parcel logistic, last mile logistic regarding ship from store, central located hubs we pick from, such as DHL, and those bigger segments. And there is not as crowded as instant delivery, where it's really crowded, but still a lot of good players that are trying to do similar things that we do, that we compete. And I think competition is always there, so you have to know about them, you have to acknowledge them, and trying to be better than them.
Yeah, that makes sense. So one last question from me. Where is Urbit in 5 years?
That's a good question. In 5 years, I see our service being operating in the majority of the largest cities in Europe. And I'm seeing that also happening across the US, where you see a lot of questions regarding New York as a potential city to be in, given the crowd, given the volume they're talking, and the struggle they have with the congestion and also with air pollution. So I would say as in majority of the largest cities in Europe performing those urban deliveries, that is crucial for the businesses out there.
Thank you. So with that, the presentation is over. We want to thank Kevin for your presentation and wish you all the best of luck in the future.
Thank you for having me.
Thank you.